Check. Good morning, ladies and gentlemen, and a very warm welcome to each one of you present here with us early morning to begin the day 2 of this international conference. Ladies and gentlemen, in about 10 minutes from now, we will go ahead with the proceedings of our first session. I would request everyone to kindly take your seats with all mobile phones kept on to silent mode from now onwards, please. Thank you very much indeed. Ladies and gentlemen, once again, in about 7 to 8 minutes from now, by 9:30, we would like to go ahead with the proceedings of our first session. All our guests who are outside the hall are kindly requested to join us back and take your seats and be seated with mobile phones kept on to silent mode. Thank you very much indeed. Good morning, ladies and gentlemen, and once again, a very warm welcome, and requesting everyone to kindly be seated as we are ready to move ahead with the proceedings of the day 2 of the NFRA International Conference. I would also request for the exit doors to be closed to have a seamless experience of the deliberations that we will have today. So, ladies and gentlemen, we are now going ahead with the proceedings. Namaskar and good morning. Ladies and gentlemen, a very warm welcome to day 2 of the NFRA International Conference on Transparent Financial Reporting and Audit Quality, Pillars of Corporate Governance. So today we begin the proceedings with a panel discussion on lines of defense, role of audit committees, independent directors, and efficacy of their communication with the auditors. And ladies and gentlemen, I have the proud privilege in inviting on stage our distinguished eminent chairperson, Dr. P.K. Tiwari, full-time member, NFRA. Let's welcome sir with a warm round of applause. Inviting our eminent panelists for the session, I have the proud privilege in welcoming Dr. K.P. Krishnan, Independent Director, Tata Consumer Product Limited, former Secretary, Ministry of Skill Development and Entrepreneurship. A warm welcome, sir. Inviting Mr. D. Sundaram, Lead Independent Director and Chair of NRC Infosys. Warm welcome, sir. Inviting Ms. Megan Zeitzman, Global Audit and Assurance Quality Leader, Deloitte USA, and the former board member, PCAOB USA. A warm welcome to you, ma'am. Also have the privilege of inviting to join us on the panel, Mr. P.R. Ramesh, Independent Director and former Chairman, Deloitte India. And ladies and gentlemen, before I hand over to our session chair to carry forward the proceedings of the session, I have the proud privilege of introducing our eminent panel. Our distinguished session chair, Dr. Praveen Kumar Tiwari, is a career civil servant with over 35 years of experience in auditing, accounting, and financial sector regulation. He joined the Indian Audit and Accounts Service in 1985. Superannuated as Deputy Comptroller, Auditor General from the Supreme Audit Institution of India. Dr. Tiwari has several years of experience of the insurance sector regulation as Deputy Secretary Insurance in the Ministry of Finance and as the Superintendent of International Insurance and Supervisor of International Banks and Trust Corporations in the Financial Sector Regulatory Commission, Antigua and Barbuda. He subsequently worked as the Executive Director, Pension Funds Regulatory and Development Authority in India from 2019 to 2011, before moving as Director of the Financial Intelligence Unit, India. As a banking sector regulator, Dr. Tiwari implemented Basel core principles and coordinated Antigua and Barbuda's banking sector evaluation by the IMF. He has done prudential regulation and supervision of banks operating from several countries in the Americas and Europe. Dr. Tiwari's experience in public sector auditing and accounting in India has been at both state and federal levels, including dealing with audit policy implementation and monitoring. And sir, we are honored to have you as the session chair today. Our eminent panelist, Dr. K.P. Krishnan, served in the Indian Administrative Service for 37 years. In his IAS career, he has served in various positions in the Government of Karnataka, Government of India, and at the World Bank. In the Government of India, he has served in key roles in the Ministry of Skill Development and Entrepreneurship, Department of Economic Affairs, and the Prime Minister's Economic Advisory Council. In these positions, he served on the boards of large PSU banks as well as boards of statutory regulatory authorities. In parallel with his government career, Dr. Krishnan has been a strong researcher and academic. He held a prestigious Bok Visiting Professorship of Regulation at the University of Pennsylvania Law School from 2012 to 13. He also served as the IEPF Chair Professor of Economics at the National Council of Applied Economic Research, New Delhi, and as the Honorary Research Professor at the Center for Policy Research, New Delhi. At present is an independent director on the boards of Sri Ram Capital Private Limited, Dr. Reddy's Laboratories Limited, Tata Consumer Product Limited, and a few not-for-profit institutions working in the areas of education and public health. And he is presently the chairperson of the Foundation of Audit Quality. And once again, a warm welcome to you, sir. We have on the panel with us Mr. Sundaram, who is currently the Vice Chairman and MD of TPS Capital Funds Limited and serves as an independent director on the boards of SBI General Insurance, GSK Pharma India, Crompton Greaves Consumer Limited, and Trent Hypermarket. Previously served as an independent director on the board of State Bank of India and SBI Capital Markets, and has been a member of the Board of Governors of the Institute of Financial Management and Research, Chennai, since 2005. Sundaram sir's experience spans corporate finance, business performance, monitoring operations, governance, mergers and acquisitions, talent and people management, and strategy. His extensive experience spans over 34 years with Hindustan Unilever Limited. And sir, warm welcome as we look forward to your valuable insights in this session. We also have on the dais with us Ms. Megan Zeetzman, who is a Global Audit and Assurance Quality Risk and Regulatory Leader for Deloitte Touche Tohmatsu Limited. She has worked with the PCAOB in the capacity of PCAOB's Chief Auditor and Director of Professional Standards, and later on as a board member of the PCAOB. Before joining, Megan's extensive Deloitte career spanned over 30 years and served as a partner in the Deloitte US Professional Practice Network, where she was a member of the leadership team, a leader in the Audit Consultation Network, and the partner in charge of audit standards setting. Ma'am led the development of the firm methodologies and the implementation of the new and revised professional standards and rules, and consulted with engagement teams on complex auditing matters. She was also Deloitte's representative on the International Auditing and Assurance Standards Board and served as the deputy chair. And we are extremely grateful to you, ma'am, for traveling all the way to be part of this international conference. A warm welcome once again. And ladies and gentlemen, our esteemed panelist, Mr. P.R. Ramesh, is the Chairman, Audit Committee, Nestle India, and Independent Director on several companies. Was the Chairman of Deloitte India and has over 40 years of experience in the profession. In January 2024, Sir was awarded the Best Independent Director Award by the Asian Center for Corporate Governance. Thank you. He has been associated with various regulatory bodies, industry bodies, and the Institute of Chartered Accountants of India. In the Confederation of Indian Industries, he was a member of the National Council, the Committee on Financial Reporting, also was the chairman of the committee and the CFO Forum. His expertise extends globally as an impaneled expert on international financial reporting standards with the International Monetary Fund, and presently he holds the position of chairman at the Insolvency Research Foundation. Sir is also a fellow member of the Institute of Chartered Accountants of India. And sir, we are honored to have you here with us today. A warm welcome to you once again. So ladies and gentlemen, with those words of introduction, I have the proud privilege now to hand over to our distinguished session chair, Dr. P.K. Tiwari, to carry forward the proceedings of the session. And sir, I would like to remind you the time duration of this session ends at 10:45. Over to you, sir.
Thank you for that introduction. Good morning to everybody and welcome to this panel discussion on lines of defense, role of audit committee, independent directors, and efficacy of their communication with auditors. To start with, I'll have some introductory remarks. And can I have the slide, please? Yeah. It is accepted that audit is inherently critical. Is criticism good or bad? We have some anecdotes from the prehistory and history. So when Ravan is dying and Lakshman is sent to him for words of wisdom, one of the advices he gives that always trust the minister who criticizes you. From history, Louis XIV, one of the members in his executive council was always critical of him. So one of the sycophants of Louis XIV saw this as an opportunity, and he goes up to him and says, "Sire, he is always critical of you. You must do something about him." And Louis XIV says, "I pay him for doing that." So Companies Act 2013 provides a legal basis for criticism or critique, as my co-panelist, Mr. Sundaram, says. Audit committees and independent directors constitute an important line of defense of corporate governance. So the issue is, do the lines of defense blur into lines of offense in some cases? NFRA's experience is admittedly very limited to the investigations NFRA has conducted in last couple of years. So it can't be said to be representative. Of course, it must be added that the experience has not been so encouraging. I would like to quote Mervyn King, who said, "You cannot legislate good behavior. You can have any amount of..." Mervyn King was the former governor of Bank of England. For those who don't know, he's a well-known name. He said, "You cannot legislate good behavior. You can legislate, any amount of rules and regulations and laws, but good behavior comes out of something else." So in today's discussion, we aim to explore the ground realities because admittedly NFRA's experience is limited to what it has seen in the past couple of years. Now, we have structured the discussion today in two parts. In the first part, we have broken the subject into four parts: the structure, the process, and the conduct, and then the international experience coming from our co-panelist from the US, Megan Zeisman. Then in the second part of the discussion, the first part will last for about 20 minutes, so each panelist will have about 5 minutes each. In the second part of the discussion, we in NFRA have formulated a set of questions. These questions are primarily based on the functions of the audit committee as given in the law, the Companies Act 2013, Section 177(4). Why we have formulated the questions around these provisions in the law? Because we want to understand how the provisions of the law are being implemented on the ground. And we can't have a better qualified panel than this. We have stalwarts from auditing community who have seen audit committees, who have seen, who have been as independent directors on the board. So we hope that at the end of the session, we would have elicited enough information to give us a fair idea of how things obtain on the ground. So without any further ado, let me request my distinguished colleague, Dr. K.P. Krishnan, to talk about structure. And then we pass on to Mr. Sundaram, who will talk about the process. Then followed by that, Mr. Ramesh will speak on conduct. And then Megan will share her international experience. Thank you.
Greetings to my fellow panelists and a very good morning to all of you. Let me begin with a word of thanks to my good friend Praveen, Ajay, all the senior colleagues in NFRA for this opportunity, but more importantly, for this very timely sort of international seminar. I want to have the cheap thrill of claiming I told you so, because I've been a columnist for a while, and I've actually written a column on NFRA when a lot of the world did not know what NFRA stood for and pleaded for NFRA to be strengthened in terms of its legislative mandate, in terms of clarifying some sort of somewhat blurred roles vis-a-vis other regulators, and also sort of appealing to NFRA to come out of the closet and become a little more visible, become a little more public. So I'm certain nobody read the column, but I will claim the credit for, among others, to have pushed NFRA to do this. But thank you once again for doing this. At one level, in this first round, I'm going to stick to very conceptual sort of issues, because the topic that we are discussing on the importance of financial reporting for corporate governance, at its very basic sort of foundational level, is pure motherhood and apple pie. There is nobody who will disagree with the essence of what we are saying. It's fundamentally robust common sense, but as Sam Walton famously said about Walmart, my business model is actually robust common sense. What do? I buy in bulk at a discount, and I manage to sell with a margin and make money. Please try doing this. If it was easy, the whole world would be billionaires. So the simple point is, motherhood and apple pie doesn't always get implemented. And as Praveen correctly said, it is not easy to legislate good behavior, but it's possible to legislate keeping in mind incentives, keeping in mind how people have behaved in the past, and at least ensuring a structure where there is a greater likelihood of good behavior. So in that sense, I want to go back to the basic notion of why do we have a company as an economic entity. Primarily, and it's something we all know, the idea is value creation, and the subsequent questions of how much of this value is retained for further value creation, how do we distribute the value. In essence, if we are able to answer the how of these questions and put in place mechanisms to ensure that this how is rendered ethically, legally, we've broadly answered the puzzle that we're dealing with. But before I go further, I have a general sort of one minor word of caution. Having transitioned from the world of government and regulators to the world of actual value creation, namely the private sector where I have been in the last 3 years, I want to emphasize the fact that we need value creation. Regulators need to understand, like the old Indian debate about growth versus distribution, you need the growth to be able to distribute. So let's keep in mind the fact that a lot of the frameworks that we put in place should not go and actually begin to destroy value. So keeping in mind this and constituting structures for appropriate legal, ethical value creation and distribution is what we are talking about. In that sense, quick look at the statistical trends in India on the one important part of the structure. The structure that we are talking about essentially is the management with independent reviewers, internal, external auditors, audit committees, which broadly is the structure that I'm going to focus on. The quick facts in terms of board demographics for the top 200 companies of India, average board member age is 61. Average board size is a little over 10. Average board memberships is 1.25. About 20% of the board members are women. 54% of the board members are independent. So if one were to take a quick superficial look at the board structure, prima facie, other than increasing diversity, and if you break this down, for instance, a lot of the state entities will come short on independent directors, but the larger set seems to come out well on average on most of these kinds of parameters. My only sort of quick 1-minute comment in this part of the session is, we seem to have a structure which broadly is in keeping with global practices, in keeping with requirements. Can we focus on the aspect which I personally think we need to focus on increasingly, namely the skill sets of the structure and the time available for the structure given the information asymmetry that is inherent in the structure. I've used up my 5 minutes. I'll stop here. Happy to come back to these later. Thank you.
Mr. Sundaram.
Good morning. Good morning, panelists and participants. I'm delighted to be here this morning. Largely, I think, thanks to Ramesh, who has been instrumental in bringing me here. So the outcome, as you decide, the blame has to be fully on him. And I'll just use my background and experience as an audit committee member for quite some time now, also as the chairman of the audit committee in some of the companies. So very much what my observations are tempered by my own experiences. I just want to say, to start with, anything that you relate to a larger purpose, the outcome is always better. Rather than really saying that the audit committee's job is to examine the financial statements and specifically look at the financials of the company is one thing. But the larger purpose one has to carry is to say that here is a set of stakeholders who have trusted you to really say about the company's integrity of the financial statement, its operations, and so on. And therefore, there is a huge amount of trust is based on the line of defense of audit committee, and that's a big responsibility. That is a larger context in which an audit committee must always function. So recently, when I was referring for this session, I came across an interesting statement in the PCAOB resource document. PCAOB resource document, and it meant a lot of sense to me. PCAOB and audit committees have a special relationship that contributes to the integrity of capital markets. We have a shared purpose, protecting investors and maintaining the integrity of capital market. That made a lot of sense to me. Let me just give you some building blocks in my mind, which I thought is useful to share with you. First of all, as an approach, if one has to be in an audit committee, in the whole audit committee membership, you have to have a sense of commitment of time. You have to commit time for the job. It's a hard work. It's a detailed work. You have to do a lot of diligence of what you really go through. It's very, very fundamental and very important. Second thing is you must ask the right questions. You should be able to go through and ask the right questions. So not in a forensic mindset, but a very inquiring way. An inquiring mindset is very important. Third, I think you must assert your purpose. You cannot be pushed around. You cannot be pushed around by management. You cannot be pushed around by anyone. You need to stand your ground and assert if you have to find out an answer to a question or a details or an insight to a particular issue. Second thing is, I think I just want to say, financial statements are in the context of a business model. Each business has got some unique characteristics, like Dr. Krishnan talked about Walmart. There are companies will have specific business models. In some cases, unbilled revenue may have a very significant importance. In some cases, the manner in which the revenue is recognized will be important. You need to understand, a basic understanding of the business model is critical. Internal processes you should understand well as an audit committee member. You should understand how the internal processes are really working. Finally, I have to, as an audit committee member and an audit committee chairman, I have to ensure that the processes are working, management processes are working, audit processes are working, and they are all for real. Not only working, they are for real. So it's absolutely important to look at that. The third thing I always place emphasis on ITGC, Information Technology General Controls. Because today with so much of technology in accounting and record keeping and everything, the general controls, the integrity of general controls is very important. You need to, as an audit committee, get an independent assurance that these processes are working, particularly things like access management. Very, very critical. The access controls. These are very, very critical because otherwise the whole system can be really compromised. Then I always prefer an audit committee members to be doubling up as risk committee members, because an appreciation of the enterprise risk management issues are very, very important. Because you need to some extent, audit committee, when it is looking back, risk committee always is looking forward. So you just need to integrate both and understand that the risk committee, being a member of the risk committee and understanding the enterprise risks would be an integral part of the whole thing. You have to spend quality time with statutory auditors in pre-meetings. One thing is to come all of us together in a meeting, but I prefer to spend time with the statutory auditors one-on-one. One of the audit committee members, preferably the audit committee chairman, should spend time with the statutory auditors, go through the details, go through the underlying issues one by one, and so that we have a very clearer picture. When we go to the audit committee, there's a much larger, clearer picture is there with all the other members we can really share. Same thing with internal auditors. I need to sit with them, go through what the internal audit issues are, how these are getting mitigated, what actions are being really taken, and bring it to the audit committee and discuss this whole thing. These one-on-one meetings have played a very, very significant role in improving the quality of discussion and quality of understanding of the issues. I also feel that there has to be a pre-meeting with the statutory auditor and the finance management together, the CFO and his team together, so that the totality, the issues can be really examined. The other thing these days I get very concerned about is the cyber security. So it is important also that we spend some time as audit committee members with the CISOs, the Chief Information Security Officers. Audit Committee Chairman should insist that he or she clears the agenda. It is my job as Audit Chair to clear the audit agenda and the time that is being allotted for the subject. I have never constrained a statutory auditor's time in presentation, never. Because a statutory auditor requires 1 hour, he is a very, very important part of this entire audit committee proceeding. So they have to be given the full time. So therefore, the agenda content and ensuring the time is really given is very critical to monitor. There is also a good practice of special audit committees. In the normal quarterly meetings, sometimes the agenda is very, very tight. So there is internal audit presentation, statutory auditor's detailed presentation, your RPT to be really cleared, and your whistleblower complaints to be listened to. There are so many of these issues when they are really coming up. It is absolutely important that you have 2 meetings at least in a year where a special, I call them special audit committees, where you construct the agenda to go into a fair bit of details on certain subjects. For example, I go into the details of tax issues, what the disputes are, what the issues are, what the views that are being taken by the company. There is those. Second thing is on contingent liabilities. What are the contingent liabilities in the balance sheet? What are the details? How are they being really constructed? What is the incremental movements and so on? Third is the omnibus approval for RPT. That's one forum where we just do the omnibus approval. Internal audit plans, we discuss in detail. Similarly, IFC processes, the internal financial control processes, all these are going into detail. Sometimes a quarterly meeting simply will not have the time to be devoted to, and therefore the special audit committee have really served the purposes extremely well. Other thing which I think is important is that the audit committee presentation should be very, very specifically tailored to the accounting and the details of accounting. It should not be the same as business performance and mixing it with the board presentation and the audit committee presentation to make in one presentation is something which I have never encouraged, because the audit committee presentation has got to be focused on accounting, have to be focused on financial statements, have to be really focused on the details, not necessarily about how the business has performed and so on, for which there is a board and there is a board forum to discuss those details. Similarly, I think audit committees should ensure that assessment of the internal auditors and statutory auditors are done every year, and that must be an independent point of view by the audit committee, not necessarily what is recommended by the management, because you need to assert that we do have observed this and therefore a point of view. Every quarter, at least once in 6 months, it's also useful to have, and not useful, it's important to have audit committee meeting with the internal auditors and statutory auditors together without the presence of the management. That helps enormously, because certain times people are able to share with you any insights or any issues where they really believe things are not really forthcoming. Audit committee should not hesitate to appoint specialists if necessary on some specialized subject. It could be, for example, on cybersecurity issues. It could be on ITGC controls if necessary, and so on and so forth. I think it's, or any investigation for that matter. So these are very important. Finally, I just want to say what Ramesh used to say. Ramesh says, it's a very interesting thing he used to tell me. You can have a manual on swimming. You can have a very detailed SOPs on swimming. You have to go into the water and swim. Then only the real test will really happen. Otherwise, it will all remain. Something like what Dr. Tiwari said, that the good behavior cannot be legislated. Thank you very much. That's my initial remarks.
Dr. Tiwari, my turn. So before I start, can we have silence in that segment? There is a lot of chatter which is disturbing this session from that corner of the room. So can we have them silent? I was not able to hear Mr. Sundar. You may not be affected though. So good morning, all of you, and my thanks to NFRA for this outstanding function, I should say, this conference. It's truly a forum where we can interact, exchange ideas, come up with suggestions, and it's very wide in terms of now the types of people who are attending. And now, in my case, as you would have noticed from the introduction, I am currently a member of an audit committee, in some cases chairman of audit committee, but for 40 years I've been an auditor. So for those auditors in the room, my heart is part of your tribe in a way, it's still with your tribe. So if I may have some harsh messages in the course of my speech or my talk, please consider it in the right spirit. It's a spirit of enhancing quality. And this subject, before I get into conduct, the role of audit committees and communication with auditors. Let me first put it in perspective so that you understand the role and both the limitations in the role and given that what needs to be done. Who is inside a company for the longest time? An average audit committee member spends between 50 to 75 hours. Sundaram will bear me out. Let's take 4 hours for an audit committee meeting, 6 meetings in a year or 7 meetings. Then you are part of other committees, you're part of the board, you have pre-audit meetings, whole of it, even 75 hours. Whereas the auditor spends hundreds and thousands of hours inside the company, has access to books, records, vouchers, other documents. So I liked what the chairperson of NFRA said yesterday, that you should rely on auditors. Whilst we would rely on auditors, we also have a role as audit committee, and I'll touch upon that. The audit committee's role does not envisage being inside a company and scrutinizing, books of accounts, vouchers, and other documents. How does an audit committee go about? They review agenda papers, they review presentation, listen to presentations, look at them, review all the documents which are placed to them, interact with the auditors, internal and external, interact with CFO, which is part of the communication which I'll touch upon, and ask very intelligent questions, look at analytics, the whole thing about process which Mr. Sundaram spoke about. But a large part of the audit committee's role is on communications, both written and oral. And that's why we need to focus on that. And I have some specific suggestions which I will give you. So although therefore in theory the audit committee is primarily responsible, and I'm not shirking away from that, for the preparation of financial statement, etc., I believe that the auditors have a responsibility too, and maybe a larger responsibility given the fact that they have access to everything, they spend a larger time. The communication with auditors, therefore, assumes great importance, as Mr. Sundaram highlighted. This includes both open meetings and in-camera meetings. An auditor's communication to those charged with governance, if I'm saying one line, has room for improvement both in quality and content. And I'll talk about, make some specific suggestions. Years ago, auditors would give what is called a management letter to a company, running into pages and pages, well-bound document, which was a speaking document of what the auditor saw, what he's suggesting, what recommendations he's making, whole host of deficiencies. In a technology world today, you're seeing PowerPoint presentations, and I've been part of that too, a few slides here and there, given the time, and that's it. Thereafter, there is no other document, a management letter, which I think we need to go back in time to have that management letter being received. The second thing is my experience, of course, has been mixed, and there are two aspects to communication. One is content, second is perception. And as part of a role of the audit committee is also evaluating what the auditor has done. So that's a lot in perception. and that comes through communication. So we have, I would highlight maybe 4 challenges. Let me start with the first challenge, which is the auditing standard itself. And I'll read out from SA 260, which is standard on communicating with those charged with governance, para A16. You listen to me carefully. It says, care is necessary when communicating with those charged with governance about the planned scope and timing of the audit so as not to compromise the effectiveness of the audit, particularly where some or all of those charged with governance are involved in managing the entity. Now, in an audit committee and in the board, you'll have members, whole-time directors, you'll have also independent directors. So there will always be somebody who is involved in managing the entity. But the next line in the standard is very disturbing. For example, communicating the nature, timing, and extent of detailed audit procedures may reduce the effectiveness of those procedures by making them too predictable. How can it be? We want it to be predictable. We want to understand what an auditor is planning to do. Facilitate that as an audit committee. Now, this may be perhaps viewed as out of context. If there is a toxic auditor, and I hope that's an oxymoron, he may use this and say, I don't have to communicate to you because it may become too predictable, so let me carry out what I want to do. So it defeats the very purpose of an auditor communicating a plan. So the first challenge is the standard. The second challenge is part of the perception is who is making the presentation. Unfortunately so, in many situations, and ideally, as an audit committee member, we would like to hear from the horse's mouth. In many situations, the engagement partner is not making the presentation. We are hearing from, crudely, if I may put it, from the pony's mouth, some member of the engagement team. Now, how will you have an effective communication when the person presenting is not the person signing the accounts? We have, along part of the team, somebody comes and says he's a relationship partner, somebody says he's some other leader in the firm. That is not what we want for two-way communication. The third is content. If you want to evaluate what in the quality of an auditor, what is done, which is absent in most presentations, is when did the audit begin? When did it end? How many hours were spent on the audit? Perhaps for all you know, you would have spent only 50 hours, less than the audit committee. It won't give us satisfaction. How many hours? Who spent those hours by category of persons? If it's all juniors, then I would be worried. How much time did the engagement partner spend on the audit? What experts were involved? What digital tools were used? What special areas were focused? What were the disagreements with management? What was the resolution thereof? Even if it is resolved, we would like to know. So I think we need to revisit the standard itself on content and maybe lay down some minimum content for the audit committee's communication. And fourth, before I close, is the biggest challenge for audit committees come in group audits. When you have a large company and you have yesterday Mr. Uday Kotak talked of 350 subsidiaries. And if they are not the same auditor, I don't get a chance to communicate with those auditors of all those entities. Sadly, we heard a council member yesterday saying we have no plans to implement ISA 600 or anything. But you don't require, honestly, you don't require a law. Companies themselves can appoint to at least material subsidiaries the same auditor as the parent, so that you can ask, you can have that communication. Divided responsibility is divided accountability. So that's the fourth challenge. I think we need to find a way around that fourth challenge, because the parent company auditor says, I have relied on the work of all the other auditors. And he in turn is relying on written communications, which in turn is passed to us. So there could be a lot which falls between those. Thank you, and I'll participate.
Megan, please.
Right, thank you. Good morning, everybody. It's a real pleasure to be here. So thank you to NFRA for the invitation to participate today and to be on this esteemed panel with all these esteemed panelists. It's a great privilege. So I thought, well, I'll spend a little bit of time just maybe level setting. And I think we've heard a lot over the last day, and I think we'll hear more as the day proceeds, about the importance of really a broad, well-functioning ecosystem that drives audit quality and reliable financial reporting. So, really that the financial report, I think it goes without saying, that reliable financial reporting that people can trust, that investors can actually rely on, is driven not only by auditors, but also by companies' management, by the audit committee, by regulators, by standard setters, and by other players within the corporate reporting ecosystem. So each member has a really important role to play. So this panel, obviously, we're focused very much on the role of the audit committee and the auditor, and that really important relationship, and how key it is to driving quality outcomes. I mean, I think the prerequisites for audit quality sit within a sound control environment within the company, strong governance, excellent application of the accounting framework, which is driven by clear accounting standards, clear auditing standards or assurance standards with very clear criteria, and then a robust regulatory regime that holds auditors to account, but at the same time allows innovation and continuous improvement opportunities. So, I really think the interactions between all those parties are key to strengthening the respective lines of defense. So you start and work. This is obviously not meant to dive into all the lines of defense. We're looking at the roles of the auditor and the audit committee. I think at the end, the auditor really comes probably last as the last line of defense, more of what I would call a preventive control, but there are a number of detective controls and foundational things that really need to be in place. And that's really where the important role of the audit committee comes in. I think you've probably already had a flavor from my co-panelists who've talked about the importance of the role and maybe also the difficulty of the role and the wide span of things that audit committees need to be focused on. And I think internationally, you certainly see some variation around the world in terms of how the different regimes work, how the audit committees are constituted, what they're focused on. And there's certainly feedback that comes from different regulators, from different surveys that would indicate that there's definitely room for improvement. So for example, there was a survey done last year in the United States. It was a survey that was run by the Center for Audit Quality, partnering with Deloitte, and it found that there kind of was a little bit of a disconnect even in some of the areas that audit committees were focused on, in that the survey was of audit committee members of, I think, 160-something large companies. I think at least only 20% of the total of those audit committee chairs who were surveyed indicated that fraud risk was among the top 3 criteria that they would be focusing on. So, and that's because they have lots of other things to focus on. So, I think it's really important that audit committees do stay focused on, really on their roles of oversight of the financial statements, oversight of a company's financial reporting, because that really does set the foundation for an effective audit. So let me talk a little bit now about the US environment. So I think many of you have heard about the Sarbanes-Oxley Act. We've talked about it over what's come up a number of times yesterday. And certainly, recognizing that the US system is recognized as a sound example of a mechanism that does feature prominent and a continued focus on the importance of strong controls at the company, and then illustrates how all the participants within the system are linked and held responsible. So most of the, maybe some of the more well-known provisions of the Sarbanes-Oxley Act, or SOX, relate directly to the external auditor. So, for example, that was the act that established the PCAOB, the regulator of the auditors of public companies, but also established the requirements for audits of companies' internal control. So SOX, however, took a very holistic view of the entire financial reporting system. And it contains a number of provisions that are addressing the role of management as well as those charged with governance or the auditor. So you kind of need to look at the whole thing as a package. So some of the main provisions that are really important are, it starts with some really more direct responsibilities for management. So the CEO and the CFOs are required to certify all of the quarterly and annual financial statements of a public company, that they are fairly presented, and that the results of the operations are fairly presented. And knowingly presenting false certifications is subject to criminal penalties, and there have been cases brought against certifying officers in that regard. It also makes very clear that no officer or director of a company may fraudulently influence, coerce, manipulate, or mislead the company's internal auditor, which is also a really important provision. In the event of a restatement, there's also the ability for a clawback of bonuses and profits that might have been distributed to CEOs and CFOs. So all of that really sets a strong accountability for management. But then it also has provisions around the audit committees, which are responsible for the appointment, the compensation, and the oversight of the external auditors. So it really strengthened that regime. So let me dive a little bit into audit committees. So obviously, is the topic of this panel. So in addition to the requirements of the Sarbanes-Oxley Act, which have been enacted into law, into rules through the SEC's rulemaking process. So that's how the provisions take effect. There are also a number of federal laws and regs. There's additional acts, the Dodd-Frank Act, as well as other SEC rules. And then there's also requirements of the various different listing exchanges that deal with requirements for the composition of audit committees, the capabilities, competence, etc., as well as what they were meant to do to discharge those very important oversight responsibilities. And clearly oversight of the audit and the audit process is among, maybe not, or maybe the most important function that an audit committee can serve. So if you look at the backdrop of what drives the auditor's interaction with the audit committee, you look to the auditing standards. So the PCAOB's auditing standards contain very clear requirements for what needs to be communicated to the audit committee, and also includes really communications that span all the phases of the audit. So start with communications around planning, and then going into the course of the audit, and then important things at the end. So it's very much an idea that there is a continuous interaction and communication, two-way communication. Many of the things that are required to be communicated are things that can't just be written down on a piece of paper. They're things that you actually have to sit down and have a conversation with the audit committee so that the auditor can share their views, hear from the audit committee, and really have a dialogue about these different things. There was actually a speech made just last month by Paul Munter, who is the chief accountant of the SEC, and he really called out the important role of audit committees. I'll just read a couple quotes. He mentioned that they are the critical gatekeepers for investor protection, and he emphasized the benefit of having an audit committee that is truly independent of management. He also had some advice for the audit committees. He encouraged them to meet formally or informally with the auditor, independent of management, to engage in open dialogue with the auditor, to have in-depth discussions of financial reporting and internal control matters, to ask the auditor probing questions to assess audit quality, and to speak directly with the engagement team about the importance of professional skepticism and the audit committee's support of the engagement team. And also to avoid substituting management's judgments or interactions with the independent auditor for the audit committee's own judgments and engagement. Many of which I think are what you heard from Mr. Sundaram. I think so very, very much aligned. He also emphasized the importance of audit committees having dialogue with auditors about inspection results, the firm's internal monitoring programs, and other audit quality reporting or initiatives that a firm might have. And also focused on the expertise of the auditor, so the expertise of the engagement partner, the engagement team. Do they know enough about the industry? Do they bring specific skill where it's needed? And really, does the partner really take ownership of the team? So I would encourage you to go and have a read of his speech. It's on the SEC's website, and certainly has a lot of really good information. And then I think the interest or important attention that the PCAOB also plays to look at audit committees, I think has already been mentioned, but I think it's very apparent from looking at the PCAOB's outreach and interactions with audit committees. So the PCAOB doesn't directly regulate audit committees, but they recognize the really important role that audit committees play, and they recognize the importance of audit committees actually understanding the role of auditors, but also the role of the regulator. So there's a lot of direct interaction with audit committees from the PCAOB. So for example, on every inspection of a public company that the PCAOB performs, they would do an outreach to the chair of the audit committee to have a separate interview with the inspection team. The vast majority of audit committee chairs take that up, and it's oftentimes an opportunity for the audit committee chair to really learn a little bit more about the PCAOB's inspection process, its purpose, its outcome. So that's really important. And then the PCAOB puts out a number of different resources for audit committees that give results of their inspections, but also examples of questions and probing questions that audit committees should ask of auditors. And that, they do that periodically through a spotlight series. They keep those up to date. They're very topical and very much aligned with things that the PCAOB is seeing out of its inspection process. So I think, maybe I'll conclude by saying that I really strongly believe that the path to addressing many of the challenges that we've seen and that we've heard about over the last day and a bit, really, and with this desired outcome of high quality corporate reporting and high quality audits, really needs action and commitment from all the players within the ecosystem. So there really isn't a magic bullet to address these issues. You need multi-stakeholder dialogue, you need due process and standard setting, you need robust regulation, and you really do need global collaboration. We all need to learn from one another because there's a lot of really good stuff going on around the world that we can share best practices. So, it does really seem clear that we're at the turning point of what auditing of the future will be. We heard yesterday about the role of technology and all of the exciting developments, but also the challenges and the risks that will bring. So, I think that this is a really important panel to talk about the importance of the audit committees and the key role that they play, and that relationship between audit committees and auditors really, cannot be overemphasized.
Thank you, Megan, and other distinguished panelists for a very comprehensive but useful head start to the discussion. With that, we move into the second round of discussion. I was a bit greedy and had drawn a very ambitious list of questions, but I think given the time frame, we'll have time for one question each. So let me move on to Dr. Krishnan. And sir, my first question is about the composition of the audit committees. The Companies Act 2013 requires that the audit committee will consist of minimum 3 directors, with independent directors forming the majority. It also requires that the majority of the audit committee members, including the chairperson, shall be persons with ability to read and understand financial statements. The functions of the audit committee provided in section 177(4) are wide-ranging and highly specialized. Given this composition of the audit committee, do you see any challenges in the compliance with these conditions? Thank you.
Thank you, Praveen. I'll actually try in my answer to not only cover this, but also the related question of independence, independent auditors, independent audit committee members, and I'll do it within the time limit, not to worry. Quickly, 4 general remarks and 4 specific concerns. We are all familiar with the origin of the 3 LOD framework post the 1990s, the dot-com burst and a whole bunch of similar things when it sort of exposed the world to the ever-expanding risk landscape. To manage the risk as well as exercise of control, all these structures got created, got strengthened, more like it. And these oversight mechanisms essentially are to ensure enforcement of the agreed legal frameworks. Third sort of general observation is somewhere along the way, and this was alluded to by Mr. Sundaram, the whole category of stakeholders has got expanded from a very narrow, limited sense of addressing shareholders. We've now moved not only minority shareholders, but an ever-expanding list of stakeholders. So it's a very large sort of canvas which you capture in this. And the fourth sort of general point, and this again came in some of the observations, is it is not just the responsibility of the audit committee, it has to be the collective responsibility of a number of players in this process. In this background, what are my 4 specific sort of concerns in answering this question? And this is based entirely on my experience of the last 3 years of working. Clearly, and this again was mentioned by both, I think, Mr. Sundaram and Mr. Ramesh, the workload of the audit committees is hugely expanding. There is cybersecurity, supply chain, hugely enhanced post-COVID, workforce challenges, geopolitical risk, economic risk. So the mandate is clearly now huge. In this background, I think, and that's my second concern, independence is directly correlated with ability and competence. And this general statement about familiarity with, our ability to read financial statements is somewhat similar to the prescription we have in a lot of our regulatory legislations on selection of technical members, familiarity with public administration, economics, and law. About 500 million Indians who read Economic Times every morning will become eligible, and this has to be understood in that spirit. But I think the point I'd like to emphasize is, in addition to the financial aspect, the point that Mr. Sundaram made, given complex business models, a thorough understanding of the business is integral to the work of the audit committee. And I think we can do more on this front. We need, there is a skill gap that I find in audit committees on complete understanding of the business, the complexity of the business, and the business risks. Closely related to this is the over-reliance on the chairperson or one member who has the background or the expertise. This is something that I think audit committees in consultation with NRCs need to handle. Audit committees need to be actually committees and not effectively get run by one dominant person, and that has a whole bunch of consequences in terms of group dynamics, de facto independence, because if there is one person who is effectively running the committee, all we need to undermine independence is to handle one person. And this is, I think, a live risk. And the related sort of general good governance practices of ability to deal with dissent, ensuring that committees actually record all that needs to be recorded, which is sort of closely related to the previous point, are the 4 sort of broad concerns that I have on this point. Stop.
Thank you, sir. My next question is to Mr. Ramesh, and it pertains to related party transactions. The Companies Act 2013 requires approval of related party transactions by the audit committees, but also makes certain exceptions, including transactions between a holding company and subsidiaries. It also provides for omnibus approval of related party transactions. NFRA has observed misuse of related party transactions provisions. Give us a sense of how widespread this phenomenon is and what should be done to stop its misuse and to make legal provisions more robust. Thank you.
Thank you. I certainly will make some suggestions on legal provisions too. First of all, I concede related party transactions is the most sensitive, perhaps one of the most sensitive matters, and which come before the audit committee and which everybody is concerned about. However, we must realize related party transactions in general are not evil. They are often a business necessity, and therefore it is not a stigma to have related party transactions. Automobile companies deal with entities which produce components and supply to automobiles. There are many examples that way, even in pharma, etc. Having said that, the focus, therefore, has to be on abusive related party transactions. The real challenge is in legislating or regulating to prevent or detect abusive related party transactions. There is a challenge. The challenge is about striking a balance between excessive legislation and loose legislation. I'll give some examples though. But abuse occurs in a number of ways. First abuse occurs in identification of related party transactions. And this question is often asked, how do I know all are related? Relationship is based on blood relationship, is based on control, is based on influence and dependency. And the fourth one, where it is loose, regulations and laws, is relationships based on group, brand, trademark, and other affiliations. Now, if you're sharing a common brand, you're part of a group, there are control mechanisms in place for you to comply with a group behavior. But they are technically not related parties because it's based on control, influence, or blood relationships. We need to look at this carefully. Second point is relationships are always looked at a point in time. There are general declarations, etc. So the point I'm trying to make here is the law currently does not cover periods before and after relationship. Meaning, if I am a director, there is a matter which I am interested in, I may resign as a director, maybe come back after a year or two, after the transaction is entered into, where there is, so then it doesn't become a related party transaction. It doesn't go through the lenses which you want to. Equally, it can happen the other way. So both before and after, so we need to perhaps look at a window of maybe a year before and after. So if a person joins the board, look back in transactions which he would have been interested maybe in the last 6 months or 1 year to see whether there could have been abuse. The third issue is what I call shadow directors, not listed in the related party things. Somebody who's a family member who's in the group and therefore not on the board, not part of any related directly to any members on the board because seemingly the board is independent. But all decisions are directed by the person. I think in some geographies there is this concept of shadow directors. We need to look at, can we capture shadow directors? And abusive related party transactions happen in a number of ways. Channeling funds into other entities, transactions not reflecting substance, pricing not at arm's length, and there are other challenges is where you do not act to benefit a related party. You don't participate in a bid because you facilitate the benefit to a related party. There too you are denying your entity on which you are on the board or the investors of that entity a potential benefit, which is actually going to some other related entity. Very hard to detect, but I'm just giving you the landscape or a business opportunity which is lost to a related party. Then timing of the related party to directly or indirectly benefit the related party. So how can the abuse be prevented given all of this? Very quickly, fundamental to all of this is looking at the rationale for the transaction before approving the transaction. Why this transaction at all? Forget with whom and what. Why do we need to do this transaction? And why do we need to do this transaction with this person? It's not about arm's length pricing. Second is pricing to be independently verified. Sitting on the board or audit committee, you are not the expert in pricing. Have it independently validated. I think the law should also provide that at a point in time. The third one, which I have a very important suggestion, which is drawing from the experience in fair value measurements. Wherever fair value is applied, you have this 3-level classification, 1, 2, and 3. First one being you get the same price for the identical item. Second is where you are surrogates, you look at and assume it's and the third one is a loose one, where you're looking at projections, future cash flows, all of it. Why can't related party transactions also be classified into these three for reporting? Which is the transaction which is exactly what they would do with other customers, same price, same listed price, nothing. Incidentally, it's to a related party, let's not waste time. Second one is surrogates, and third one is the one we need to focus on. Having said this, I think related party transactions do not necessarily happen in goods and services, but in matters outside of goods and services. So therefore, why the big thing in related party transactions is the pricing, right? And transfer pricing becomes extremely important. And often even the experts tell us, transfer pricing, there are 6 different mechanisms, the markup of 15% seems all right and all that. Here I have maybe 2 points, I'll close with that. And one where we need to perhaps really act upon. Let's take, because you don't know what is the actual markup should be based on comparables, transaction net margin, whatever, you're marked 15%. A year later, transfer pricing officer determines the transaction markup should be 20%. Then what happens? Company may contest, may not contest. In many situations, they go and pay the tax. So effectively, if the markup should have been more by 100 rupees, they pay the tax on 35 rupees. My question is, the underlying transaction was underpriced by 100 rupees. The 100 rupees should come back to the company. We should have a recognition of the transaction at the correct value at a subsequent time once you accept that yes, there is a valuation. But in practice, that does not happen, and I think this is a debatable issue which one needs to look at, particularly in the area of pricing. The second is always the issue of range. And I will pause here. I think with these and with an independent verification, sir, I believe there is sufficient legislation today, particularly after SEBI's revisions to the LODR. It's vast. We don't want to reach a situation where it's impossible of compliance too. Thank you.
Thank you, Mr. Ramesh. A quick question to Mr. Sundaram, and this relates to evaluation of internal financial controls and risk management. Mr. Sundaram, give us a sense of the audit committee's oversight over the internal financial controls and risk management functions. Are the audit committees facing any challenges in performing this task?
Thank you. As I mentioned in my introductory remark, the underlying processes are very important, be it order to cash, procure to pay, hire to retire, record to report. All these processes are very, very important. They must all hang together. We need an independent assurance of that. We just need to ensure that these processes are indeed working, and within them there are so many sub-processes. For example, some years ago, I had a situation where the internal audit highlighted that some high-value materials, reconciliation and scrap disposal was not happening very well. Then the audit committee then mandated, and really said that please go into this specific process, identify why this is really happening, and ensure that if there's any leakages are there, ensure that this is really stopped. So the processes are very important. Ultimately, audit committee has to ensure that the control processes, management processes, audit processes, all these really happen. In this, every year, there is design adequacy and operational effectiveness is always tested. For every process, you really sort of ensure this is there. There is a walkthrough that is really done, and then design effectiveness is really sort of see that it is adequate. What is critical is that an independent evaluation of the IFC is done, because the board has a responsibility to positively state in the director's report to really say that the internal financial control system is adequate and working effectively. So therefore, it's a responsibility to ensure that this is discharged. So we need to have an independent assurance, an independent agency. It could be internal auditors, it could be someone else. The statutory auditors also look at it, but they look at it more from a financial reporting point of view, not necessarily all the underlying financial and business processes. So it's important. Audit committee should insist that this is presented to the audit committee. Audit committee should ensure that the agency who has really done it presents it. One of the questions I always ask is, what was identified last year as the deficiency, which you said has been rectified, ameliorated? Has it repeated? Why is it repeated if it is so? And has it been rectified properly? So you just need to go in to see that as a trend, all the deficiencies are really getting remedied and the processes are strengthened. Because only as long as the process is very strong, all the outcomes will subsequently be very strong. So it's important that the IFCA as well as IFC for financial reporting is very, very strengthened. There are enough technology measures today, there are technology interventions today which can be used effectively to really give you that assurance as an audit committee. This is what I really feel. As far as the risk management is concerned, as I mentioned, I would always like the audit committee members to be part of the risk committee, to understand the ERM completely, the enterprise risk management, because it helps you to see that which are the specific areas where you deploy the internal auditors and the focus to really see that a risk-based audit is really done adequately and effectively. So it's a very long subject, but I'm really saying that it's important because it's a very foundational to really have a very, very strong processes. Otherwise, what you really build up on that will not be effective. Because the foundations have to be very strong, so processes have to be very strong. Audit committee has to have that assurance independently.
Thank you, Mr. Sundaram. Megan, a question for you, and this is on effective two-way communication with the auditor. What is the nature and extent of engagement of the audit committees with the auditors in the United States? What best practices are adopted to ensure an effective two-way communication with the auditors?
Yeah, great. So I think Mr. Sundaram laid out some really good best practices and good ideas already, and I think what you've heard from some of the other panelists. So I think in the US, the audit committee would meet with the auditor at least quarterly and at the end of the audit. It's around, driven around the interim reporting, but I think in practice it happens more frequently. And they discuss a wide variety of things, which, as I said earlier, range from things that relate to the planning of the audit, how it's going to be discharged, and then really going all the way up to the report issuance. The PCAOB has a standard, AS 1301, which sets out all the various different requirements. It's very detailed and has, some very, you actually could argue almost technical requirements for things that auditors have to tell the audit committee in terms of who's actually doing the work, where it's been done, which specialists are being involved, etc. And I think, one of the things that is very clear, the importance that the PCAOB places on all of that information making its way to the audit committee so that the audit committee can properly exercise its oversight, is the focus that the PCAOB puts on that stuff in their inspection process. So they have a separate category in their inspection reports, Part 1B, where violations of that standard would be highlighted. So if you pick up an inspection report, you might often see things that auditors have failed to tell the audit committee. So clearly the PCAOB thinks that that's really important. And there's actually recently been a fair amount of activity on the enforcement side where PCAOB has really been concerned about the audit committees not getting information that they should have. And primarily it's in the area of auditors involved, so involvement of other auditors, involvement of specialists, but sometimes it's around communicating the planning, the strategies, the risks, discussing the risk of fraud, etc. So I think some of the best practices include, kind of what we've already heard, that the audit committee needs to own that relationship with the external auditor. There needs to be unrestricted access to the audit committee without management being present. Audit committees should get to know the lead partners. They should also ask to speak to the specialists on the engagement. So talk to the IT specialist, the tax specialist, the valuation specialist, the actuarial specialist, and really hear from them as well. Important to establish expectations around how the communications are going to happen. They're going to be two-way. Don't set limits on the agenda. Make sure that there's enough time to actually have those robust discussions, but also be available to the auditor. The auditor is going to call the audit committee when things are, where the auditor is concerned, and that can happen sometimes at an inconvenient time. But it's really important that the audit committee chair and the audit committee make themselves available to listen and have those substantive conversations. And I think also it's important that the interactions include educational topics. So I think the auditors obviously are in the position to be able to have good conversations about emerging topics and really do sort of a little bit more of an educational session. So I think it's important for audit committees to invest in those kinds of things. And then important for formal evaluations and regular feedback. I really think all of that establishes the groundwork for really effective two-way dialogue. And obviously the importance of that relationship really can't be overestimated.
Thank you, Megan. Thank you very much for that. I'm afraid with that we'll have to wind up the discussion because I'm told our time is up. I've already cut down my list of questions by 3/4, so maybe some other day. Thank you, co-panelists, for a very engaging discussion. Thank you very much. Really appreciate it.
Thank you very much indeed, sir. And I would now like to invite Mr. Pukhraj Tak, Executive Director, NFRA, to kindly do the honors of presenting a token of gratitude and appreciation. We would like to begin by honoring, going by the ladies first, and of course, speaker who has traveled all the way. We present to Ms. Megan Zeetzman. Thank you very much indeed once again, ma'am, for being here with us and for sharing all those valuable insights. Can we get the mementos on the stage, please? We honor session chair now, Dr. P.K. Tiwari, full-time member, NFRA. Thank you, sir. We would now like to honor Dr. K.P. Krishnan, eminent panelist. Thank you, sir. It was a pleasure to have you here with us on the panel. We present to Mr. D. Sundaram. And to Mr. P.R. Ramesh. Thank you very much indeed. I would request Mr. Tak to kindly join our panelists for a group photograph. Thank you. And ladies and gentlemen, we now take a short coffee break. Tea and coffee is served downstairs, one level below this. As you move out, you can see the escalators on the left-hand side. And the next session will start sharp at 11:15. We would request you all to kindly be seated by 11:10. Thank you. Please enjoy your tea and coffee and join us back in time for the next session.
Thank you so much. Really appreciate it. Thank you, sir.
And we will build on that. It has to be persuasive.
एक्सक्यूज मी सर ये कितने बजे स्टार्ट है? कितने बजे स्टार्ट है? 11:15। हाँ तब तक हम पानी वगैरह सब चेंज कर देंगे।
तो जब मैं करूँगी तब आप उनको that's the problem. विद्यार्थ्यांचे काम
Ladies and gentlemen, requesting all our distinguished guests, participants, delegates to kindly take their seats as soon as possible. Ladies and gentlemen, it has become extremely important for us to stay in time, as now the Honorable Minister joining us for the validatory session has slightly preponed his schedule, and we will now have to conclude all our sessions in time and may also have to skip the tea coffee break in between. We request you to kindly cooperate with us on that.
Hello, this is Gaurav. Sir, this is for the MP Vijay Kumar. Sir, are you able to hear us? Sir, you are on mute, sir.
No, I have unmuted.
Okay, okay. I can hear you properly, sir.
Okay,
Am
great.
I audible
Thank
to you,
you,
sir?
Gaurav. You are audible, Gaurav. Thank you.
Okay, thank you, sir.
Thank you.
So, ladies and gentlemen, we are all set to go ahead with the next panel, which is on strides in financial reporting. And we have our two eminent panelists on the days, Professor Sanjay Kalapur, Professor, Indian School of Business, Hyderabad, and part-time member, NFRA, Mr. Mohan R. Lavi, partner, KP Rao and Company. And joining us virtually on this panel is Mr. MP Vijay Kumar, member of IFRS Interpretation Committees and IFRS Advisory Council, IFRS Foundation. And also, ladies and gentlemen, let's put our hands together to welcome our distinguished moderator, Ms. Archana Bhutani, partner and India regulatory leader, Deloitte India. And ladies and gentlemen, before I hand over to our distinguished moderator, a proud privilege of saying a few words of introduction. Moderator, Ms. Archana Bhutani is a partner with Deloitte Haskins and Sells LLP and also oversees the regulatory profile as a professional practice partner. She has nearly 25 years of vast experience relating to accounting, Indian GAAP, IFRS, auditing, corporate law, and other related matters. And prior to joining Deloitte, she worked with BSR and Co. LLP for 23 years. And ladies and gentlemen, eminent panelist, Professor Kalapur is a part-time member of NFRA, is an independent director on the board of IDBI Bank, where he actively contributes to the risk management and audit committees. Previously served on the board of the Life Insurance Corporation of India. Professor Sanjay Kalapur joined the Indian School of Business in 2005 and has been engaged in conducting research on financial and managerial accounting, auditing, corporate governance, and risk management. Notably, he served as an editor of the Accounting Review from 2008 to 12 and becoming the first individual from outside North America to hold this esteemed position. A warm welcome to you, sir. Mr. Mohan R. Lavi is qualified as a chartered accountant in 1989 and has over 27 years of experience in industry across a variety of industries, having worked in senior positions in finance, in manufacturing, and software. He has over 8 years of experience in practice. At present, he is a partner with Messrs. KP Rao and Company, Chartered Accountants, Bangalore, and heads the financial reporting, India AS, and ESG practices of the firm. Mr. Mohan is the author of the books on IFRS and AS, Key Audit Matters, and the Sarbanes-Oxley Act. His articles appear frequently in the Hindu Business Line, Deccan Herald, and Bombay Chartered Accountants Journal. Is also a regular speaker at various forums on financial reporting. And ladies and gentlemen, joining us virtually, can we have him? Yeah, he's here with us. We welcome Mr. MP Vijay Kumar, member of IFRS Interpretation Committee and IFRS Advisory Council, IFRS Foundation. A warm welcome to you, sir. And may I now hand over to our distinguished moderator. Over to you, ma'am, to kindly carry forward the proceedings. And I would request you to kindly conclude latest by 12:20. Thank you.
Good morning, everyone. It's a pleasure and privilege to be part of the panel and discuss the financial reporting landscape with such an esteemed panelist. I'm just going to take an initial 5-10 minutes to set the tone before we move into the panel discussion. We are living in a challenging and changing world. The issues of transparency, accounting practices, governance have become high agenda items in organizations worldwide. The equity and debt markets have become less forgiving. The complexity of business transactions and structures has increased, and the stakeholders' expectations are also changing. Now, given this environment, of course, stakeholders require financial information which is relevant for their decision making, and this is where gap comes in. Incomplete information creates uncertainty, and that results in risk for investors and creditors, thereby for them demanding a higher rate of return. And therefore, if the financial statements have to continue to be relevant for decision making, continual monitoring and improvements in gap become very relevant to reflect the changes in economic and other conditions, the capital markets, the stakeholder expectations. So if you see the US experience on the slide, the financial reporting has changed. The landscape has changed significantly over the decades. It started from a development focus in 1930s when there was no standard, moved on to homogenization focus wherein standards were set up, and then gradually moved further to consolidation focus in 1980s, and then fair earnings in 1990s, and finally, very most recently in 2000s to value reporting, especially considering the introduction of host of issues relating to value reporting, integrated reporting, non-financial reporting. So as you can see, this is how the macroeconomic developments also have impacted the financial reporting framework. Now, similar experiences can be seen. I've just put one here, but if you were to go through other countries, you'll find similar experience as well, and similarly for India also. India has actually caught up, I think, very significantly in the recent past in terms of matching the pace of change globally. It has taken a big leap as far as financial reporting is concerned in the last 2 decades. In addition to the financial statements being source of information, I'm just picking it up from the discussion that we had yesterday. In India, we do have the regulators supplementing that information through additional information in CARO relating to governance and proprietary matters. So you will actually see even that keeps on evolving. If you see the most recent change that happened in CARO, you had introduction of clauses relating to diversion of funds, evergreening of loan, and that was just kind of reflective of what was really being seen in the financial reporting sector. So we said financial reporting framework continues to evolve. So what's on the menu right now for financial reporting reforms? There's been a relatively stable period, but we do expect certain changes to come. And even if, let's say, IFRS or IASB doesn't, I think there's still some areas where gaps are there and probably at a local level may require attention. So the first one, if I can just quickly, I mean, we'll discuss these as part of the panel discussion, but just quickly to refer to them. Areas where I think right now there is a gap and some kind of either disclosures or maybe revision in standards is required. The first one, everyone will agree, I'm sure, is the business combination under common control. So while Appendix C was very well intended, its implementation has presented many, many challenges. And possibly there is a realization that one model may not fit all. The second is on the goodwill impairment. Again, while it is conceptually sound, experience has shown that it is not really working as intended. The impairment is too little, too late, and there has also been very recently debate on reintroduction of the amortization method. An interesting one, which I've seen now getting discussed globally, is the self-generated intangibles. So there's discussion happening, should these be on the balance sheet, especially looking at how vital these intangible resources are to certain sectors. They're still not on the balance sheet and therefore not really visible to most of the stakeholders. And therefore, right now, the regulators globally are looking at what can be done to improve transparency on those. Then there are other ongoing projects like the post-implementation project. A significant one is on the financial instruments with characteristics of equity. I think those will also kind of reflect some or the other changes that will come into reporting. IFRIC agenda decisions, I think we'll discuss when we, in the panel discussion, but I do believe it requires more attention in India, especially where standards are converged. The regulators are expecting us to comply with also the IFRIC agenda items to the extent there is no carve-out. And therefore some initiatives or educational measures may be needed on that account. The last one, if you ask me, the big one is the primary financial statement, which is just on the horizon. It's going to be a new standard IFRS 18, which will replace IS 1, and I see that potentially as a game changer. So I'll talk about the primary financial statements in the next few slides, but just before I end, as far as what's on the financial reporting reform, just a small input. We spoke a lot about quality yesterday, right? And PCOB also referred to the fact that just a mere registration with PCOB does not mean your quality of audit is great. Similarly, just by mere issuance of the financial reporting standards, you cannot ensure quality. So while the framework is there, the requisite standards may be there, the key aspect will be the effective implementation of its standards. And therefore, while doing that, taking due consideration of the spirit of law, the substance of form becomes very relevant. I think without that, the framework cannot really achieve the purpose. And as they say, if something looks like a duck, walks like a duck, talks like a duck, account for it like a duck rather than a chicken. I'll move on to just very quickly to take you through what the primary financial statement project is all about. If you look at the IASB projects, IASB has issued a lot of new standards in the last decade, but they've mostly focused on recognition and measurement. Nothing much has been done as far as disclosures is concerned. So some of the recent standards, revenue recognition, look at leases. So they all focused on recognition and measurement. And as a result, the income statement under IFRS is rather form-free. We do still have Schedule 3 in India, but globally, if you look at IFRS, it's rather form-free. And therefore, the board has now proposed amendments to the way information will be communicated in the financial statements with focus on financial performance. So the key three changes, if you ask me, the first one is in terms of how to provide more comparable information in the statement of profit and loss, how to have more discipline and transparent approach towards reporting of management performance measures, and the third is regarding disaggregation of information. So I'll just quickly, very briefly, just take you through this. This gives you a snapshot of what the statement of profit and loss would look like. Again, if you go back to where the gap is today, IFRS does define what is revenue. It defines what is profit and loss, but it doesn't define any subtotal, right? And as a result, companies and investors, they have started creating their own subtotals, because of which there is lack of comparability. So the key, if you ask me, one most important proposal of the standard is the introduction of the 3 subtotals: operating, investing, and financing, which will bring in a greater structure and also improve comparability. So operating profit, for example, is shown even now. Many companies present operating profit, but there is no definition, and therefore there is lack of consistency. So in that context, this becomes significant. The next one is management performance measures. I think this has been an ask of the industry for many, many years. So while it does come in with a lot of riders. So the standard proposes that if companies usually present non-GAAP measures, and the standard terms these non-GAAP as management performance measures, in, let's say, public communication documents like it could be an investor, investor information that is going out. If non-GAAP measures are being provided, then these management performance measures need to be disclosed in a single note in the financial statements, and that note will have why these performance measures are useful, how are these determined, and thirdly, a reconciliation to the most comparable line item in the statement, in the income statement. So I think this again is a very significant one, which will help users understand how the management performance measure reconciles with the financial statements. And the last is the level of disaggregation. Investors have complained that quite often information is lumped into one single line item. You look at other expenses, other income, you'll have many, many items which are just aggregated there with user really having no idea as to what does this comprise. And there are going to be now requirements, specific requirements as far as aggregation and disaggregation is concerned, so that information can be provided in a more meaningful manner to the investors. So I just wanted to take 5 minutes, sorry, on this, because I thought this was very important in terms of the change that we expect to see in the near future. So we'll move to the panel discussion now. Thank you. So my first question is to Mr. Mohan Lavi. Sir, the financial reporting has been criticized as being very complex and having overload of disclosures. How do you, and recently the regulators are also talking about simplification, right? How do you see this happening? Do you feel a real substantive simplification is possible? And if yes, will simple be better? I mean, can it be better?
Okay. First of all, let me thank NFRA for inviting me here for this extremely important discussion we are having on financial reporting. And I couldn't come here actually, though I wanted to come, but circumstances prevented me from coming here. But I believe the discussions have been very useful. So let me go straight to your question, Archana, and I'll answer this in two parts, basically. The first part, I'll go back to 2004, when the IFRS standards were actually implemented. And the environment at that time was, we just looked at WorldCom, we looked at Enron and all those issues which had come up there. And I think the problem there was not about accounting, but about disclosures, about not disclosing. Even Enron, the question was about not disclosing the fact that they've not consolidated a very important subsidiary company. So when these standards were developed, I think what the IASB was thinking was that it's better we give one full blast disclosure. We'll give standards which will focus more on disclosures. So they started, for example, IFRS 7 and IFRS 12, all focused on specific disclosure-based standards. So this was the first part which happened in 2004 onwards. And I think one more reason for that, Archana, was that they had a separate standard for IFRS for SMEs. So where they had a slightly reduced disclosure requirement. So I think compared with these two things put together, I think that was the initiative which they had initially taken, saying that it's better to disclose than not to disclose. But as we moved on, around 2012, 2013, it was observed that many of these disclosures were becoming template-based. They were just disclosing for the purpose of making a disclosure. And there was a lot of projects which the IASB also initiated. And subsequently, they've got into a lot of 3 or 4 separate projects for, trying to simplifying the disclosures. They did one on IAS 19, they did one on the other standards also. But I think many of that was sort of, they felt that there was no need for them to change the standard as such. Even as we speak today, we have a couple of projects. In fact, what you see, the amendments to IAS 1, the shift from significant accounting policies to material accounting policies is probably a part of this initiative. Though we can still debate what is significant, what is material, should I put everything together and say both are significant and material? So I think this is one of the things which they have achieved. They also have other projects on, subsidiaries, consolidation is not, no public accountability is there. They want to give them reduced disclosures. So a lot is going on. I think what we need to understand today is not about simple, but I think relevant. I think you spoke about relevance. So I think relevance of that disclosures becomes primarily important for this entire thing. I think we need to accept also the fact that each one of us want to look at financial statements, what we want to see in them. We don't look at the entire gamut of financial statements. So each person wants to look at it in what they want to look at, what they want to get from those financial statements. So I think it's not a question of simple or easy. I think it's a question of being relevant and useful, I think. I think that is what I'll probably say for this thing here. I think in Indian context also, we have also been up to tune with that. So I think that change is happening. It will take some time, but it's definitely happening. Yeah.
So there is different types of complexity. When I started teaching accounting, we were doing earnings per share based on APB opinion number 15. There was one paragraph in that opinion which could be interpreted in 6 different ways. So that is the kind of complexity we don't need. We want standards that are written in ways that people can understand. Then at a conference once, the CFO of IBM said that their salespeople would go and do these leases, which would be, they would want them to be sales type leases so that revenue can be recognized. And so, there was a lot of discussion between the client and this CFO's team and the sales team and the CFO's team about what wording would qualify for it to be a sales type lease. And apparently, after everything was approved by the CFO, 1 comma was dropped, and that made it not to be a sales type lease. Okay. So that is the complexity that comes from the kinds of contracts, the terms within the contracts, etc., which is not accounting complexity, it is the complexity of the real world. So that cannot be helped. There is a third kind of complexity that comes from the fact that similar transactions are reported differently by different companies, which makes them less comparable and therefore more difficult for users to understand. And the standards try to reduce that kind of complexity. And there is a trade-off, you don't want complete uniformity for the sake of uniformity. You don't want too much variety for the sake of variety either. There is going to be back and forth between the standards and the way they are implemented and so on. So I think complexity is a fact of the real world, and we should do the best we can.
Thank you. MPV, I know you there, yeah. So do you want to add to this? And I do know that you have certain, in terms of how do you see it linked to the applicability of India's roadmap?
Yeah, thanks Archana, and thanks to NFRA for the invite to be part of this very important conference. Archana, coming specifically to the question which you mentioned, Ind AS and IFRS as we speak are almost the same. They're literally the same, sans those small carve-outs which my view are largely for transition. So whatever journey is there in IFRS, the same applies to Ind AS as well. No difference on that. Coming specifically to the question of simplicity, I think simplicity is always the best to have, whether it is a business model or a business transaction or accounting. Simplicity is always good. In fact, investors love it and they actually give a premium for the same. But unfortunately, we all in business, in fact, I'm also as a preparer, we all in business, we come to situations where commercial contracts, the way they are done, more often than not have a lot of structuring, whether it is raising money or whether it is a sale transaction as Sanjay was just mentioning, or even a expense vendor-supplier relationship. We tend to make those commercial contracts complex and we embed a lot of rights and obligations. It is the accounting of, it is actually the identifying of those and then putting them through the test of recognition, measurement, and accounting is what actually makes difficult. If you look at Ind AS, I'm sure many of the participants here in the conference will agree that as long as you don't have complex transactions, as long as you're doing a vanilla transaction, the standards are extremely simple, commonsensical, easy to understand. All of the literature which is there is basically to only guide how do we go about handling a complex transaction. I have seen over at least since 2016, I have been part of several forums of various accounting bodies, including IFRS Foundation. Consistently, people have wanted to do it as simple as possible. Mohan Lavi was talking about IASB's initiative of simplification of disclosures on IAS 19. It was a huge effort which was put in, almost 3 years of efforts which IASB put in. But the feedback which came is, no, this is also important, this is also important, this is also important. So while there is effort to simplify, the user groups say that, no, we want this information. That's where the project is at this point in time. And my only input to the business community at large, in order to ensure a fair presentation, and my view, it helps sustainability, is to keep business transactions, including capital structuring transactions, as simple as possible, because I feel investors really love it. They really love simplicity, and it makes understanding financial statements pretty simple.
Great. So moving on to the next one, goodwill impairment. I spoke about that, and I think there's general acceptance that goodwill impairment is too little, too less, too late and too little. And goodwill impairment, therefore, has been a very divisive issue. The IASB has finally decided that there is no compelling case to review the goodwill impairment model. Instead, I think it is now working on a project wherein more information will be provided through disclosures on business combinations. How do you see this? I mean, do you see this as going to add to the judgment that investors need to apply to understand that information? Or do you think, at least at an India level, do we need to have a separate debate on amortization of goodwill? How do you see the situation for India, sir?
Different ways for accounting for goodwill have been tried before. So in the US, goodwill used to be amortized for up to 40 years, and most companies would default to amortizing it over 40 years. So when Blockbuster was a video store chain, a video rental store chain in those days, and they acquired another company, and they were amortizing that goodwill over 40 years, and some newspaper asked, has anyone ever seen a 40-year-old video rental store? And of course, later Netflix came and Blockbuster is no longer in existence for not even 10 years after that. But these things are inherently difficult to predict. So I don't see that any one method is necessarily better than the other. So we also used to have purchase versus pooling of interest, and we have seen how transactions used to be structured. The Daimler-Chrysler merger was apparently structured in order to make it qualify for pooling of interests, as it used to be called. Then UK had another system for goodwill. It could be written off directly to reserves and so on. So I don't see that any one method is consistently superior to the other. So I do agree with the IASB that the standard seems to be okay.
Mohan, do you want to add?
Just to add on to what Professor Sanjay was saying, I think we also need to look at it from the point of view of, if you look at 103, goodwill is actually given not much of an importance there. They actually give importance to the other intangible assets which are acquired in a business combination. So, I mean, to put it in a very different language, goodwill almost becomes like a balancing. We can test it for impairment every year. So, I really don't think we should worry too much about goodwill right now, but focus more on the other intangible assets.
Okay. So that actually takes me to the next question linked to intangibles. Like I said, the IASB has now picked up this project where they're saying there are sectors wherein intangible assets, self-generated intangible assets are very relevant and viable assets, but they're not on the balance sheet. And therefore, investors do not have the requisite information. Right now, we do not know whether the project will result in reconsidering the recognition measurement of intangibles, or would it just be a disclosure-related amendment? But do you feel overall there is room for improvement as far as the standard is concerned in bringing some information in the financial statements, whichever way, regarding self-generated intangibles?
Maybe it's a bit too early for us to actually address this in terms of accounting and recognition and measurement. But I do believe that the IASB is in an active project in this. But if you go by what they have done for leases, I don't see any reason why they should bring out a project or bring out some sort of a publication which will enable these self-generated intangible assets to be actually sort of recognized in the balance sheet. I don't think they will only focus on the disclosure part. I think the focus is more on, I mean, they'll probably look at how it is to be accounted for itself and then probably test it for impairment and all those things. One of the reasons why I also say this is because the concept of indefinite useful life, which could be a very relevant factor for these self-generated intangible assets. I think that is something we definitely have to think about when they actually bring out this project. It may take time, Archana, I feel, but I don't think it should be ignored in terms of criticality. I think they should probably do something about this. And the development costs, which will ultimately go into this intangible assets, or when this recognition does happen, I think that will become a very, very important guidance to give as to what development costs can actually be capitalized here. And I think in the Indian context, this would be even more relevant looking at the number of startups which are not even starting up in India, and the number of startups which are starting up and the number which are not starting up also. I think you take the gaming industry, for example. I think there would be a lot of importance given to such assets in the gaming industry.
Yeah, I think there have been concerns around R&D as well. So yeah,
there should be a lot of R&D thing on this.
Okay, so do you want to add anything on this?
So I have published a paper. This is an old paper now. It is based on, in the UK, some companies capitalized their brands, including self-developed brands, way back in the 1980s. So I had occasion to study that, and I found that, firstly, the numbers did agree with what the market was valuing. But if the concern is that unless the company put that number on the balance sheet, the market would not know, then that concern was misplaced, at least in that sample, because I found that 90% of the value was already capitalized into the stock prices before it was actually put on the balance sheet, valued and put on the balance sheet by the company. But third, I found that depending on companies' incentives to overstate the numbers, there was a big difference in the valuation that they put on these intangible assets. So the valuation of especially self-generated intangible assets is especially fraught with uncertainties. And if you give companies that discretion to do the valuation themselves, then you will find a lot of variety in practice, which will cause the kind of complexity that I talked about that we don't need, where different companies are doing different things. So I don't think that the capitalization of self-developed intangible assets is an especially useful idea. Now, even where we do capitalize self-developed intangible assets, we capitalize the cost at most. So the development cost of software, of in R&D, that is allowed to be capitalized, which many companies do. Now, the development cost does not necessarily track the market value in any case. So if the concern is that the market value of Apple or companies like that is far, far higher than its balance sheet assets, then I don't see that allowing the capitalization of the cost of these self-developed intangible assets is going to solve that problem. There is another problem with the argument that the valuations are too high compared to the balance sheet book values. Now, the theory of valuation, I have never seen it say that anything has to be valued based on the assets in place on the balance sheet. The residual income valuation model takes the balance sheet value of the assets, plus it adds the residual income of the company over the future. So when these self-developed intangible assets are not capitalized, then they reduce the assets, the balance sheet value of the assets, no doubt, but they do increase the earnings relative to the book value, that is the return on assets. So by the same token, the residual income is higher, and it all works out. So it is just a question of whether we have the information to be able to project those residual earnings into the future or not. And for that debate, whether we capitalize the cost, whether we capitalize something else has nothing to do in my mind.
It's an interesting perspective. I'm going to move on to MPB on business combination. Okay, so IFRS is silent on business combination under common control. We do have an Appendix C to deal with those situations in India, but its implementation has had its own challenges. We were waiting for IASB to come out with their revised standard or the accounting principles, but they've decided not to proceed with it and probably will only explore disclosure requirements. From an India perspective, do you think it requires immediate attention, and what would you recommend?
So, Archana, with your permission, I'll just step back to an earlier discussion you had with Mohan on goodwill. Just want to give an update that IASB has completed the project on goodwill and disclosures surrounding business combinations. The exposure draft should come anytime now in the next 2-3 weeks. It should be there. I think the direction is also pretty clear. And to be fair to all the stakeholders, even though they moved from amortization to impairment model hardly 15 to 20 years back, at the request of all the stakeholders, IASB spent almost about 5-6 years doing research and finally concluded that impairment model serves the interest of all stakeholders best. And Sanjay beautifully explained the history of some of the past transactions and all as to limitations on amortization. So that's where we are on that. But I think for Indian industry, what will be very, effort taking required will be disclosures as around business combinations. It's not going to be easy. See, the problem for all of us is as preparers, we are willing to disclose. The question is, do we have the investor ecosystem who is willing to understand those disclosures in the right perspective? I think NFRA chairman, I saw the speech in the media today. He talked about engaging with other stakeholders as well. I would encourage interacting with one more stakeholder group, which is not very active in India, which is the investor group. We need to create forums for investor group because they seem to be a very critical part of this whole development. So they need to understand the disclosures much better and the volatility which comes surrounding that. So coming back to this IFRS 3-103, IASB spent almost about, 8 years of time, including worldwide meetings, including preparing so much of discussion paper to solve this issue of business combination under common control. Almost every single forum I attended, they put up some paper, put up for discussions, different views came up, and it looked like almost they would crack it. But it just didn't happen because there's so much of complexity surrounding business combinations under common control. And equally and more importantly is that when you prescribe something, I think Sanjay gave this example of the Daimler one. When you prescribe something, there is a possibility of people structuring to that particular prescription. So for this reason, IASB decided not to add any guidance for now. I repeat, for now, on business combination under common control. As far as India is concerned, way back in 2011, I think when the institute developed these standards, they did not want to leave this area open for people to engineer it the way they want. While it's a principle-based standard, they still wanted to ensure some discipline. And that was the time when we did not have valuation profession also in place like it is now. Today, valuation is a regulated profession. There's a separate regulator. It's much, much different from what it was way back in 2011. So I think Institute and the then NACAS, I think in their wisdom and rightly so, decided that let's have the minimum of the likely things, which is the pooling of interest method or book value method, and that found place in Appendix C. But what we have experienced in the implementation is that these business combinations under common control are extremely common, extremely common. Subsidiaries merging, parent acquiring subsidiaries, they are happening all over the time, all over the time. There are entities where there is non-controlling interest, there are entities where there are wholly owned subsidiaries, all kinds of complexities are there. And in every situation, we are now forced to actually do a book value accounting, despite the fact that the substance of the transaction is something totally different. So it is harming a fair presentation of the transaction in the financial statements, and also it has its own tax consequences as well. And it is not proper, I reiterate, it's not proper to put Indian industry, which is now part of global industry in terms of size of operations, and Indian industry, which is part of the 4th or 5th largest GDP of the world, to be put at a disadvantage where the global peers are accounting based on substance, whereas the Indian enterprises are forced to do a book value accounting. I think it is not appropriate. I think it's time we take this project a bit on priority. And the first step, we need to remove the Appendix C, and we should debate whether we should develop an alternative. I'm not seeing an alternative to be prescribed at this point in time. We should just leave it for the audit committees and the regulators like NFRA to oversee those transactions of business combination under common control, so that people have actually applied the right accounting within the conceptual framework. But I think it's an urgent necessity. And the good thing, Archana, now is the valuation profession is pretty much stabilized. This is well-regulated. I think we have reached there. I think we should boldly take that step is my view.
I think that's, yeah, thank you so much. Professor Kalapur, coming to you. You referred to the difference in the market price, the market price being high. So we've seen this, that there is growing gap between the market price and the book value of an entity. That obviously indicates that the investors are relying on information which is outside the financial statements. And
that is outside the balance sheet.
Okay, outside the balance sheet. And you do see companies more and more providing non-financial information continuously and also in a variety of form. How, since that is also going into the decision making, how do you think quality can be, how do you address the quality issue as far as this additional non-financial information or outside the financial statements, that information is concerned?
So the issue there is talking about taking a valuation perspective, since you mentioned about the stock price being, so accounting has different purposes, but taking the valuation perspective, the value is a function of the book value. It is a function of residual income, that is how much earnings are being earned over and above the normal rate of return on that book value. And of course, this residual earnings has to be capitalized to infinity. So we need, as a valuer, we need some information that tells us how persistent are going to be these earnings over a period of time. So we need information to that for that purpose. And that is where the disclosures in integrated reporting about the business model, about the strategy, about the competitive situation, etc., comes to play. We have not figured out how to make companies do that well. I think we know how to think about it, but we have not figured out how to make companies do that well, because from what I see in Australia, etc., they have been giving these integrated reports for several years now, but the quality is assessed to be quite poor. Okay, so there is still capacity building required for the preparers, the users, etc., to get better, and rating the annual reports on whether they provide this information or not. And as MPV said, the investor community, involving the investor community more, I think that's the way to get to a better place than we are in right now.
Thank you. I'm going to, before we run out of time, I want to first come to the primary financial statements and then move on to others. Mona, I'll start with you. I mean, given that it's just, like I said, near the corner, how do you think India needs to start preparing for it, and any thoughts in terms of the proposals as well? And given especially that we have Schedule 3, how do you see that as a interacting factor?
Yeah, I think it's what we have now is only sort of a very basic draft of what is going to come, and I think you captured that very well in your slides, Archana. So, yeah, I think I only remember this, and I keep repeating this in a couple of places, that if you look at Warren Buffett's newsletters, which he gives every year, the first few paragraphs of his newsletter, including the one which he published last week, gives a reconciliation between GAAP and non-GAAP. So he has his own reconciliation. He says, my US GAAP profits are $26 billion, but my version, what I see, is probably $40 billion. And he's been given this for the last 3 years. And he says that, in this latest newsletter, he says that the unrealized gains and losses, the capital gains which he has to pay, he says that for a company like Berkshire Hathaway, it can go to about $5 billion a day. I don't see why I should account for this, he says, until it's actually realized. But that, okay, that is a separate, but he's done this even in the past also. In the past, he's captured issues on impairment and why I can't increase the value of my intangible assets. And so I always look at the first part of his newsletter for the differences between US GAAP and what I call it as Warren Buffett GAAP. What will happen now is that now that we have this MPM coming into the picture here, this may not really meet the definition of MPM because it may not be a subtotal of what is being published in US GAAP. But I think it takes to us a very interesting space wherein the way we are seeing Ind AS or IFRS financial results and the way, say for example, the management perceives it, right? I think if that sort of a reconciliation comes in, I think there could be some sort of a common meeting point, shall I say, wherein we can probably look at, saying that, okay, this is the actual results and this is what has actually happened here. I think we should probably take this up. Obviously we'll have to take this up as soon as the standard and the IFRS standard is released. But I'll go back to what you spoke a little bit earlier also, Archana, on this disclosure part. And I think, though I did speak about template-based disclosures and all that stuff, the disclosures specific to the Indian context, for example, for specific to the Indian context, and especially we look at Ind AS 1, I think you will have something specific to the Indian context. And there also, Schedule 3 will give us some sort of a guidance on how do you account for some of these particular transactions, how do you classify them, how do you disclose them. I think there will definitely be an amendment to Schedule 3 also which will come in with probably the necessary guidance as to where do you classify and how do you measure these particular set of, this subtotals, whatever we're talking about, these measures. So I think that this project has to start very early in India, probably. I think if the IASB is looking at 2027, we should probably look at a parallel date. And it goes back also to the question you spoke to a little bit while about on intangible assets. I think Schedule 3 already gives us some guidance, on intangible assets required under development and all that stuff there. So I think both the standard as well as the Schedule 3 amendment should probably go simultaneously, and that will probably make this probably relevant whenever it comes in the context.
MPV?
Archana, as far as 18 is concerned, I think it's a transformational one. And I think it will make global financial statements pretty comparable. In India, I think credit to the Ministry of Corporate Affairs that we always had a presentation template available, which was not the case with IAS 1, and rightly so. But I think MCA has done its job in terms of earlier having that template of financial statements, 2011 moving to the vertical format and preparing the industry for India's transition. And I think there's something pretty good. So we now need to revisit that template and bring it in line with the prescriptions of IFRS 18. And I think in IFRS 18, the good part is, apart from what you mentioned, I'll not repeat what you have put up in those three beautifully done slides, is the fact that people will get to see operating profit more clearly. They'll get to see operating profit more clearly. And we'll be segregating the financing and the investing ones separately. Second is the reconciliation with the management performance measures. And personally, including my bosses may not like it, I'm not a great fan of EBITDA actually. I strongly believe depreciation is as much an expense like any other expense. And that way operating profit is a line item which comes after depreciation. So if people continue with EBITDA, then that reconciliation will help the investors to understand the financial statements better. I'm sure the Institute will start the project very soon of preparing the exposure draft. They'll be working with MCA also on revising the Schedule 3 as well. And I'm very confident. I've seen the Institute's effectiveness. 1427, I think between Institute, NFRA and MCA. I'm very confident the new format of financial statements will be in place. The only thing is we need to caution the industry well in advance so that industry can communicate with the lenders in the revised format. They can interact with the rating agencies in the revised format. I think giving that 1-2 years time will be helpful. And maybe if NFRA can notify it a little earlier, make it applicable 1427, but people normally, until the notification comes, people think, okay, it may not come. So a little communication that yes, 1427 is the date, I think industry will scale up to meet the requirement. So it's a very welcome step.
And I think it will also require changes to the systems and processes. So yeah, the sooner we start, the better.
Yes.
So do you want to add any comments?
Including the taxonomy and all that kind of stuff. Maybe this might be an opportunity where our taxonomy for our XBRL filing and the IFRS taxonomy will also sync. And my view, once you are the third, fourth largest GDP, I think we should start leading the world in terms of best practices and let the rest follow through with us.
So indeed, I would echo everything that both Mohan and MPV said regarding the management performance measures. So there has been a lot of criticism of the street numbers, as they are called in the USA. But despite the criticism, there is also research showing that those street numbers are useful to the investors, and therefore, this via media in the IFRS 18 about being allowed to disclose management performance measures, but having to reconcile them, it is a good via media between these two. This thing. And the other, again, separating the operating performance from the financing performance is very important from the point of view of projection into the future, because the financial investments in the mutual funds, etc., are not going to earn a company any higher returns than anyone else can earn. They are going to have only competitive returns from the financial investments. But the current format does not enable you to easily separate out the two, whereas this new format, the companies have to separate out the investments that are integral to the business, where there is a possibility of earning above normal returns against the financial investments, and separating out the returns on those two. That is a very useful measure. There is one more thing that has been a demand of investors, but it has never been talked about in the standard setting circles, is about the investments that just maintain the capital versus investments for growth. That separation would also be very useful to investors, but it has not been addressed or not come onto the radar of the standard setters.
We do have 8-9 minutes, and I'd like to keep 5 minutes for the audience. I'll keep 5 minutes for the audience, but last question to you, MPV, and I'm going to combine two. You can just within 2-3 minutes, whatever. One is on the IFRIC agenda decision. Given that these standards are converged, how do you think there is adequate awareness? More action is needed. How do we ensure that in India, the outcome of application of India's is the same as the IFRS with which it is converged? And second is in a way connected to just convergence bit. Do you think it's time to kind of revisit the carve-outs or just even look at giving option to follow IFRS? Just thoughts on these two.
Both questions are excellent, Archana, except the time of 2-3 minutes. Okay, so I'll still try to be brief. First is as far as agenda decisions are concerned, they have the same authority as an accounting standard. So as far as the international scenario is concerned, in India, IFRIC has been brought into the standard, and IFRIC is as an authority. But as far as agenda decisions are concerned, we have not been able to still give that regulatory authoritative status, except if you go through India's 8 in terms of that hierarchy and things like that. Institute has been working on how to make this part of what should I say, authoritative, give it an authoritative status. Just like guidance notes have some authoritative status, Institute is working on how to make agenda decisions also have the same authoritative status. Maybe this year that will get addressed, given the work which has happened in the last couple of years. But I think in the interim, for those who have followed the NFRA chairman's speech over time in multiple forums, I have observed him making a consistent statement that we are also looking at how the standards, whether it's accounting or auditing, have been applied in other jurisdictions when they are looking at reviewing the financial statements or work of the auditors here. The background is whether it is audit standards or accounting standards, they are the same as the global standards. So in terms of applicability, it has to be the same. So from that perspective, I think I have requested the Institute as well that we should do exhaustive programs for dissemination of the fact that there is agenda decisions, and that competency also needs to be developed. It is something similar to our EAC opinions. I don't want to make it as simple as that, but it is something similar to us. And there's a long list of agenda decisions on various standards for the last 17-18 years. And each year, at least another 7-8 keep getting added based on fact patterns and the way standards get applied. I think India industry needs to be updated on this. I think all of us have to take a collective step. Every forum I get opportunity, I keep mentioning about this. And for the participants who are here today, my request is when you get back to your organizations and to your peer communities, please do disseminate that. Agenda decisions have the same authority and force as a standard. In India, while it's still to get that chapa, I think when a regulator eventually looks at how you have applied the standard, they will obviously get guided by those agenda decisions because the treatment cannot be different. Part one. Part two, as far as carve-outs is concerned, I think between the Institute and NFRA MCA, there has been an engagement a few years back where we put up a paper for reviewing the carve-outs. In my view, some of the carve-outs have lived their time, and probably it's time to remove them. And some of the carve-outs, we can let it remain. I don't think we should be defensive about it because they serve a particular purpose. But some of them have certainly lived their time, and we should remove those, and that will be a strong communication. But more importantly, I have the small request. I don't know who from the Institute, MCA and NFRA is here, but I'd just like to place this request. There are many Indian companies who have not availed carve-outs at all, and their financial statements are as good as IFRS financial statements. So we should look at a solution where we can give those companies the benefit of saying that their financial statements are also IFRS compliant. And that way it will actually encourage the other companies also to follow suit and say that, yes, we also don't want this carve-outs because they are very limited kind of benefit, and get the same status of an IFRS compliant one. It does make a difference in terms of raising capital and all. I've experienced it myself. It does make a difference. So I think we should do that. If you look at a country like Japan, Japan allows companies to follow US GAAP, Japanese FRS and IFRS. And in our case, it's even more easier to implement it because IFRS and Ind AS for all practical purposes are the same. I think it is high time we look at that practice. We retain Ind AS itself, except that we give an opportunity to say that if these carve-outs have not been availed, you can claim yourself to be Ind AS and IFRS compliant as well. Maybe some tweaks are there where we have departed from IFRS. Maybe those portions of the standards we can revisit them as well. So I think we should take it up. And hats off to India industry and the audit profession. Since 2016, I think literally with low decibel, I think such a complex transition has been done so very seamlessly. And for me, the NBFC and housing finance companies moving to Ind AS is an eye-opener. In fact, they've done it so well. We can all complain about the effectiveness of how they've applied it, quality, but I think we have still done a good job. I think we should not deny ourselves a pat on the back. I think good work has been done, and I'm sure it will get better with time.
Okay. I think we just left now with just 1 or 2 minutes. So, yeah, can you just state your question? Who do you want to address it to? Please state that as well.
So, I want to address it to the regulatory authorities. So I'm Amit Dharnia. I'm a member of ACC UK. I am an author and corporate trainer on IFRS and Ind AS since 2009. So my basic question is, when we know that the groom or bride is going to get married into Ind AS someday, why do we wait for the eligibility criteria to reach only 250 crore and then suddenly we give them a shock that you have to give a lot of disclosures and their life becomes very complex? Why don't we prepare them early on in their life and introduce Ind AS for SMEs earlier, sooner than later?
Archana?
Yeah, MP.
It's yours.
Okay.
Yeah, go.
So, okay, so thanks for that question actually. So one is, I think in India, for whatever reasons, we have applied Ind AS even for unlisted companies. And we have such a low threshold of $30 million. I think that should also be reviewed. IFRS standards are pretty complex. Instead of allowing people to follow those standards and then to fall and then hold them guilty and chop their neck, I think it's important that we should make it applicable only for listed companies. I think we need to review that as well. And this 250 crore limit was set about 10 years back, 2014 or 13, whatever be the time frame. And I think inflationary adjustments itself, we need to have a look at it. Third and most important is the Institute has taken upon a project in the last 5-6 years where they are revising the existing accounting standards framework and bringing it closer to the Ind AS framework, so that when the entities move from accounting standards to Ind AS, the difference is not much. And I think we need to make life a little easier for smaller entities. And 250 crore net worth is very small in today's context. So my request is let's focus on the larger companies. Over to you, Archana.
Thank you so much. Manish, I know you have a question. If it's for one of the panelists here, can we just take it offline? We need to get into the other session. If it's for one of the panelists here, we'll just connect with you. So if you could, can we take that separately?
Can we take it offline, sir? Thank you very much indeed. Actually, we have a very tight schedule. We're running on a very, very tight schedule, ladies and gentlemen, as the Honorable Minister has preponed his visit to the conference, and For that reason, we will also be doing away with the in-between tea-coffee break, and we'll only have high tea at the end when we close the proceedings of this conference. And so, ladies and gentlemen, let's put our hands together to thank all our eminent panelists on the days. As I invite Mr. Amit Jain, CGM NFRA, to kindly do the honors of presenting a token of gratitude and appreciation on behalf of NFRA. Ms. Sood, Secretary NFRA, to do the honors. To Ms. Archana Bhutani, thank you very much indeed, ma'am, for wonderfully moderating this session. Professor Sanjay Kalapur. Thank you. And Mr. Mohan R. Lavi. I would request Ms. Vidhu Sood to kindly join our panelists for a quick group photograph. And ladies and gentlemen, requesting everyone to kindly remain seated as we are straight away moving into our next panel discussion session on promoting competition and choice in the audit market. We would request you to just give us 2 minutes as we set up the top table for the next session. Ladies and gentlemen, we are all set to go ahead with the proceedings of the next panel. And I have the privilege in inviting on stage our distinguished session chair, Ms. Smita Jengran, full-time member NFRA. I also invite, ma'am, kindly grace the dais with your presence. Also inviting our eminent panelists, Mr. I.D.S. Dhariwal, Joint Secretary, Government of India. Let's put our hands together, ladies and gentlemen, to welcome sir. May I invite Mr. Ranjit Kumar Agarwal, President, Institute of Chartered Accountants of India. Inviting Mr. Sanjeev Chaudhary, former board member, International Ethics Standards, Board for Accountants, USA, and the former council member, ICAI. Mr. Himanshu Kishnadwala, his partner, C&K Associates, and Mr. Vikas Kumar, managing partner, TR Chadda and Company. So, ladies and gentlemen, once again, a warm welcome to the session on promoting competition and choice in the audit market, and a quick round of introductions. We all know our session chair, Ms. Smita Jingran, who is the full-time member NFRA. Our eminent panelist, Sri Inderdeep Singh Dhariwalji, is the Joint Secretary at the Ministry of Corporate Affairs, Government of India. He looks after matters related to corporate social responsibility, National Financial Reporting Authority, National Foundation for Corporate Governance, amongst other responsibilities, and is also currently serving as the part-time member NFRA, and belongs to the 1992 batch of the Indian Audit and Accounts Service, and has extensive experience in public auditing and accounting, and has served as Principal Accountant, General Audit, Himachal Pradesh, Director General of Audit, Eastern Railway, Kolkata, and Accountant General Accounts and Entitlement, Bihar. Additionally, has served across the country in various roles in the CAG's organization in Rajasthan, Uttar Pradesh, and in CAG's headquarters in New Delhi. A very warm welcome to you, sir. I have the privilege of introducing Mr. Ranjit Kumar Agarwal, who assumed office of President of Institute of Chartered Accountants of India for the year 2024-25. He served earlier as the Vice President of the Institute of Chartered Accountants of India for the term 23-24. Is a practicing Chartered Accountant since past 24 years. And he's also a Company Secretary and DSAO from ICAI. He was elected to the 23rd, 24th, and 25th Central Council of the Institute of Chartered Accountants of India 3 times in a row. He has also chaired Tax Audit Quality Review Board of ICAI, and his other recent nominations include his nomination as ICAI's representative on Regional Direct Taxes Advisory Committees formed under the Central Board of Direct Taxes at New Delhi and Kolkata, as an ex officio member in the Committee on Corporate Governance Guidelines for Insurers in India. His accomplishments at international front also include his recent appointment as the technical advisor to the board member of SAFA, the South Asian Federation of Accountants. And we are honored to have you here with us today on the panel, sir. Warm welcome. We have with us Mr. Sanjeev Kumar Chaudhary, who is an experienced finance professional. He is a practicing chartered accountant with over 41 years of rich experience in India and the domestic as well as international tax advisory and consulting, including transfer pricing and taxation of cross-border transactions. He has worked closely with senior legal counsel for matters in Supreme Court and High Court, and has handled corporate tax and expatriate engagements in both advisory and the compliance matters, including compensation structuring, foreign exchange regulations, employing stock option plans, and worked on both inbound expatriates and outbound assignees in respect of various Indian and overseas companies. Was earlier partner in tax and regulatory practice of BSR and Company LLP, sub-licensee of KPMG. For more than 2 decades, and worked with RSM and Company and PwC in tax practice from 2006 to 9, and has served as board member of International Ethics Standards Board for Accountants, an independent standards setting board that develops issues in the public interest. So, ladies and gentlemen, we once again welcome our eminent panelist, Mr. Sanjeev Kumar Chaudhary. Warm welcome to you, sir. We are honored to have with us today Mr. Himanshu V. Kishnadwala. He is a senior partner at C&K Associates and Company, where he oversees the firm's audit and assurance practice, focusing on auditing large corporates, including Fortune 500 companies, implementing Ind AS, conducting investigations, performing due diligence assignments, and conversion of financial statements from IGAAP to IFRS and USGAAP. Prior to his role as C&K Associates and Company, Sir served as Senior Lecturer in Accountancy and Computer System at Narsi Monji College of Commerce and Economics, Mumbai, from June 1986 to November 2000. He has also been a co-opted member and special invitee on various committees of the Institute of Chartered Accountants of India, ICAI. Additionally, has been actively involved with the Bombay Chartered Accountant Society BCAS, where he served as president in 2006-07 and as chairman of the Accounting and Auditing Committee of BCAS until 2019-20. And Sir is a chartered accountant, qualified chartered accountant with more than 35 years of experience. And once again, a warm welcome to you, sir. Ladies and gentlemen, I also would like to introduce our eminent panelist, Mr. Vikas Kumar, who is a qualified fellow chartered accountant with more than 29 years of post-qualification experience, is a partner and CEO at TR Chadda & Company, LLP since 1996, and has extensive experience in statutory audits, forensic audits, business advisory services, etc. Has specialized in the financial services sector with extensive experience in audits of large banks, financial institutions, insurance companies, NBFCs, etc. And he is a regular speaker and panelist at many conferences and seminars of ICAI, SEBI, CAG, etc. on various topics, including accounting standards, bank audits, forensic audits, etc. and is also associated with ICAI as a member and a reviewer of different committees and boards. So ladies and gentlemen, we also welcome Mr. Vikas Kumar on the panel. Warm welcome, sir. And with those words of introduction, I now have the privilege in handing over to our session chair, Ms. Smita Jingran, to kindly carry forward the proceedings of the session. And ma'am, the time duration is approximately 1 hour. And I hand over to you.
Thank you. So this session, good afternoon everyone. This session is about promoting competition and choice in the audit market. So you all know that competition is a quality enhancer. It actually promotes innovation and is a win-win situation for everyone. So who doesn't want competition in the market? But in the market for audit services, we find that the market is skewed, especially when we look at the mature jurisdictions. We find that in the audit of PIEs, the Big Four actually have over 90% share. And this has actually happened because of a lot of mergers and amalgamations. And that's how the Big Four have got the market share. When we come to India, we find that the situation is not so bad. But when we look at the BSE 500, we find that in India also, the top 10 are at around 60%. Yesterday we had Mr. Sunil Sanghi give us a data point. He said that the top 4 account for more than 60%. But when I look at the CMI data, I find that in the listed, the top 500, BSE 500, it's about 60% when we include the top 10 firms. When we go down to top 100, then of course the Big Four have a lion's share. So how is it that we grow this market? How is it that we have middle-level firms grow up and take more and more of PIE audits? And this topic has actually come into prominence because of the words of our Honorable Prime Minister when he was speaking in 2017 at the annual day of the Chartered Accountants. He actually expressed a concern that why is it that there is no Indian company, audit firm in the global arena. Though we have about 10 or 12 odd companies, audit firms listed with the PCAOB, we can't really boast of any particular audit firm having its, making a mark in the international space, which we actually want to look forward to it in the long run. So he actually spoke in terms of growing the firms in India and at least have 4 firms in India so that globally, internationally, whenever people refer, now they will not say Big Four, but they'll say Big 8. So with those words, I will now move on to our panelists, and we will actually ask him how to grow this sector and how to promote competition. I'll first speak to Mr. Dhariwal, who handles, who's at the MCA. So Mr. Dhariwal, what is the outlook of the government on this? And what do you think can be done to promote competition and to grow the middle-level firms?
Thanks, NFRA, for arranging this discussion and this conference also. It is really a pleasure to listen to other panelists in the first session also. And thanks, ma'am, for this question. For government, we go for a macros, we for an ecosystem. We provide the arrangement that is supportive for a growth without specifying our objective and target group. But in this particular thing, for audit firm and audit market, government has multi-pronged approach. One is that we want strong regulation or responsible regulators. That is what we are working toward through NFRA as well as professional institutes. We have recently reviewed disciplinary mechanism framework and ensuring that all professionals are regulated, their accountability mechanism is there. And this is how the investor builds up a reliance on the service providers. And second dimension or the second prong is capacity or the ability. That has two dimensions. One is a volume. So recently the government added companies. The professional institutes now will have registered companies with them. So the companies also comes in the framework of a discipline. So if there is initially it was individuals, now the individuals can come together. So probably 1 and 1 will make 11, this is how we think. And in that 11 also has accountability towards the system. So this is how the now all institutes will have register of firms, where the firms will also be made accountable. Third is the competence in terms of education. In the field of education, in the field of audit, education is a benchmark, it's a preliminary. Thereafter, the huge amount gets added up by experience. But anyway, the initial and starting point is education. ICAI recently reviewed their syllabus for the young professionals, those are coming in this profession, emphasizing on the audit as well as integration of IT tools and new developments in the field. Those can be help for the audit, and we are supportive to that also. Thereafter, the independence of the audit or quality through independence is already being ensured in the Companies Act through independence of auditors and a rotation of auditors. And also we have the concept that is being now emphasizes MDP, multidisciplinary partnerships. This again is based on the philosophy that the individual cannot do what the collaboration can do when the collection of different professionals come together and provide. This also has been studies. I was going through one article recently which says that the big four might be known as accounting firms, but basically the dimension that they serve to is more than 70 services. So this is a huge spectrum which might be related, interrelated, and this is how the governance can get addressed. So we also need this culture to be built up in our country where professionals are coming together for a common cause or serving the corporate world for better governance. And probably this is how we will provide these support to the whole fraternity. Another thing is, this is my personal opinion, that the demand has to come from the ecosystem. This audit is being used by a vast number of stakeholders, from users or auditor themselves, or the firms, those are paying for the audit, and then the stake investors primarily, or researchers and other study groups also. So India is a one field which is evolving and evolving very fast. So I hope the further demand will come from the ecosystem or from the market, and government will positively will respond to it. Globalization is a one dimension which is, which throws challenges, but it also opens up opportunities. IFSC is a one dimension I recently saw in this past 1 year, that is being, IFSC zone is being opened up, where the companies will be allowed, being geographically in India, but will be governed as international firms beyond Indian rules and regulations. So probably our firms, if they are there in IFSC, they will have a taste or flavor of an international competition, international requirement, where from they can probably export the services to the rest of the world or the other users. And other users will also be there. So probably they will be able or seeing the real life scenario where they are being opted or picked up in competition or in comparison to the other service provider, international service provider. And they will know probably by this comparison where all goods they are doing and making their mark on it, and where all they need to build up and come up with some sort of additionalities. So we are positively working towards it. Prime Minister Saab's Honorable Prime Minister, what he said shows the feel of a nation that is searching its place in the international dimension. And rightfully so, because if you would introspect, the big four, those are working in India, are basically we the Indians. And they are not coming from outside. So if we can compositely work in that umbrella there, so there will be number of permutation and combination whereby we can enhance skill, knowledge, and put them together for a better service and better purpose, I would say. Ma'am.
Mr. Dhariwal, I think that was the main thing, regulation and skill and knowledge. I'll now turn to you, Mr. Ranjit Agarwal. We see that there are a lot of proprietary concerns, audit firms which are proprietary concerns. Now, when we talk of competition, we're looking at competitions at two levels. A, and which is more important, is domestic competition. So we do have a vision for being there at the international arena, but first we need to do something to grow our homegrown firms, They need to grow. And then the Prime Minister's vision of the international competition. So in your view, what are the ways to go ahead on this, on the domestic competition? And do you think that we need to merge like the West did? And do you think there's also room for creating some specialized courses where then those audit firms can do audit of PIs?
Thank you very much, Madam. Very respected MCA Secretary, NFRA Chairman, sir, all the dignity. Thank you very much for giving this opportunity to have an interactive session with various regulator and the stakeholder. Before I answer your question, we have to see the background, how the institute and the membership at large are working in India. The Institute of Chartered Account India, 1949 was created, started with 1,600 members. Today we are 4 lakh chartered accountant and 8.5 lakh students pursuing chartered accountancy. Even the gender bias, if you see, there are 29% chartered accountants of women CA and 43% students are women students pursuing CA. But having said that, this 4 lakh chartered accountant in India, there are 1.5 lakh only practicing chartered accountant. And this 1.5 lakh practicing CA comprise of 1 lakh CA firm in India. Out of this 1 lakh CA firm, 75,000 firms are proprietorship. Out of this 25,000 partnership firm, there are only 400 firms having 10 partners and more. So this dynamism of this Indian chartered account in India, which is a growing economy. If you see the GST, IBC, RERA, or reform in the income tax, or digitalization, all these things are helping the country to grow, and informal economy going to be the formal economy. Now in this formal economy, the growth rate is just 6.5 or 7%, and OECD is saying 6.2%, but the global growth rate is 2.3%. So India is in the right path of the growth with the support of the contribution of the chartered accountant of these 4 lakh CA working in the ecosystem. Now this 75,000 firm which are proprietorship, and if you want to know the data, there are 19,000 pin code in this country. In this 19,000 pin code, there are more than 17,000 pin code where chartered accountant presence is there. So it's a wide spread of this ecosystem where chartered accountants are contributing in the growth and development of this country. As far as capacity building of these firms are concerned, we have so many parameters which the institute is taking in last so many years. If you talk about the various certificate course, recently we have come out with a aggregation of the CA firm. We have a networking guideline, multidisciplinary, we are also discussing with the Ministry of Corporate Affairs. We have so many advertisement guideline restriction. If you see the West, 1976, the institute come out with a ethical standard board. And after 1 year, the IESBA, International Ethical Standard Board, was formed by IFEC. So when we come out with an ethical standard board, we have our code of ethics, in which we have stringent norms, unlike the West, in which they are very liberal. So today, the advertisement guideline, and there are so many parameters on the chartered accountant regulatory measure is there, so that they are not able to do this unlike the West are doing. So having said that, if the regulatory aspects are so stringent, which has been made by the institute itself on their member, of course the time has now come to ease out some of the restriction if the firm wants to grow. But this 25,000 firm, who was a partnership firm, and the kind of certification course, now today we have come out with a new concept of AI in ICI. Now, I was in Vienna 6 months before. There the presentation of the Microsoft 700-page balance sheet was downloaded ChatGPT. And now they're asking the question, what is the profit of the Microsoft? What is the last year profit? What is the adverse comment of the auditor? So without reading the 700-page reports, all the questions are answered by the system. So now this AI is going to transform the entire ecosystem, including audit profession. So that's why we have come out with the AI in ICI. We have come out with the aggregation of the CF firm. How this CF firm can be build their capacity, they can be aggregated, and the proper mentoring and the guidance can be given so that they can live up to the expectation of the entire ecosystem the India needs as a practicing chartered accountant. So in our opinion, madam, the role the institute is playing in last so many years, we are aware of some of the challenges with the changing dynamics of the trade and the profession. We have taken note of it, and now new initiative the institute is taking so that the aggregation of the firm and the capacity building of the CF firm can be made. At the same time, we have other regulatory aspect also, how to regulate the profession. We have quality review board, we have tax audit quality review board, we have financial reporting review board, we have so many regulatory mechanisms. Suo moto, we are taking the balance sheet and then seeing the conduct of the practicing chartered accountant, how they have reported. And if they are found gross negligence, we are sending to disciplinary mechanism. If there is a small negligence, we are giving the advisory. So as an institute, whatever we are doing, that is at par, which are expected to do. But yes, the challenges are there, and we have to be more vociferous, and we have to be more proactive in addressing these challenges. And if you see this correct, we have come out with the new syllabus. Now, this new syllabus, where articleship has reduced from 3 years to 2 years, and on the final level, all the course in the final level, ethics and the technology has been infused in every subject at the final level. And that's why once we launch this new CRET with the global best practices, the Institute of Chartered Accountants of Singapore, they have written to us last year that if one of your member or any member is residing in Singapore more than 6 months, so without passing any exam, we are giving your member the membership of the Institute of Singapore Institute. That is also a commendable and applaud we institute is getting because of the recognition we are getting from other accounting body outside India. So on these lines, the course curriculum, the capacity building, the regulatory aspect the institute is doing. This year we have made aggregation of the firm, AI in ICI, so many new things we are doing. But yes, advertisement guideline is the constraint. There are other provision of the law which we are reviewing, and we will come to the ministry how we can ease it out.
Thank you, Mr. Agarwal. I think a lot of initiatives have been taken by the Institute for capacity building and other directions that they give to them. And I'm sure, taken in the right spirit, the members will be able to grow their firms. And we do hope that out of these 25,000 firms, some of them will really grow. Maybe some may also merge, and we have bigger firms to meet our objective of meaningful quality competition within the domestic market. Now, Mr. Sanjeev Chaudhary, I move to you. You are the partner of a very ex-partner of a very large firm, and you are very well aware of this market being skewed. So please tell us that if you were to think of ideas as to how to grow the market, which are the 1, 2, 3 things you think will be very important pointers in this direction?
Thank you. Thank you to NFRA first for giving us the opportunity to discuss and debate on those points. I think the president of the institute has made my task a little simple by giving the data as to what the number of members are and where the members are. At the outset, I must admit that each member has a role to play. So I think the SMEs have a role to play, and one must respect that. They have a big role to play. In any ecosystem, it is not only the large firms which are playing their part, it is the small firms also who are contributing to the entire ecosystem. Now, having said that, if the firms have to grow, I will divide this into 2 parts where ICI has a role to play and the members have a role to play. I agree with the president when he said we have some guidelines, some regulations which are age-old. You can't solicit work. A member comes up and says, well, if a foreign company is coming, how will they know about me? I should be allowed some kind of solicitation, some kind of advertisement. So I agree with Mr. Ranjit when he says that we have to modify those rules and regulations. Allow advertisement to some extent so that there is a level playing field for the members to grow. I think we must relook at the networking guidelines. We have issued, when I say we, meaning the ICI, sorry, sir, it is the ICI which has issued networking guidelines. But I think as on date, if about 100, 200 firms have registered with the Institute on the networking guidelines in the last 2-3 years, I think one needs to have a relook at it as to how do we tweak them so that more and more firms use the networks, and the networks is a mean to grow. You see, you create a network with a firm, you start understanding, and then you get into a marriage, right? And that is how the smaller firms will grow. So networking guidelines have to be relooked at. These are the domestic, and I think we are still awaiting from the Institute the guidelines where the Indian firms can become a member of the foreign networks. And I think that is what the guidelines initially had said, that you will be coming out with these guidelines. I think, sir, you have taken a step on aggregation of firms this year. A committee has been set up, and we look forward to more action from that committee as to how the firms can aggregate and how the firms can grow without least of the regulations so that they can grow much faster. Yesterday we heard Mr. Kotak talking about a growth of 6 to 8% in the next 25 years. And he talked about the capacity. We have to dream to be big. We have to become big entrepreneurs. The professionals have to grow. We have to take some risks to grow. And I think that's where the capacity building will come in, and that is where the members have to play their own part. Some of us have to come out of the thinking of, growing a firm and say, getting away, as an example, a name. Just to give an example, say if it is Mr. Agarwal and me as partners and we get 10 more partners, are we fine with the changing of the name? I've seen some sole proprietors saying, well, we would not change the name ever. Now, I think if you want to grow a firm, you have to grow with a vision of the firm. You have to have a long-term vision. You have to have a short-term vision. You have to create a leadership team. You have to attract talent. The president mentioned about investing in technology. You have to invest in people also. So people and technology are the 2 things which will help you grow. You have to attract talent. You have to have the appraisal processes. You have to have human, HR policies in place. So I think a lot has to be done by the members themselves to grow the firms, where the institute can play only a supportive part in having the right regulations to support that growth. The third element which I would like to touch upon is the ethics part, which again the president mentioned, and that's very close to my heart. I think on integrity and ethics, these are non-negotiable. I think all of us would agree to that. If I look at a person who's intelligent, who's good, who has a knowledge, but lacks on ethics, I think for me, that person should not be in the firm. That is how I would look at it. This is a long-term perspective always. We have a code of ethics which has two volumes. Volume 1, which is principle-based, which is based on what ISBA has done internationally. We have Volume 2, sir, which is based on the Indian Act and the Indian regulations. I think we as an institute have to do a lot in Volume 1 and Volume 2, both to keep ourselves updated. And I'll give you just one example of what ISBA has done in the last 4 years. ISBA actually started with a project on should there be ethical principles when accountants provide tax planning services. And the background of that was you had Panama Papers as a problem, you had some multinationals creating structures to, take the benefits of tax. And the idea was, should there be ethical principles or not? So as we speak, ISBA board in last December has approved 2 changes to the code in a very big way. And it is a very big change which has happened, which as on date is awaiting the approval of the PIOB. A chapter has been added in the members in service as to what their responsibilities will be, only on the ethics, what they're supposed to do, and what a member in the professional practice is supposed to do. So there's a big change. This was a very critical change which happened in the last 4 years, which got culminated last December, which will see the light maybe by April 24, a big change to the code. I believe ethics help you build a firm, and it is this which can break a firm also. Without going into naming a firm, there is a firm overseas which one of the tax partners was advising the government on tax policies. What should be the future tax policies? And unfortunately, that partner started advising the clients also as to how to circumvent those policies. Clearly unethical. To cut the long story short, in that country there was a Senate hearing, and today that country is looking at to have the laws in place to regulate the non-attest function now. What they're saying is that we have regulated the attest function in the last 30, 40, 50 years. Maybe we need to regulate the non-attest function now. So I think the point I'm trying to make is that one needs to be updated regularly. We need to be market relevant. You see, we want our accountants to go out and compete. When the multinationals come to India, they look at us to say how ethically, how professionally you are there. So I think ethics also plays a very important part in growing a firm, which is then more an intangible thing, which may not be easily seen. And these are all long-term things to be looked at. We talk about Big Four, and just give you an example of Deloitte for a minute, which is public information. There was a firm called Haskin & Sells, which was there in some 1875 or 1885. There was Deloitte & Company, which was there in 1900, some 60 or 70s. Those firms merged, became Deloitte Haskin & Sells, which is DTT today. So they take a long-term perspective which we have to see in growing the firm. So the firms in India, ma'am, can grow. It is just that we have to go the right way. There is no right way of doing a wrong thing. That is where the ethics plays a very important part. And I think with the due support from the government, which is there always, proper guidance from the institute and the support, our Indian firms can grow and really do a big way. Thank you.
Thank you, Mr. Chaudhary. I think 3 takeaways from your very interesting input. One, SMEs have a role. Thinking of growth all the time, they also have a role and they have a place. The market gives a place to everyone. And yes, if we have to grow and compete internationally, we have to be market relevant and have ethics. Very nice, thank you. I now move on to Mr. Himanshu Kishandwala. He's from CNK, and CNK was formed by the merger of 7 firms over time. So I think he's the right person to have on our panel. So please tell us that going forward, how would you already have done some amount of mergers. First tell us, are you going to grow more? And how are you planning? What do you plan should the other middle-level firms do to grow within this market and give formidable competition? I also want to put 2 things in front of you. There are certain practices that were approved by the government. For example, there was a joint mandatory audits which is done for the PSUs and the banks. Moreover, I think thinking that they are spread over large areas. So do you think these will help in capacity building at least? And number two, the joint audits, which were introduced in 2015. So do you think these will also contribute to our objective of this session today? Please.
Thank you, Smita, and pleasure to be here at NFRA. To start with the first thing, how do these mergers help? I think when you talk about giving an equivalent example of, say, industry, for any industry you need a scale. So even in an auditing profession, you need a scale. If you are just two partners, 20 people, it doesn't work when you're doing audits of public interest entities. So you need a scale. And to get the scale, either you grow organically or inorganically. And that is where I think we have, over the last maybe 25 years, been able to come together with like-minded people. Ethics, of course, is one of the most important things when we select our other firms who would like to integrate and merge with us. And we have seen that does result in a scale, and that does result in able to deliver the same quality which the other bigger firms would be able to do in that sense. And yes, we would be pursuing that further also to grow maybe little more, but of course not at the cost of quality or at the cost of ethics, which would be there in that sense. Coming to the other thing on this joint audits, I think joint audits were always there in the public sector undertaking. CAG always more or less had joint auditors with maybe a 4-year term. Before 3 years, when Reserve Bank of India implemented joint audits in the BFSI sector, I think it has really resulted in a deconcentration of the audits from the larger firms to a lot of smaller firms in that sense. I believe there was a lot of reluctance from the sector to defer that particular policy, but I think the sector also has realized that this deconcentration has really helped all of them, and it has certainly helped in the growth of the smaller firms in that sense. However, a word of caution there are instances where though joint audits are mandated by the regulators, sometimes the management and the audit committees do not agree to a joint or equal responsibility and equal remuneration. So you cannot have a situation where there are joint auditors, but one firm does 75% of the work and also takes 75% of the fees. A joint audit means equal responsibility and equal remuneration. So I think that is something the regulators will need to enforce. Otherwise, these joint audits may not make sense in the near future in that sense. And there are a lot of instances which I can personally tell the regulators where such things are prevalent in the various sectors which are there as such. Coming to that rotation thing, I think on the rotation part, rotation has been very helpful. And rotation, of course, also comes with its set of challenges. The periods of rotation are different. The Companies Act gives 5 years plus 5 years. When you go to the BFSI sector, it is just 3 years with a cooling off of another 6 years. If you go to the public sector enterprises, it's 4 years with again a cooling off of another maybe 4 years or something. I think this can be integrated to a period of maybe 4 years, because 3 years is too short a period. If 5 years is considered a large period, maybe it can be integrated as a 4-year period. And it helps the audit firms, especially the smaller firms, because you develop expertise in a particular sector, in a particular company, and suddenly after 3 years you are out of that particular entity which is there. So I think that period can be rationalized. You can have all checks and balances which are there, but that period can be rationalized for rotation of audit firms in that sense. Talking again about this joint audits, I think the ministry can look into joint audits across all public interest entities, not necessarily public sector entities, but across all public sector entities, as was also prevalent in some of the larger or some of the other countries which is there. So maybe all companies beyond a particular size, it can be mandated that they should have a joint audit with all sorts of checks and balances which are there in the BFSI sector in that sense. Now that, I believe, is one of a very important step to get the smaller firms also to get to that quality, get to that experience or something in that sense. Yesterday we had a very interesting talk on using automation in the audit field. I think and a lot of us were actually doubted that will we be able to invest that much to get to that level of automation. Personally, I think that's not a big challenge because it's not a question of you spending that much on automation. I'm sure the regulators, the institute, and even some voluntary organizations like the Bombay Chartered Accountants Society can help their members to develop tools to get to that automation levels in that sense. Because automation is something which we will have to move forward, but automation, as also discussed yesterday, is not going to replace the judgment of individuals which is there. And whether it's a bigger firm or a smaller firm, judgment plays a similar role. And as again mentioned by Sanjeev, in the bigger firms also, the same people are there. Maybe today you are in a smaller firm, tomorrow you are in a bigger firm. So I think it's the same mindset which is there in both the cases. And finally, I think if you want to get to that scale, you will have to come up to that level and invest in the firm, in the growth of the firm, in training, quality, maybe come together for this automation or using this artificial intelligence tools in the audit profession in that sense.
Thank you. I think you put it very well. Scale matters. Mergers are the way forward, but not at the cost of quality. Rotation, yes, but in maybe 4 years, we need to change the years. And joint audits probably for all PIEs, that would actually grow the market and have more people work on the PIEs. I now move to Mr. Vikas Kumar. Mr. Vikas Kumar, you are the CEO of the oldest firm. His firm was incorporated in 1949. They are registered with the PCAOB. So you all have seen the profession all these years. You've seen the economic landscape in our country changing. So why is it that we are not able to get these big 4 firms? Why has it not happened? In your opinion, since your firm has had such a long presence, what in your views is the reason for it not happening? And also, could you please comment whether mergers and amalgamations is the way forward, and your ideas generally on the subject?
Thank you so much, ma'am. First of all, gratitude from my side and my firm to NFRA for having this much-needed conference. And thank you for inviting me as a panelist. Thank you so much, sir. And I'm sure this whole conference is of a lot of benefit to each and every one which is attending it. Smita ji was saying initially also that our Honorable Prime Minister has also talked about the need of having large Indian CF firms which can compete internationally and which can show their mark internationally. And it is not that only our Prime Minister, in fact, it is so heartening to see that everyone who is here, whether it is from ministry, whether it is from NFRA, or whether it is from investors, everybody is looking forward that how come Indian CA firms grow further? How come homegrown firms can show their mark internationally? So this is very heartening, and this is very, very reassuring to all people like us that everybody is looking forward to. And naturally, once everybody is looking, it also brings a lot of onus on us that what we are doing or how do we really go about it to see that we come up to the expectations. And to be very frank, this is the time. In fact, everybody is talking, this is the Amrit Kal. So if not now, then when? I think we are at the right time. We are blessed to be there at a time where the country is growing, capital market is growing, and you have all the opportunities at your hand to work on it and see to it that we reach to that level. Having said that, we'll have to first introspect that what is not working and what really is not going in your favor and what you really need to do to reach to where you need to. When you compare with Big Four, as ma'am was saying that Big Four is very big, let us be very clear on some of the factual status first. Number one is on their size. The size is significantly larger than what we are. Whether it is in terms of number of people, number of offices, presence all over the world, the size is totally different as compared to what we are. And it's not easy to catch up because with this size comes a lot of many other benefits which it may be difficult for us to really match, which could be in terms of either technology or investing or having a research. All that is easy and much possible when you have that size. But when you do not have that size, it is not that easy. So that brings a big challenge for all homegrown Indian CA firms. Second, which I would like to touch upon here is the branding. So of course, they have worked for it and they have gained that brand. But from our perspective, and I see from the perspective of Indian CA firms, the only question which comes to my mind is whether we are having the level playing field. The name of Big Four comes in many other way, which goes to their brand, and they are able to do that, and that helps them to get the new business. But whether we are able to develop that brand and whether people can have that recall of our name to see that we get those benefits, how can regulation help us to see that we have the level playing field when we are talking about the brand is another thing which comes to my mind when we look upon. Another aspect from regulation perspective itself, if you really see that in India at present, each and every chartered accountant firm, as our President sir was also saying that there's almost a lack of CA firms, either as a proprietor or as a partnership firm, which is doing the audit. And all of them have got equal opportunity of doing any work, which is good in a way, but when you see it from the perspective of public interest entities, it definitely creates a challenge that it is not only the individual and the capability of the individual, it also is whether there is a capability overall for that firm to conduct that type of audits. So I think that also brings a lot of importance, that it's not only individual, it's the organization, whether that organization is having that size and capability to do those works. That is also something which I believe regulators and the government must look upon. Because just see from the perspective of the auditee, there are two sets of auditees. One, which are inclined towards Big Four, whether it is MNCs, whether it is people where there are foreign investments, or whether people are looking for a brand. So there are a set of people who prefer Big Four. But there is equally a large set of people who are okay with non-Big Four as well. When the good set of people who are looking for Big Four, you will find there are only 4 firms which they are looking upon. But when the other set of people, or the other set of auditee, which when they are looking for non-Big Four, there are, I am talking of from PI perspective right now, they have a good number of, large number of people to whom they can bank upon. That results into the fact that few firms, I'm not saying 1 to 5, I'm looking for maybe 50, 100, 150 CA firms, large CA firms from India. They are not able to get that size. They are not able to get that overall concentration for them to grow larger. So that becomes a constraint, because one side you see there are 4 firms which are competing, other side you see 1 lakh people who are competing to get that business. So that brings the imbalance. So that if that is being taken care of, I'm sure that can definitely help to ensure that there are certain Indian firms, or good number of Indian firms which can grow faster. That is one perspective which I have. Having said that, it is also important that we, the Indian CF firms, also introspect and see that where we need to work upon. Definitely the Indians are considered to be very hard-working and very intelligent, and there is no reason, if we cover the other part as well and work on it, that we cannot grow internationally or we cannot leave the mark internationally, not as an individual only, but as an organization as well. When I think of it, sir and ma'am, I would like to put those in 4 buckets. First, think big. Second, cover basics. Third, embrace technology. And 4th, improve governance. So I would like to put these 4 aspects for Indian CA firms to look upon. As I said, first, think big. Unless and until we start thinking, we believe, unless until we start believing that yes, we can grow, we can do this, we cannot embark on that journey. The moment we start thinking, yes, this is something which I want to achieve and I would like to work upon it, then only the journey will start. So how do we really become big? There could be many, many things, many aspects which you can look upon. Like first, as being talked about, that bouquet of services. Dhariwal sir was saying that Big Four has got a lot of bouquet of services which they can offer. Why we cannot offer the entire bouquet of services which our clients are looking upon? Of course, not in a conflict zone, that's a separate issue. But otherwise, if somebody is looking for advisory, why can't I do that? And for that to happen, we will need to have that talent with us. One person cannot do it. You need to have a team. You need to have those experts who can really work upon that. So if we aspire to grow, if we aspire to be a national firm and international firm, naturally we will have to have the entire bouquet of services as well as the team which can really handle all that. And big will not only means big in terms of size. You will have to bring in your quality control measures and all other measures in a big manner to really see that you can really become big. Another aspect, why do we shy away from serving the international clients? It's not because if you want to grow, why we are shying away from serving the international clients? Why we cannot focus upon to see, yes, we can serve many international clients, and I can see there are a good number of Indian CF firms now which are specializing in catering to foreign clienteles. There are people who are catering to Japanese clients primarily. There are firms which are catering to Italian clients specifically, and they specialize in that. So many of us have to work on those directions to see that, yes, we are in a position to do that, and we are in a position to provide those services to our international clients as well, which will help us to grow bigger and faster. Second, as I was saying, cover basics. Having said that, unless and until your basics are covered, you will not be able to grow. We'll have to change our mindset for certain things. If you talk to any Indian CF firm, they will say that we are able to do good quality work. We are doing what is required. But when it comes to documentation, we are lacking. We still do not have those type of documentation with us which is expected by standards or which is expected by regulators. I think this is more on our mindset. It may involve additional cost, additional time and effort, but unless and until we are able to document what we have done, how do we really evidence that we have actually done what all is required to be done? So we will have to really focus on that documentation part and ensure that we fully comply with those standards on training. Another thing on the basis will be on training. Are we ensuring that we have the right training culture in the firm? There are so many changes happening, regulations are changing, laws are changing. Are we keeping ourselves not only at the top management level, but at the down level, for the lowest of the employee, that they get trained and ensure that they are in a position to actually do the same work which is expected even from anybody else in the firm. So that is again another important aspect which need to be covered. Third, as I said, embrace technology. There is no choice for it. I think we have spoken enough in the last 2 days on the importance of technology and what all needs to be done on the technology side. Only relevant thing from my side we can add is that this entails investment. We should not shy away from making these investments, because if we do not do that investment now, we will be left out. We must embark on that journey. If I invest now, and I'm sure we are going to reach benefits in the times to come. So we must work on the technology and keep working on it. And the last thing which I talked about was improve governance. What I mean here is that what is the structure which we have at Indian CF firms? Are we still having like only founders who started, they are controlling the things? What structure you have? Is it only a family which is controlling any firm? Or it is only a founder which is controlling the firm? Or are we having a structure where you bring the corporate culture and ensure that you have the right mechanism, you have right checks and balances, and the incentivization to see that the merit is rewarded, and you are driven, the entire organization is driven to see that we take it to the different level. So that culture, that corporate structure in any CF firm, in my view, is really important at present. Independence was another thing which was talked about. In my view, we should not look as to what is the interpretation of the law. If the regulator is saying this is what is the understanding on the law, let us work on that simple. Let's not spend time to see that what could be the other interpretation. In fact, rather than saying that what we cannot do, in fact, in my view, we should drive with the culture that what is allowed to be done if you are a statutory auditor. Rather than I cannot do these things. I will do only these 2 things, 3 things, 4 things, which is defined, and I will not do any other thing. So what I can do, I should define and work accordingly on that. That is what I feel and believe. Another thing on the governance could be, what is my monitoring mechanism? Are we having the right culture, or we are ending with our having EQCR, or we have a monitoring culture where we are monitoring and seeing that the things are going upon. So there could be many things. At the last, I can only say that ultimately it has to make a business sense for all of us. And I'm sure when everybody is looking upon and we are getting all this sort of support, it will make business sense for us to continue to grow and do better. And one more thing, last thing, which ma'am was saying, that whether we see that it is an organic growth or inorganic growth, in my view, we'll have to work with both. There is no only one-way mechanism that only by inorganic way you can grow or only by organic way you have to grow. TRC has at least grown in last 77 years on its own, and we could reach to a good level. But if we have to compete internationally, it is important that we look upon good, like-minded people where we can collaborate and we can grow further. The choice there is on two parts. Is control important or is growth important? I think the biggest worry which comes to the mind is that if I collaborate with others or merge with others, what control we are going to have. So we'll have to sacrifice something somewhere if we want to grow and if you want to become international and to be known everywhere. So we will have to have a mix and then continue to grow, whether organically or inorganically, ma'am. That's the sort and sum of what I think.
Thank you, Mr. Vikas Kumar. I think that was a very, very detailed exposition. And Mr. Ranjit, you want to say
just one line I would like to add. Mr. Vikas was telling businesses, that's fine. But in my opinion, as an institute, what we think that there is a difference between business and the profession. Business for the business and business for the profession, there are two different yardsticks. And that's why we have a code of ethics and we have a guideline. So growth of the profession and the growth of the business, there are two different yardsticks. And the profession has to look into that aspect that we are in the profession and we have to cater to the stakeholder with the code of ethics, and we have the various parameters on which we have to deliver. If you remember, in our code of ethics in 1964 when we started, in then president of the institute has said in that opening line that even if something is legal, the professional has to see whether it is ethical or not. Maybe something may be legal, but it is ethical or not, that consciousness has to be inbuilt between the professional, and only they can deliver, because there is a huge onerous task on the professional, because the money of the stakeholder is in the business and we have to certify. And we are the only professional in this country which has the mandate to certify what is true and what is not true. So if such a huge mandate has been given to the chartered accountant by the parliament, by the government, we have to see we are in the profession, not in the business. Thank you.
Thank you so much to all our panelists. I hate closing the session without any questions, but do we have time for one question, since the chairman has already gone down to receive Justice Lalit? I think. Yeah, so give them 1 minute, one question maybe. It eats into your lunch, but please, I heard. Just one or two questions.
My name is Harinderjeet Singh. I am a retired partner of Pricewaterhouse, and I was also Central Council member and chairman of AASB. That's my brief background. So my question is to Himanshu. I need some clarification on what you said. Are you saying that joint audits is a mean for capacity building and the quality will come along? Is that what you're trying to say? Number one. Number two, do you see this from a point of view of stakeholders or just the market, increasing the market for the auditors? And last point, I want to remind everybody in this room, internationally, there is no audit standard. We follow IFAC. ISAs have not yet come out with a standard on joint auditors. Our standard, SA 299, is a homegrown standard. Thank you.
Right, so to just answer Harinderjeet Singh, having joint audits is not something which is required because auditors or the smaller firms need that audits in that sense. It does give them a larger opportunity, and if the regulation wants joint audits, it's also a check and balance, because if you have a single auditor over 5 years, 10 years, a joint auditor can be a check and balance because the areas of verification would be interchanged every few years. There is a standard in place in India at least, SA 299, which is a very robust standard, and the standard also says that if the two auditors have different views, they can go ahead and give two separate reports in that sense. And I do know of 1 or 2 countries in Europe who does mandate joint audits for their public interest entities in that sense. And I believe more than anything else, the experience over the last several years of CAG and the BFSI sector, and if you interact with the companies themselves or the BFSI sector themselves, I believe they are also saying that joint audits does add value to them because it does give different perspectives over the period of the audit in that sense. So I would still stick to that stand that yes, joint audit is an important thing to have in the system.
Thank you very much. I am Vijay Kapoor. I am from academics. I must congratulate Vikas for a brilliant talk. It touched my heart. You really said what it actually means and what is required. First and foremost, I wish to say, Big Four is a misnomer in this country. At least celebrate the fact there are Big Six in this country. BDO making to 4,000 crores in last 6 years of its existence. Let's celebrate that fact. Why do we actually coveted this term Big Four? There are at least Big Six. And if I tell you correctly, there are Big 10 in this country. But as Vikas said, they are promoter driven. They are not coming out of their shell. So regulator has to think about it. The second thing which I wish to state, in the BFSI, Hamendra Hazari wrote 6 private sector banks in 2021. None of the 6 private sector banks is audited by any Big Four. Let's correct our facts, number one. Second, I think there is a need for removal of artificial restrictions, bringing accounting reforms, which has not happened since 1991, restrictions like joint audits, restrictions like number of tax audits. With the introduction of UDIN, I always thought that all these restrictions will go away, but nothing happened. We talk of level playing field. There is a lack of transparency. Some of the members do write openly that there are no global networking guidelines since last 3 years. There is no data available on the ICAI website in respect of firms which have got the global networking thing. I think there is a lack of transparency somewhere. Coming to Vikas, investment. I compared this analogy with our cricket reforms. Look what happened to cricket reforms. MRF Pace Academy in mid-70s, Dennis Lilly coming to India, followed by IPL, and where do we stand in the cricket today? Can we think of these reforms in our country? Please think over it. I think another thing which he made was the growth versus promoter. My request to NFRA is, why did they push ATR under the carpet since last 1 year? Thank you.
Thank you very much indeed, ladies and gentlemen. Let's put our hands together for all our eminent panelists. We had a wonderful session, and I would now like to invite on stage Mr. Kulkarni, Senior Consultant, NFRA, to kindly do the honors of presenting the mementos. We present to our distinguished dignitary, Mr. IDS Dhariwal, Joint Secretary, Government of India. Thank you, sir, for sparing your valuable time and being here with us. We present to Mr. Ranjit Kumar Agarwal. We present to Mr. Sanjeev Chaudhary. Present to Mr. Himanshu Kishnadwala. To Himanshu, sir. We present to Mr. Vikas Kumar, Managing Partner, T.R. Chadda and Company. And to our session chair, Ms. Smita Jingran. For all that hard work of moderating such an eminent panel. Thank you, Mr. Kulkarni. Could you kindly join the panel for a group photograph? And ladies and gentlemen, after that group photograph, we invite all of you to join us for lunch, once again served on the level below. And we have a very important session post-lunch, which will be graced by Honorable Justice Lalit, who would be, in fact, he's, I think, already joined us. He's here at the venue. And we would request everyone to be seated by 14:10 hours. Once again, requesting everyone to be back from lunch by 2:10. Thank you. Good afternoon, ladies and gentlemen. Requesting everyone to kindly join us back inside the hall and occupy your seats as soon as possible. Ladies and gentlemen, in the upcoming session, we have address by the Honorable Justice Lalit, the former Chief Justice of India. We would request everybody to kindly take your seats and be seated as soon as possible. Ladies and gentlemen, once again requesting everybody to be seated inside the hall for the next keynote session, which will be graced by the Honorable Justice U. Lalit, former Chief Justice of India. Good afternoon, ladies and gentlemen. Kindly requesting everyone to be seated. Good afternoon, ladies and gentlemen. Once again requesting everybody to kindly be seated inside the hall as soon as possible. We are expecting the Honorable Justice Lalitji any moment now. And also we have a small announcement before we move ahead with the proceedings. The Honorable Minister, who was joining us for the validatory session, has now requested to prepone the validatory session. So we will not be having the tea coffee break in between and have continuous sessions and then have high tea at the end of the closing of the conference. And we will be really grateful for your cooperation in this regard. Thank you. Ladies and gentlemen, once again requesting everyone to join us inside the hall and be seated as soon as possible. We're expecting eminent guest, Honorable Justice U. Lalit, former Chief Justice of India, any moment now.
Okay, sir. Next session में
Ladies and gentlemen, requesting everyone to kindly be seated. Honorable Justice Lalit would be joining us any moment now. तभी सोच रही थी क्या हो गया आवाज में। And ladies and gentlemen, please welcome Honorable Justice U.U. Lalit, former Chief Justice of India. As I invite you, sir, to kindly grace the days with your august presence. Also joining the Honorable Justice is Dr. Ajay Bhushan Prasad Pandey, Honorable Chairperson, NFRA. And I also invite Mr. Arghya Sen Gupta, Founder and Research Director, Vidhi. Namaskar and good afternoon. A guest of honor, Honorable Justice U.U. Lalit, former Chief Justice of India. Eminent dignitaries, ladies and gentlemen, a very warm welcome to this special session. We are honored to have with us today Honorable Justice U.U. Lalit, former Chief Justice of India. Honorable Justice was appointed as Judge of Supreme Court of India in August 2014 and was elevated as Chief Justice of India in August 2022. Honorable Justice Lalit enrolled as an advocate in 1983 and practiced in High Court till 1985 and was also as a special public prosecutor appointed by the Supreme Court of India in the matters involving high public interest. Honorable Justice is currently Distinguished Visiting Professor at the Shank Desai Center for Policy Studies, IIT Bombay, and Distinguished Visiting Professor at West Bengal National University of Juridical Sciences. And ladies and gentlemen, I would now request Dr. Ajay Bhushan Prasad Pandey, Honorable Chairperson, NFRA, to kindly do the honors of welcoming Honorable Justice U.U. Lalit, former Chief Justice of India, with a traditionally Madhubani stole. A very warm welcome to you, sir. I would now request Mr. Arghya Sen Gupta to kindly welcome the honorable guest with a green initiative, a green plant. Thank you, sir, for doing the honors. Ladies and gentlemen, Mr. Arghya Sen Gupta is the founder and research director at Vidhi. His areas of specialization are constitution law and regulation of the digital economy. He has served on a number of government committees, including the B.N. Sri Krishna-led Committee of Experts on Data Protection Framework for India. Sir has a number of academic publications on the Supreme Court and the Constitution in leading law journals such as Law Quarterly Review and Public Law. He is also columnist at the Telegraph and the Times of India. Has recently authored a book, Independence and Accountability of the Indian Higher Judiciary, Cambridge 2019, which builds on his doctoral work at Oxford University. And prior to founding Vidhi, he was at Oxford as a lecturer in administrative law at Pembroke College. So ladies and gentlemen, please put your hands together as I invite Mr. Arghya Sen Gupta for the words of introduction and opening remarks.
Good afternoon, everybody. Thank you very much first to Dr. Pandey and the members of NFRA for inviting me today to moderate this session. It's a real honor to be amongst you all, particularly with Justice Lalit in the chair. Now, without any further ado, today in this session, we are going to be discussing issues of corporate governance and how it can safeguard public interest. Now, over the last 2 days in this conference, we've had several invigorating sessions on both financial reporting and the importance of financial reporting and audit standards. And these are really the twin pillars for ensuring that corporate governance standards work in the interests of shareholders. And that's ultimately what we are talking about. And I was recently looking at the report given by the Committee on Corporate Governance, headed by Mr. Uday Kotak, which said that corporate governance standards are meant, and I quote, for the nameless and faceless investor, unquote. And And I got a sense when I was reading that NFRA as an institution exists to ensure that the nameless and faceless investor is not voiceless. So essentially, the corporate governance standards that it tries to ensure through financial reporting as well as maintenance of audit standards is in the interest of the shareholder, and that's what it tries to do. And this conference has been organized by the NFRA, but it's not only about the NFRA, it is about what the NFRA is established for, and that is public interest. And we're doing this at a time, historically, the interface between corporate governance and public interest has been well documented. We know of the scandals like Enron and Satyam in this country. And recently, the Australian Senate Inquiry Committee has also gone in to the auditing practices of large global corporations which are in Australia. So this has been a historic issue and is a live issue as to how corporate governance can ensure public interest. And we have no better person to talk to us on this than Justice U.U. Lalit. He's already been introduced, but I can't resist adding one little nugget. I recently came across a judgment that Justice Lalit delivered in the Supreme Court in the Serious Frauds Investigative Office versus Rahul Modi. He may or may not remember the case because he's given so many judgments in court. But that was a case where essentially the judgment of the Supreme Court upheld the powers of the SFIO to ensure the investigation into some alleged economic offenses and overruled some hyper-technical objections that had been placed on the jurisdiction of the body. So in essence, what that judgment did was upheld the public interests in corporate governance over the private interests of promoters to deal with their companies as they pleased. And so he, of course, after giving the promoters a fair and patient hearing. Well, now it's our turn to give a patient hearing and to Justice Lalit, and of course we are really looking forward to it. So without any further ado, it is my privilege and honor to request Justice Lalit to present his keynote address. Sir.
Dr. Pandey, Mr. Arghya Sen Gupta, all the distinguished persons who are present in the gathering today, some of the resource persons who have also addressed the gathering, and all the delegates who have come here to attend this conference. At the outset, I must congratulate the organizers for organizing such a conference with such a thoughtful idea. We, as lawyers and judges, see the matters only when the final curtains on a controversy are drawn and the matters come before us for adjudication. We don't have or hardly have any role at a stage where the matters are still in the area of gray or are still unfolding. So therefore, our perceptions naturally are arising from decided cases or cases that we had the fortune to deal with. If I may just start my address by giving you 4 or 5 such cases, which may, from the perspective of what is that nameless, faceless, but not a voiceless commodity. So how would a common man perceive of a situation where there is either a dichotomy between the corporate governance and the public interest? I'll give 1 or 2 cases, or rather maybe slightly more. The first of these lots is, of course, the Life Insurance Corporation versus Escorts. That was a case decided by 5 judges of the Supreme Court, Justice Chinnappa Reddy presiding. And in an internal matter where the financial institutions were holding 52% shares in a corporate entity, the Life Insurance Corporation had sent a notice seeking to terminate the appointment of 9 part-time directors and seeking to appoint 9 fresh faces in their places. Now, that particular company was certainly a company which was founded, nurtured, nourished by a private business house. But at the same time, the financial institutions had 52% stake in the shareholding. So it was one of the majority shareholders. Now, that action was challenged. And the judgment of the Supreme Court says that yes, LIC was definitely entitled to do that. Why? Because public institutions, which are the financial lending corporations, they certainly have a say in the matter, and therefore public interest demands that we must allow Life Insurance Corporation to have a complete say in the matter. That gives you one idea as to what shall be the regime of corporate governance. Very well, it must be going purely by the will of the majority when it comes to internal organization where the shareholders or the members of the company have a say. So this was one. The second case, Bhopal gas disaster. It was a corporate entity which was, the parent company was a US company, and the Indian company was manufacturing, among others, what is called MIC, which is a poisonous gas. And on a fateful night, the gas which was stored in the chambers in the factory premises escaped, as a result of which more than 7,000 persons lost their lives, and few thousand people got permanently disabled with some infection or the other. The matter was fought. It was also fought in the US courts on behalf of the citizens by the Union of India. And finally, when the matter reached here, a settlement was brought about which ensured that US dollars 570 million would be paid to the victims of that particular gas disaster. Now, mind you, the facts actually showed that this particular chamber of gas, which was having MIC, contents of which were definitely poisonous, was sitting there in those chambers for last almost a year or so, without there being any reason, without there being any kind of production activity which was undertaken in respect of that particular gas. So it was an idle commodity which was still lying stored. Now that raises another set of corporate governance. How do you deal with your own manufacturing processes or the production processes? In what manner? Would you then allow such a situation to happen? Would you then permit such a situation to develop where a poisonous gas, without there being any necessity with respect to manufacturing process, which was not even undertaken for last a year or so, was still lying there idle? Would it not be part of the regime of the production mechanism that you try to minimize any such chances of escape of such gas. So therefore, corporate governance, when it comes to internal, your manufacturing processes, is also something which is part of various regulatory enactments like Factories Act and various other statutes. So therefore, another set. And look at the deleterious effect that the escape of gas had. It left a permanent mark on thousands of people so far as their lives are concerned. Very well, so therefore this was one. What is the fallout so far as the management is concerned? There were certain, naturally, the whole-time directors, the working directors, but there were also directors who were simply associated because they were the friends of the persons in the management. What you can say, merely there as directors. One such person was Keshav Mahindra, who was the chairman and managing director of Mahindra and Mahindra, which is manufacturing vehicles in this country. And he was sought to be prosecuted, and he came up to the Supreme Court. And at his instance, in his petition, the Supreme Court ruled that the liability of these directors can definitely not be of an offense which comes very close to what is called culpable homicide. And that's a diametrically opposite kind of a judgment, in spite of the fact that there was such a calamity. And that judgment came to be relied upon by the whole-time directors and those who were in charge of the factory premises to say, look at that. What is the liability? And we are still struggling with that. So that gives you the other dimension of the picture, that what is supposed to be the liability of those who are in charge of the management when it comes to situations or torts such as that. Very well. So I gave you two perspectives, two cases. Now the third one, which is what happened is there was one company called a textile undertaking which was supposed to be wound up. And naturally, in winding up proceedings, the stakeholders who are normally heard in the matter are the creditors, the employees, or certain persons who are the stakeholders or the management side people. But under the statute, the employees or the workmen of that factory were never given a statutory status to be part of the proceedings for winding up. That is to stake a claim or to say that we should also be heard in the matter. A judgment of the Supreme Court in NTC versus Ramakrishnan says that even the employees have a standing in such matters. They definitely have locus standi to present their view. Very well. So therefore, the third facet of the matter, that when it comes to winding up the organizational entity, apart from those who are to deal with finances or who are the creditors or the financial lenders, even the workers also have a locus standi to present their views in the matter. Now look at the dimensions. So therefore, according to the Supreme Court, workers can't be nameless and faceless. They must have a voice in the matter. So we now turn to the fourth case. What happened in There's one iron ore mining company called Kudremukh Iron Ore, which was given license to mine iron ore in the coastal part of Karnataka, one of the states in this country. It had all the permissions. There's nothing wrong with the way the mining was being done. The only thing is that out of the area which was under its license, about 6 hectares of land was falling in national park, which was declared or assigned as a national park. Under the relevant statute, which is Wildlife Protection Act, in a national park, you can't do any mining activity. Now, this was a public sector undertaking, so it was not essentially what is called driven by private motive. So it was for the common good. Yet the Supreme Court said, sorry, you can't have these kind of mining operations in an area which is designated as national park, so you must stop your operations. For what? For the safety and the lives of those animals who are supposed to be having a safe haven there in the national park, to preserve the biodiversity which is part of that national park, so that at any future juncture this mankind can certainly rely on the gene pool which is available in Kudremukh. So therefore the mining operations were stopped. Now what was that compelling factor? Nothing wrong so far as internal organization was concerned. Nothing wrong so far as permissions were concerned. Yet the deleterious effect that it could cause in the other sphere of activity, that the Supreme Court said, sorry, we will not permit that. So therefore we have now 3 or 4 different kinds of corporate governances when they come or they clash with what is called public interest, or their posture, or at least the idea or the drift of that is certainly not consistent with elements of public interest. And what has been given precedence? It is the element of public interest which has been given primacy or precedence over what you may call the corporate setup or the entity setup or the corporate governance. Very well. Here are the cases where, except for that solitary wrong which happened in that MIC matter, these are all what is called bona fide kind of situations. Now let's turn to something which is completely fraudulent idea. So there have been such cases like, say, Satyam, which was referred to by Ardhya, where the directors tried to fudge the reporting, the accounts, tried to inflate the figures of profit so that the share price of that particular company starts climbing up on the share market. This is one. There are cases where Sarada and other deposit accepting companies which were operating in the eastern part of the country, which had accepted deposits from these kind of nameless, faceless investors who had given their life savings and they had completely evaporated. There was one case which was Sikkim Bank, which was given the license at 1 or 2 places, but it started expanding without there being permission. The bank went fut. All the monies of the investors were lost. These are all cases where there has been a fraudulent intent on part of the persons who were in the sphere of management. Similarly, last 2 cases, IL and FS. Again, that's something which perhaps I think I may give that credit to the company and say that perhaps their idea is that there was a mismatch between the assets and liabilities. But the result was 9,900 crores worth of debts. So therefore, we have such examples where there has been a definite fraudulent intent which gets exhibited from the management or on part of the management. So therefore, we have now covered almost these kind of cases. You know, there is a very famous saying by Warren Buffett. He is one of those whose essays are actually relied upon in many of the US universities and many other universities as some kind of a test case to say that this is how one must succeed in life in the management. And he said that Berkshire, which is the umbrella company which is under his control and which runs almost like 500 other corporations, he says that I select my chief executive officers and give them a command, which is to say, number A, you shall treat this company as your private property, so that there is an incentive, there is an attachment. You shall. What you will do is, you will only think that this is the only asset that I have. There is no other asset that you are to play with. There is no other asset that you can work with. And third principle, that you can't change the nature of this asset. You can't liquidate the asset. So you are stuck with that asset and you have to deal with it as if it is your private property. And then he says that it brings the best out of the management. Because there is no escape. There is no way that he can change the asset. There is no way that he can change the sphere of activity or change the line of activity. So therefore, this is how it must be. Unfortunately, what happens is that in this country, at times, we consider only the first principle, that we treat it as our private property. But don't go by the principle of trusteeship, which is the inherent idea or the ingredient, which is the part of the second and third principle, that you will not be allowed to change the character, you will stay in the same line, you will not have any other asset. So what does that mean? It means that whenever you have to have an internal structure, that internal structure must be such which brings out the best in that person. Best in that person in whatever walk of life he or she is associated with that corporate entity. Whether it is in the manufacturing process, whether it is in the finance line, whether it is in the advertisement, whatever it be. You must treat the entire asset or property at your disposal as if you are trustee of that property. If that's the idea with which the management looks at the issues, looks at the ideas, looks at every single property under their control or under their disposal, then it will definitely lead to a situation where the best comes out of it. See, if those persons who were in charge of that gas chamber had thought of that there can be an escape of gas, let me get rid of this gas if it is not required for manufacturing process, that would have avoided so much of disaster. That's why people say, there's a very beautiful saying that, you know, whatever you have lost by an ounce, you can't regain it by a pound, or stitch in time saves 9. So therefore, everything which is done at the appropriate and opportune time will certainly save the disaster which is lying in future. So therefore, this is one part. Now we know, all of you know, corporate governance means what? Corporate governance may have two facets. Number one, internal. That is to say, when it comes to internal organizational structure itself. There may be various stakeholders. There may be shareholders, there may be members, there may be creditors, there may be employees, there may be directors, the persons in management. These are all cogs in the wheel. These cogs in the wheel must actually function so smoothly that it finally results in that wheel performing its objective. So therefore, internal working must be smooth, internal working must be effortless, that is to say without any obstacles. It goes without saying. So whatever are the regulatory mechanisms or regimes which are prescribed, say by instance by SEBI, so that there is no insider trading, so that management people don't seek advantage out of their own wrongs. These are all designed to achieve one single purpose, that the wheel keeps on moving smoothly. There are no obstacles at any juncture. So therefore, one part is internal mechanism. The other part is what is called external ideas. And in that external ideas comes some of these pointers that, as I gave you the example of Kudremukh, whatever was the internal function of that organization was absolutely perfect, nothing wrong in that. But it wasn't consistent with the element of public interest that the national park you associate with that. And that is precisely why the company had to stop its operations. So there are elements such as these external elements. And that is precisely why the definition of director under the Companies Act, it includes all these internal ideas, and at the same time says what is good for the communities and what is good for the environment. These are the outside factors which the directors must look into, must take into account. So therefore, for every good corporate governance, you must put the house in order. The moment you put your house in order, the moment every regulatory regime idea is implemented, you will always subserve the public interest, just as that MIC gas chamber could have served. So therefore, every fastidious, or if I may say, that every very strict adherence to his regulatory mechanism, whatever has been put in place. I was once told by somebody that there are 7,900 regulatory regimes or ideas which every factory has to follow. I don't know the truth behind that, but even if it is, it has been put in place with certain ideas, certain intent, certain object in mind, and therefore everything must be satisfied. When it comes to your manufacturing process, when it comes to your internal organization, including sharing the what is called disclosures by the directors, giving the insider trading kind of information, all of it, when it comes to financial health of that organization, must be strictly adhered to. The second and third element, which are the external elements, which are in the nature of what you say the demands of environment and the demands of the community. The demands of the community and demands of environment are also equally important facets. If all of it is taken as part of your corporate governance, then that kind of corporate governance will never be going inconsistent with what is called public interest. So therefore, in my humble view, if all the regulatory regimes which have been put in place, going by the experience that the regulators had in that particular sphere or walk of life, if all of it, including whatever are the mandates so far as the directors or the persons in management are concerned, if they are followed strictly, including the issues of environment and community interest, then certainly we will have public interest which will get subserved. In today's world, every corporate entity has to give what is called corporate social responsibility. And some of the funds are also sort of expended on that. That's also one way of doing community service. So therefore, by statute, you are obliged to make some contributions for what is called CSR donations and CSR contributions. This is exactly what, to my mind, if corporate governance is the ideal, just as what Ramraj should be, then public interest will be subserved at every juncture. Thank you so much.
Thank you very much, Justice Lalit, for that really insightful talk, because we tend to usually see the internal facets of corporate governance much more in terms of regulations that regulate activities of directors, related party transactions, and so on. This is how typically we tend to see corporate governance, but this other facet of the external aspect being woven into this conceptual framework was extremely insightful. So it's not just about keeping our house in order, which we in India usually tend to do, but also keeping the road right outside the house also in order and litter free, and ensure that we are in an environment where which is also one where we would like to live in. So I think it's really been a kind of comprehensive perspective through 4 judgments of the Supreme Court and his own personal views, and there is a lot to unpack. Justice Lalit has kindly consented to take questions from the audience on this and other issues relating to corporate governance and public interest. There should be a mic somewhere reaching you. So if you do have a question, please do raise your hands and introduce yourself, and keep your questions short, because we have about 10 minutes or so. While you're thinking about your question, maybe I'll lead with one question which I thought of when you were speaking. And I wanted you to elaborate a little bit more on this external aspect, particularly in terms of the corporate social responsibility rules that have been brought in now as a statutory mandate. The idea was, in some sense, it goes back to Gandhiji's idea, which you mentioned, of trusteeship, that there is a role as a trustee that corporates have to play. And so there are 2 views on whether it should be a statutory mandate or not, and that it should be done in a voluntary way, as was always as a matter of duty and not so much as a matter of law or compliance. So how do you see a statutory mandate of corporate social responsibility? One, and related question is that there is a big movement towards ESG compliance that has been happening lately, which can also fit into your framework very nicely of external facets of corporate governance. And how do you see the development of ESG? Again, should that be seen as a statutory matter, or do you think that's something that companies ought to do as a matter of good practice?
See, CSR, I'll just tell you, I had been to Vancouver, and Vancouver has a very peculiar development rule. Any property which is developed there, 1% of the expenditure has to be earmarked for what is called beautification of the property. So therefore, they go by this idea that, very well, in front of your property, whether it is an office complex or not, you must develop a fountain, do whatever you wish to do. 1% must go to so far as beautification of the property, because that's how you have the entire city developed as one of the beautiful cities. There was a survey which said that people were asked whether a person living in a particular city loves his city or not. And the highest number of votes were in favor of Vancouver. So the inhabitants of Vancouver love their city. How does it happen? With a regulation such as that. Correct? So therefore, now come back to our present example of CSR. CSR, of course, yes. There is an element of compulsion. I quite see that. As a result, to get over that element of compulsion, there have been round-tripping also done by some of the companies. They try to just fudge the accounts and say that we have expended for something, but the money comes back to the persons in management. But these are infractions, these are some of the dark sheep in the flock. But we have to go by the idea. I happen to be part of the jury which selected certain corporate entities and gave them awards for their CSR contributions. I would say that one of the largest corporations of this country gave something like more than 750 crores by way of CSR, which could be the budget of many midterm or small scale undertakings. So therefore, that's the kind of money which goes back into the society. The money which goes back into the society, that's where you, whatever you owe by way of your moral obligations, because it is the members of that society which have allowed you to prosper as a commercial entity. So it's how you give it back to the members of the society. So therefore, it's that CSR obligation. Same thing by some kind of, different language would apply to ESG as well, correct? Yes. Thank you.
You're open for questions. Yes, there's one right there and then one here. We'll just come to you. Yes, please.
So thank you, sir, for the opportunity. I come from an audit background, so maybe I would start with one question that we always grapple with, our transaction with related parties, right? So we have certain norms from the auditing side or from a Companies Act side, which will deal with the entire mechanism of identification, and dealing with related party transactions. But often what we have also encountered are that we know a certain transaction or a certain party is related, right? If I call it through substance or by gut feel. But it somehow doesn't fit into the entire technical definition. So if you could share some thoughts on how to deal with this ethical or a technical dilemma, right? And how do you balance this from a public interest perspective, which you just highlighted very, very clearly? Thank you, sir.
See, there is one fundamental principle in environment law, which is whenever you are in doubt, are on the side of safety. So tilt your ideas in favor of safety rather than being adventurous. And why do I say so? It is true that, a sprouting idea for the first time may not appear to you to be taking gigantic form in years to come. So therefore, let's test it. Some of these cases like Satyam and others, the Rome was not built in a day. So whatever that fraudulent conduct had actually been going on for a while, and perhaps the concerned auditors either failed to notice that or did not assume the proportion that it may take in future. But nonetheless, what we have for us, the manifestation comes in the problem which is gigantic in proportion. So therefore, if there is any statutory command which says that you should not tilt in favor of what is called related party transactions, or you must flag them, then as auditors you must. Correct? That's the only way that you are actually sort of, that's the function, because an auditor is supposed to be the watchdog for the entire society. So therefore you have to be at times, just trying to smell a rat wherever it is possible. Okay?
Thank you. Gentleman here.
Myself, Manish Iyer, I am a consultant on accounting standards. My question is with respect to the same. For example, Companies Act requires an auditor to give a certificate for schemes of arrangement, that the scheme of arrangement is in accordance with accounting standards. But then the same act provides in Schedule 3 that if there is a deviation, you please disclose. So is it in public interest to have both the things in the same law?
I would say if there are two conflicting ideas, one says that you must, the other says you may not, then as I said, always go in favor of an area which brings you the element of comfort and safety. So therefore you must then disclose. What is it that you are going to achieve by non-disclosure? What are you going to achieve by non-disclosure? Unless there is some kind of a underlying current somewhere else. That by disclosure, you will be then exposing yourself to something. If that undercurrent is there, then naturally it means that the disclosure has to be done. So therefore, to my mind, there are, of course, such situations where perhaps I think there are two conflicting ideas which emerge from two binding nature of sort of obligations which arise from statute. But then in that case, as I said, tilt in favor of element of comfort and disclose everything. Okay?
Any more? There are two or three hands. Maybe we'll just take a couple together and we'll end it.
Sir, I'm Director General from Comptroller and Auditor General of India. Internationally, we are called as SAI India, Supreme Audit Institution. Since we have global audience here, sir, so I thought it will be very pertinent to talk in terms of intergenerational equity. As Honorable Justice just now mentioned, that we have to talk about non-fiscal parameters also. And environment, certainly our environmental concern, issues are of topmost concern for us. Be it in terms of, let's say, water pollution, air pollution, because as we know, by 2050, we are going to, the global temperature is going to rise by 1.5 degrees Celsius. And at least 10% of the coastal areas will be inundated. They will be completely submerged. So when we are talking as a businessman, we don't have to do business only for the day, but we have to continue doing business. If we are not there, if the population is not there, what for is our business? So can we think of some format where we can have a disclosure and it will be non-financial in nature, saying that, let's say if it's a hydro project, we'll say it's a seismic prone zone. It's zone 4, zone 5, like in Uttarakhand. As sir rightly mentioned, that MIC, methyl isocyanide, it is a poisonous gas, it can kill you in seconds. If we could have disclosed that. It may, to some people, it may appear as a sort of redundant note, but believe you me, sometimes this could be most critical and most material statement. So can we have some such kind of disclosure which can be passed on to the government of India, and the concerned ministries can take notice of this, or any other institution, so that we are not seen to be operating in silos. We have to follow integrated approach, and I think that will serve the purpose. The underlying principle is intergenerational equity. Thank you, sir.
Would you like to say something? See, you yourself have answered the question. Correct. When you say intergenerational equity, what does that mean? That I have inherited this earth or my environment from my parents in some form. Supposing if I say it was X, it is my obligation to pass it on to my next generation, at least in the same form which is X. It should not be X minus Y. So its value as an asset, its value as entire environment shouldn't get diminished. That is your intergenerational equity. Or there is a very beautiful story when a grandfather and a grandchild sees the grandfather planting a mango tree. So the grandchild puts a question to him, when is this going to fruit? He says, after 40 years. He says, why are you doing it? Are you expecting that you'll live for 40 years? So he said, my grandfather did it for me, I'm doing it for you. So therefore, that's intergenerational equity, correct? That's number one principle. Number two, what you said about MIC, I don't know exactly what are the details of whether there was any statutory command and there was a failure to disclose. What I am saying is slightly of a different nature. Even if it was disclosed that I have so many liters of MIC in my premises, But if you're not going to use it, or you haven't used it for a year or so, then it is always, the good sort of, governance demands that you must get rid of this kind of substance. So therefore, it is from that standpoint that I said the failure on part of the management to take care of adequate precautions, correct? This happens almost every time, whether it is public sector undertaking, whether it is not, whether it is A regulator or B regulator. When a bank goes fut, somebody may ask, what was the Reserve Bank of India doing all the while? Because the audited accounts, everything is actually given to the Reserve Bank every now and then. If you couldn't smell the rat, you as a regulator, then what is this nameless, voiceless person going to do? He may not have that wherewithal. So therefore, that's precisely why every authority in the chain of that particular business has to do what is called the best efforts which he or she or that authority can bestow to that particular mechanism. That's the only way that we can have the best of the ideas.
There are two other hands, one there and one at the back. If we could just get a mic there, and we'll end after that.
Good afternoon, Justice Lalit. Thank you for your address. I'm a lawyer working with the Vidhi Center for Legal Policy. Sir, my question is, scholars of Indian constitutional law have pointed to the emergence of the administrative and regulatory state, consisting of powerful statutory regulators like the Competition Commission, SEBI, and in our case, NFRA as well. So in your view, I mean, of course, the Supreme Court has given expansive interpretations of their powers, regulation making, for example. In your view, what is the role of bodies like this in protecting public interest? And also, what is their place in the Indian constitutional framework? Because largely the constitution seems to be silent on the administrative and regulatory state in our country.
See, you are right that the constitution doesn't say anything about these administrative or what is called the governmental machineries. It simply describes what is the state legislature, what is the parliament, what is the judiciary, what is the judicial organ, including the district judiciary, and at best, bodies such as UPSC and public service commissions, correct? But nonetheless, if you see Article 12 will take within its fold every such authority, which is bestowed with the idea to do something which is to subserve the public interest. Now, very beautiful saying by Mahatma Gandhi, that if you are in doubt when it comes to exercise of power, whether it is judicial, administrative, or any kind of power, always think of that lowliest of the man, and whether is it going to exercise of your power, is it going to bring a smile on his face, a solace to him, or a succor to him, correct? So therefore, if you go by that idea, every single regulatory authority, the parameter or the perimeter of its power is prescribed under the legislation. It can't be acting ultra-virus. So therefore, the perimeter is fixed. If it acts within that, like take for instance Medical Council of India, if it were to act completely within the perimeter of that, then perhaps I think there wouldn't have been necessity to supersede that. So therefore, these are the instances where perhaps every such authority, if it oversteps, then the fallout will certainly be in the nature of either superseding or doing something to terminate the authority. But minus that, if it functions within that area, the jurisdiction that it has been conferred upon, there won't be any chances to regret, there won't be any chances to sort of, doubt or any kind of doubt arising in the mind of anybody. So therefore, that's what, yes.
So lest anyone think that only male chartered accountants and auditors ask questions, I think there was a lady somewhere at the back, so who had her hand raised, if I'm not mistaken.
Hello?
Yeah, somewhere.
Yeah.
Yes, please.
Yes, there.
Okay,
yes, that's right. So please, last question to you.
Yeah. So audit is a risky profession is something that we are listening even here and even outside, and this has been a continuous debate. So every citizen and every profession has its own rights of protection when duties that are cast on them are done diligently. We have seen recently some of the, many cases that are on and off, that auditors are pulled into any kind of dispute, maybe a family dispute, maybe a property dispute also, and maybe non-filing of some return, anything and whatsoever. Sir, do you think there is a requirement for something like an auditor protection bill or something of that sort of a law, which is, you know, highly controversial, but at the same time, do you think is it the need of the hour?
I wish the auditors had the same protection which advocates have under the Evidence Act. The secrecy of whatever instructions they receive, correct? That can never be tested, never be challenged in a court of law. But ma'am, you are in such a profession, you have chosen this profession, which is what? The entire society looks up to you to say that you as auditor, you will find if there is anything wrong in that profile of that organization. And if you have that kind of ability, knowledge, experience, and learning, that you can find that, the society relies on your judgment, your understanding. So therefore, if you then say that, please protect me, then that will be a paradoxical situation, ma'am. Yeah, yes, you are right. So therefore, always what we say is that any bona fide exercise always gets protected. Anything which is shorter than that or lesser than that will not have that protection. Okay, thanks.
I think you may say auditors need protection. I'm currently going through an internal audit. I feel we need some protection from auditors as well. But it's been a really invigorating session. Lots to think about. And thank you very much, Justice Lalit, one more time for these wonderful set of remarks and for coming here and being with us today. Thank you very much.
Thank you so much. And I must thank the organizers for giving me this opportunity to place my views before you. I know this corporate governance is highly a technical field. I didn't want to be sort of you getting engrossed in those technicalities. You have umpteen number of sessions where you can have that kind of exercise. I thought, let me present a view which, as a judge, as a lawyer, we have had certain kind of encounters in the past. So therefore, that's what the intent or the object behind this address was. Thank you so much. I enjoyed it. Yes, thank you.
Thank you very much indeed, sir. And I would now request Dr. Ajay Bhushan Prasad Pandey, sir, to kindly do the honors of presenting a token of gratitude and respect to our guest of honor, Honorable Justice Lalit. A small token of gratitude, sir, a memento. I would request Mr. Amit Jain, CGM NFRA, to kindly do the honors of presenting a token of gratitude to Mr. Arghya Sen Gupta. Thank you. And before we close the proceedings of this session, may I invite Dr. Janak Raj, Executive Director Law, NFRA, to kindly say a few words of thanks.
While conveying my namaskar to honorable dignitaries at dais and respected audience, on behalf of NFRA and audience here in this room, it is an honor to propose a vote of thanks. On this occasion, my heart is filled with lots of gratitude and respect for our honorable and distinguished guest speakers, Honorable Justice Lalit Sir and Shri Arghya Sen Gupta ji, for not only sparing their valuable time for gracing this event, but also enlightening us with most relevant and enlightening insights. Honorable Justice Lalit Sir has given a very deep insight on importance of public interest in corporate governance, citing examples of case laws like Bhopal Gas Kand. I am in public interest. I express my most humble, heartfelt thanks and gratitude. We at NFRA will always be grateful for your kind presence in the first international conference of NFRA today. Thanks to all and everyone. Namaskar. Jai Hind.
Thank you very much indeed, sir. May I request for a group photograph I would also invite Dr. Raj and Mr. Amit Jain to join our dignitaries for a group photograph, sir. And let's once again put our hands together to thank Honorable Justice Lalit, former Chief Justice of India. May I also invite other members of NFRA to join a dignitary for the group photograph. Sir, may I request you for 1 more minute, sir? Secretary Corporate Affairs also to kindly join. Thank you, sir. And ladies and gentlemen, I would request everyone to kindly remain seated as we are not having any tea or coffee break now. Straight away moving to the next panel discussion session, and we will have the high tea after the conference is over. Thank you. Kindly give us a moment while we arrange the top table for the next session. Meanwhile, can we check the audio quality with our eminent panelist, Mr. Takashi Nagaoka? Is he here with us? Mr. Nagaoka is here with us. Has he joined?
You hear me? Hello? Can you hear me?
Yes, yes, Mr. Takashi, we
Yes,
can hear
sir,
you.
Okay.
we can hear you.
Right.
Can you hear us, sir?
Yes, clear.
Thank
Thanks.
you, sir. Warm welcome. We are just about to go ahead with the proceedings of the session. Ladies and gentlemen, kindly remain seated, please. As I would like to invite our distinguished moderator, Mr. Sumit Seth, Partner Capital Markets and Accounting Advisory Services, ESG Reporting and Assurance, PricewaterhouseCoopers Chartered Accountants Limited. Let's put our hands together to welcome sir. I also invite eminent panelist, Mr. Amarjeet Singh, whole-time member, Securities and Exchange Board of India, SEBI. Warm welcome, sir. Mr. Takashi Nagaoka, Chair, International Forum of Independent Audit Regulators, Secretary General of Certified Public Accountants and Auditing Oversight Board, Deputy Commissioner for International Affairs at Japan's Financial Services Agency, has joined us on the virtual mode. A very warm welcome to you, sir. And may I also invite Mr. Kaushik Chatterjee, Executive Director and CFO, Tata Steel. So ladies and gentlemen, a quick round of introductions before I hand over to our moderator. Mr. Sumit Seth is the partner in the assurance practice of Pricewaterhouse Chartered Accountants LLP with over 26 years of professional service experience. He has served as the financial statement audit engagement partner on various listed companies spanning multiple sectors including US listed SEC issuers. And he is also a special invitee to ICAI's Accounting Standards Board. Shri Amarjeet Singh is a whole-time member, Securities and Exchange Board of India, SEBI, and prior to this assignment, he was Executive Director in SEBI. And Sir has been handling various departments, including Investment Management Department, Market Intermediaries, Regulation and Supervision Department, Office of International Affairs, Investigations Department, and Human Resources Department. Is a recipient of a Rotary Foundation Educational Award 2000 for promoting leadership development and international understanding by Rotary International USA and jointly by Japan World Bank Graduate Scholarship Award by 2001 and 2. Warm welcome, sir. And Mr. Takashi Nagaoka, Secretary General of Certified Public Accountants and Auditing Oversight Board and Deputy Commissioner for International Affairs at Japan's Financial Service Agency, was elected IFIAR Chair in 2023 after representing the JFSA at the IFIAR Board. In addition to his work with IFIAR, Mr. Takashi also currently chairs the IOSCO Multilateral Memorandum of Understanding Monitoring Group and IOSCO Administrative Arrangement Assessment Group. A warm welcome to you, sir. And finally, Mr. Kaushik Chatterjee is Executive Director and Chief Financial Officer. Tata Steel has been appointed as trustee of the IFRS Foundation. He has also been appointed as a member of the Advisory Board of the UN Global Compact CFO Coalition for the Sustainable Development Goals, where he will be the sector lead for industrial goods and represent the Asia-Pacific geography. Mr. Chatterjee was declared one of India's best CFOs by Business Today magazine in 2005 and 6, by CNBC in 2007 and 12, and in 2009 he was awarded the Best Indian Executive by Asia Money, and in 2015 was recognized as the most influential CFO of India by the Chartered Institute of Management Accountants, UK. In 2019, Financial Express awarded him for CFO Lifetime Achievement Award, and he is a fellow member of the Institute of Chartered Accountants of India. A warm welcome to you, sir. And ladies and gentlemen, before I hand over to our distinguished moderator, I would like to announce that NFRA plays a significant role in ensuring that auditors consider climate change risk and impacts in their assessment of the financial statements. Auditors are increasingly required to evaluate how climate change affects a company's financial position, performance, and the prospects. And now, before we delve into our discussions, we present before you a short film on climate change.
Human activities, from pollution to overpopulation, are driving up the Earth's temperature and fundamentally changing the world around us. The main cause is a phenomenon known as the greenhouse effect. Gases in the atmosphere, such as water vapor, carbon dioxide, methane, nitrous oxide, and chlorofluorocarbons, let the sun's light in, but keep some of the heat from escaping, like the glass walls of a greenhouse. The more greenhouse gases in the atmosphere, the more heat gets trapped, strengthening the greenhouse effect and increasing the Earth's temperature. Human activities, like the burning of fossil fuels, have increased the amount of CO2 in the atmosphere by more than a third since the Industrial Revolution. The rapid increase in greenhouse gases in the atmosphere has warmed the planet at an alarming rate. While Earth's climate has fluctuated in the past, atmospheric carbon dioxide hasn't reached today's levels in hundreds of thousands of years. Climate change has consequences for our oceans, our weather, our food sources, and our health. Ice sheets, such as Greenland and Antarctica, are melting. The extra water that was once held in glaciers causes sea levels to rise and spills out of the oceans, flooding coastal regions. Warmer temperatures also make weather more extreme. This means not only more intense major storms, floods, and heavy snowfall, but also longer and more frequent droughts. These changes in weather pose challenges. Growing crops becomes more difficult. The areas where plants and animals can live shift, and water supplies are diminished. In addition to creating new agricultural challenges, climate change can directly affect people's physical health. In urban areas, the warmer atmosphere creates an environment that traps and increases the amount of smog. This is because smog contains ozone particles, which increase rapidly at higher temperatures. Exposure to higher levels of smog can cause health problems such as asthma, heart disease, and lung cancer. While the rapid rate of climate change is caused by humans, humans are also the ones who can combat it. If we work to replace fossil fuels with renewable energy sources like solar and wind, which don't produce greenhouse gas emissions, we might still be able to prevent some of the worst effects of climate change.
Thank you very much indeed. And ladies and gentlemen, I now hand over to our moderator of the session, Mr. Sumit Seth, to kindly carry forward the proceedings of the session. And may I request you, sir, in the constraint of time, if you could kindly conclude in 50 minutes to 1 hour. Over to you, sir.
Thank you. First of all, thank you, NFRA, for having me here. It's a privilege, and to, of course, interact with all of you here. I think Justice Lalit's session was a perfect segue into this session. He spoke about corporate governance, he spoke about community, he spoke about environment, and actually I was just thinking about it, how all the case laws was actually reflecting, the topic of sustainability. So maybe let me just get straight into that, and moving from financial reporting, let's move to non-financial reporting and sustainability. So just to kind of set the context, there is an enigma around sustainability reporting and to what that is. So out here, if you see, it's really, it's not so complicated actually. It's about really how does a corporation conduct its business in a sustainable manner. What that means, and I think there was a gentleman here who spoke about intergenerational equity, and that's exactly what it is. How do we meet the needs of our current generations without sacrificing or compromising the ability of future generations? So it's really about conducting our business in a responsible manner. And these are just the 3 pillars of sustainability, which is environment, social, and governance. And that's how companies kind of look at that, and through those lens. Like financial reporting, one would look at what are those really material topics. And again, like financial reporting, you start with business risks, which translates into financial statement risks and then audit risks. Here, it's sustainability risks and also opportunities which businesses manage. And of course, once they manage these risks and opportunities, there are KPIs through which they report it. And if you can maybe move to the next slide, there are obviously our regulators and our standard setters who are looking at this quite closely. They have put out standards so that these KPIs can be reported consistently. They can be comparable and complete. I think that's been one of the, I would say, challenges also. And as you see out here, there are a variety of standards out there, both nationally and internationally. And we'll try and cover some of this through our discussions with our panelists. But the end goal really is having trusted, transparent reporting, so that can increase, of course, value. And again, value not for just one set of stakeholder or shareholders, but there are a variety of stakeholders out there. So maybe with that background and context, if I may start, with our panelists. And Mr. Singh, if I can maybe start with you first. And you've been at the center stage of the BRSR reporting. And we are so proud, actually, as a nation, that India is leading the way in the context of ESG reporting. So maybe if I can start with you, there has been, of course, the whole evolution, the reporting standards are kind of evolving. There have been significant developments both locally and internationally. How would you kind of outline that for our audience in terms of the landscape and the milestones which have been achieved here?
Yeah, sure. But before I do that, I would like to thank Chairman NFRA and his team, for inviting me and having me here. I was looking at the conference schedule. It's a fantastic conference, so my compliments. So it's a very interesting landscape and very fast evolving one also. So let's understand some basics around sustainability movement. First, it's a long-term movement. It's a multi-decade movement. And what we are seeing in the last few years is just the beginning of that. It has gained more traction, more speed in the last 5 years. So let me give you very briefly the state of play of the last 5 years. 2019, 2020, I think it got a lot of focus, a lot of attention was paid to this area by regulators also. I think one main reason was COVID-19 that brought off renewed focus on sustainability issues. 2021, we had COP26, where, as we are aware, many nations made their net zero commitments, including India. Come 2022, you see a bit of, the Russian-Ukraine situation, which led to whole debate about energy security. And the ESG investing, which had picked up in the last 2 years, there were question marks around that. And in fact, some of the prominent financial groups started going slow on ESG investing, or they even started pulling out of the Net Zero Alliance, which was formed earlier. But be it, as it may, the fact remains, and the movie which was shown, just that 2-minute clip, is very clear that the climate change is happening. It is very real. And the investors are seeing the physical risk, seeing the transition risk. They're also seeing the opportunities, and they need to be aware of how it impacts their investments. So that brings me to the question of how the sustainability disclosure landscape has evolved over the last few years. So let's understand this. The main driving force behind sustainability disclosures, to my mind at least, has been that of investors. Before regulators jumped in, investors were already asking for those non-financial sustainability related disclosures. If you look at different geographies, look at the FSP survey, Financial Stability Board survey of 2023. It very clearly brings out all the 25 member states of FSP, either one or more than one authorities in those respective regions is focusing on disclosure, sustainability disclosures. Another very interesting trend is most of the jurisdictions had the disclosure requirement in the voluntary space. It was not mandatory, unlike India. They are now moving more towards mandatory requirements. If you look at Europe, they have been on the forefront. We have this ESRS, which is a very comprehensive framework for sustainability disclosures. In US, and which is comprehensive in the sense it covers not just climate, it also covers the social issues, governance issues, and so on. In US, we have climate disclosures which are yet to be notified, but there has been consultation and debate around that. So in a nutshell, most of the geographies, most of the important markets have moved towards sustainability disclosures. To give you a very quick view of the situation in India, not many people know this. We started on this journey way back in 2012 when we came out with our BRR requirement, business responsibility reporting. That was only for top 100 companies in 2012, and it was mandatory even then. Then we progressively moved to 1,000 companies by 2019, and I don't want to trouble you with a lot of details. Let me fast forward to 2021 when we notified BRSR, which is a very comprehensive sustainability disclosure template. It has some 800 data points. So we kept it voluntary to begin with, but even in that year, we found that 185 companies had chosen to disclose, despite the fact that it was voluntary. This was for 21-22. For 2022-23, when it was mandatory for 1,000 companies, 1,185 companies chose to disclose it. Not just 1,000 companies, more than 1,000 companies. So I think the data shows that corporates are seeing value in making these disclosures. Investors, of course, are demanding these disclosures, and they see a lot of value. That is why they demand these disclosures. BRSR has brought in more transparency. See, why are regulators like us engaged into this space? We want, our focus is investors should know what are the risks, what are the opportunities relating to sustainability issues. So maybe let me pause with that. I can go on otherwise.
Maybe if I can move to Mr. Takashi, would you like to add to this, on the same kind of aspect from your perspective?
Thank you very much, Mr. Sumit. And As Mr. Amajit, I'd like to start by thanking NFRA for inviting me to this panel. And while it is quite unfortunate that I could not come to India to attend this conference in person, still it is my great pleasure to sit on this panel with distinguished panelists to discuss the important topic of sustainability reporting. And today, I will probably be wearing 3 hats, one being the Japanese regulator, one being chair of the International Forum of Independent Audit Regulators, and one being chair of the IFRS Foundation Monitoring Board. And I would make a usual disclaimer that the views I share today will be of my own and do not necessarily represent those of the 3 organizations I mentioned or their members or their staff. And lastly, I'd like to make a short remark before I respond to the question. It may not be an ideal timing, but as chair of IFR and on behalf of its members, I would like to express my warm welcome to NFRA for joining the group last November as a new member. And we look forward to working closely with you towards the shared goal of improving audit quality globally. And long introduction, but with that, I'll start my response to the question. Well, many of the aspects of the evolution has been already touched upon by Mr. Amajit. So I'll just add some flavor from focusing on the standards around sustainability reporting. And in a nutshell, the evolution was that, as mentioned, the investors wanted to have the information on sustainability-related activities. And then following those needs, a lot of standards have been developed by different groups in different regions. And then we were seeing a situation where we often called alphabet soup. And then in that situation, the investors need turn one step forward, and then there was great need for information to be consistent, comparable, and investor usable. And there was this high demand for such international or global baseline or framework to cater to those needs. And then in that context, there has been milestones in the area of sustainability reporting standards. And I will just touch upon a few. First, I think the remarkable thing was that in 2015, Financial Stability Board established a task force on climate-related financial disclosures to talk about how climate-related information should be disclosed and what kind of reactions the financial institutions should take vis-a-vis climate change. And then as an output, in 2017, there was this recommendation to encourage the development of standards that will cater to the consistent, comparable, trustworthy, and clear information in the market. And then, in line with those developments, in 2021, during COP26, the IFRS Foundation established the International Sustainability Standards Board based on the inputs from the stakeholders worldwide. And then within just 2 short years since the establishment of this ISSB, it has successfully launched a set of sustainability standards in 2023, in June actually. And then these standards were endorsed by IOSCO, like IOSCO did for International Financial Reporting Standards. And this endorsement gave thrust to this set of new standards developed by ISSB. So the development from alphabet soup to global framework, this has taken place in a very short period of time, but in a very remarkable manner. But is this the end of the journey? Not at all. I would say that this is just the beginning, as has been mentioned earlier. In different dimensions. One, standards are there, but they should be used globally to be international framework. So as IOSCO put it, the jurisdiction should think about adopting, applying, or being informed by those standards. And then after all that, there will be a true form of global framework for sustainability reporting. So we will still need to see that. And also from different dimension, this is only climate related information. And when we talk about sustainability, as we saw in the video and as we saw in the moderator's slides, E is only part of ESG, and then we have to be thinking about S and G. So in that context, we will see further development in ISSB's future agenda. And then it has completed its agenda consultation and is trying to come up with the result of those consultations. So a lot has been done, but a lot will be coming. So I think that's the general landscape when we talk about the reporting standards per se. Thank you. I'll stop here.
Thank you, Mr. Takashi. So Kaushik, maybe I'll turn over to you now from a preparer's perspective. And I know you've been, your company has been preparing integrated reports for a fairly long period of time. You consider GRI standards, you do BRSR, you already do integrated report. And as we just heard now, the ISSB standards are out there. So kind of what's your view and how do you look at this, evolving in the future, considering all these frameworks? And also the kind of harmonization, if any, with the global standards. That's kind of question number one. And the other is, how do you look at this, progressing in the next maybe 4 to 5 years, as this all evolves?
Thanks, Sumit. Good afternoon, ladies and gentlemen, and thank you, NFRA, for inviting me to speak at this very important conference. Let me step back a little bit. I'll come to disclosures. But the whole point on sustainability as a source of where does it come from? Mr. Singh talked about the investors demanding it. There is a different ask from different regulators today. But fundamentally, it goes back towards defining what is a responsible business supposed to do. And defining your stakeholders becomes the first and the most important step, because over the last maybe 5, 6, 7 decades, we've seen that shareholders being the most important stakeholder for any organization, because we've been living through decades of industrialization, development across the world. And as we develop this, we find that the stakeholders, and I see this in Europe very significantly, where the stakeholder universe has rapidly moved from just the shareholder to the community, to the employees, to the customers, suppliers, the entire supply chain. And their stake is becoming more and more important for multiple reasons. As one saw in the video, health is an important issue. Because health is an important issue, climate is an important issue, nature is an important issue. And therefore, I think the earth has become a very important stakeholder. It's just not the shareholder. So if you have to address the issues of the earth, we have to redefine what a responsible business should be doing. It's difficult. We are living today in an era of outages and outrage. Everywhere across, if you look at the newspapers or the media, you will find how different geopolitical events are leading to outages, and you will find different communities across the world are having a certain sense of outrage on what's going on as status quo. So that's actually the context on which
the foundation of sustainability or importance of sustainability comes in. Because end of the day, when you looked at what is happening in Europe, the EU ETS, which is the carbon pricing model, was increasing the cost of business. And as the cost of business increases, every investment that you do on status quo actually can result in a stranded asset, which then affects the investor. And that is why the investors today increasingly asking, what are you doing beyond your financial numbers? They're not asking for the love of the company or for any other reasons which are very generous. They're very specifically asking because their asset exposures are under risk if the company or organizations across sectors are doing things which are not, if I use the word, responsible. And in some ways, a responsible business has to look at things which does not have a quid pro quo. Justice Lalit talked about the CSR bit, and I think if you have a quid pro quo, then it breaks that barrier. It doesn't kind of meet the requirement. So yes, the investors are asking for it, the community is asking for it, the regulators will be asking for it, and the entire ecosystem wants to know what the company is doing beyond its financial numbers. Their profit and loss accounts, the cash flows and the balance sheet will remain important for the financial stability of the business. But for the economic stability of the business on a longer term, one has to look at what disclosures comes in from the company. Because when you look at sustainability, it is not just financial sustainability. It is now becoming social sustainability. How does an organization live within the community in which it operates? It's looking at environmental sustainability, be it nature, be it biodiversity, be it resources like water, or be it climate. So I think it's the whole system view of a business is now within the lens of a stakeholder, much beyond the shareholder. And I think that's where this is going. The standards are coming in, and I think as ISSB, internationally ISSB goes towards more and more standards. They've come up with two, S1 and S2, which will get operated and be in operation soon. We will see more and more standards covering climate, nature, biodiversity, water. And to me, the reference point is the 17 UN SDGs, because those 17 UN SDGs actually cover the entire spectrum of sustainability. And ultimately, I presume that the ISSB will have to cover all of that. Nearer home, I think SEBI's done a very important work and a seminal work in coming out with the BRSR framework. As a preparer, I might complain that I have a lot of work to do, but I think as a responsible business, I would certainly say that framework kind of addresses the range of sustainability outcomes that any stakeholder would like to see, if done with the heart and the principle of disclosing things, what you do. Because when you look at the disclosures, it has to cover between the strategy, the risk and opportunity, and the governance part in all together. So if you're looking at different standards, your chart Sumit had many standard setters, evolution from GRI in 2002. The most important thing as we are coming in is to ensure that it comes out consistently. We need to ensure there is interoperability of the standards, so that we, as preparers, we don't keep doing standards for different geographies and different lenses and different purposes. So if the interoperability, which ISSB and IFRS Foundation is addressing in terms of jurisdictional views, I think it will help preparers, it will help the stakeholders to compare on a consistent basis the frameworks of measurement and disclosures.
Thank you. Thanks, Kaushik. Mr. Singh, maybe if I can just, as Kaushik spoke about, he covered stakeholder interactions, expectations, he spoke about interoperability. Maybe if you can, provide your thoughts and add to that as to how these reporting frameworks, obviously address stakeholder expectations. What are those environmental challenges, and of course community-based aspects, and most importantly also interoperability, because that's a topic which comes up in many conversations.
So let me answer the last one first. That's a simple one. So interoperability, when we were developing BRSR, so that was an issue raised by the industry with us, because there were multiple frameworks available. Even today they are there, but now we've seen some consolidation, some convergence happening after ISSB standards have come. So BRSR framework recognizes that in case you are disclosing as per, let's say, GRI, that will be fine, and you can just cross-refer, and that will be taken as deemed compliance of BRSR. So that is already there, and that would presumably apply even for ISSB. If you are compliant with ISSB, then you don't have to separately comply with BRSR. On the stakeholder versus shareholder, I think that's a very interesting debate. I just have two comments there, very quick comments. Our Companies Act already recognizes that, and we did it, I think, much earlier, and then this whole debate started in the US. It gained more traction a few years back. So I think Section 1666, if I'm not wrong, already recognizes that the company has to take care of not just shareholders, but also of community, employees, and the environment. So, but what I feel, while that is a very high-level legislative indication, but we don't really have necessary frameworks for each of those stakeholders. And I think perhaps now is the time to have debate around that, how to develop frameworks in terms of disclosures, accountability, board level discussions, and so on. As a regulator, I would probably, think about, just like we talk about greenwashing, it should not happen that there is a purpose washing, if I can call it. So I'll probably worry about that as a regulator. I'll pause with that.
Thanks. Thanks for that, Mr. Singh. I'll kind of move forward and maybe get on some of the practical aspects of reporting. I often hear that it is challenging, it is difficult. So maybe if I can start with yourself, Mr. Takashi, based on your practical experiences, what are the common challenges you have seen, in the context of preparing sustainability reports, and how some of those barriers could be overcome?
Okay, thank you very much. That's a very important, good question, but by definition very difficult to answer, but let me give it a try. First, well, if we talk about challenges, there are a lot of challenges in sustainability reporting, but if we look at it in a big picture, I think there are several aspects of challenges we see. One is how prepared the corporates are in terms of reporting regime. And the second, how exactly they could report the content-wise. And then third, as we have been discussing, especially for those companies operating cross-border, their compliance with different requirements in different jurisdictions and based on different standards. So those three pillars I will raise first. And then for the first one, if we look at the preparation for financial reporting, over years, the corporations have a very solid system, internal control system over financial reporting. And if we compare it to the current status of sustainability reporting, we often see that the internal control over it is not as much, and then resources allocated to that is not as much. And so if we are to really have fully fledged sustainability reporting that meets the the needs, that meets the desires from the investors, I think the corporates need to think about rebuilding, well, rebuilding maybe not be the word, but strengthening their internal system around the financial, no, the sustainability reporting. And that in itself is a challenge. And then even if they have that system in place, we move to the content of sustainability. But saying that sustainability reporting is important and then that we have standards there, that's pretty easy to say, but actually how to implement it at individual corporate level is not an easy task. And then the argument that we often hear is that, for example, for green gas emissions, especially scope 3, can the corporate acquire appropriate data in a timely manner? That's a very big challenge. There is no market for that. And then in order to acquire those relevant data, at this point, corporate needs to pay a lot of cost to do so. And then if there are a certain kind of commonly usable platform for that kind of information, some market for such information being developed across industries, across jurisdictions, then the cost for corporate sector will be much, much less affordable. But this is something that we have to be working on. It's not the regulatory world, it's not purely private world. I think there should be coordination, cooperation among all the stakeholders around there. And then the third pillar about the potential fragmentation and the cost for compliance with different standards. As we were talking along this international global framework for reporting and the standards to adhere to that, that is very important. But at the same time, we know that sustainability reporting is not standing alone. It's part of overall sustainability policy, sustainability system in individual jurisdiction. And then being such sustainability reporting, the focus of sustainability reporting may differ from jurisdiction to jurisdiction. But what is important here is that at the core, there is this commonality that is represented by this international framework. And then the concept of interoperability that we heard, and then also the building block approach that is taken by ISSB. Those are really important concepts. The standards cannot be really identical in purest form in different jurisdictions, but they could be functionally identical. And then in order to do that, the ensurement through those interoperability discussions and distinguishment between global framework and the things, unique things that are built on it. Those are really important concepts to make these sustainable reporting a real thing, and not just a concept, but real thing. And then in order to do that, I think the ISSB's help coming, after development of these standards are really important. There are assistance to the corporate sector through educational materials and guidelines, and then also assistance for jurisdictions in the form of adoption guide, which will be coming into place in several months' time. But using those documents, I think there are a lot of hints, clues embedded in them. And then if all the stakeholders from their own standpoint go there and then check them and then use them, I think those challenges faced by the corporate sector and also other stakeholders will be, could be remediated. So the materials should be there, so let us work on it based on them. That will be my message. Thanks.
Thanks, Mr. Takashi. Maybe if I can move on to you, Kaushik, again, from a preparer's perspective, some of the practical challenges, which you have come across, when you're kind of putting out these reports, how does one overcome it? Some advice to the audience. And if I may ask, there are obviously 3 pillars, E, S, and G. Which one have you found more difficult to report, and why?
So I think we started many years back with integrated report, which is the integrated report principles were largely principle-based, not rule-based. And that's an important starting point because it gives you the latitude to define and disclose what under each of those 6 capitals had the business been run and what actions have been taken, the risk and opportunities and strategy and the governance oversight. But as we are moving forward, it needs to be, one of the most important thing, I think we all talk about comparability, is when the taxonomy gets defined. And without the taxonomy, what is a green to me could be gray to somebody else, should be black to somebody else. So therefore the taxonomy is important. I think that's where the ISSB's taxonomy principles are moving. GRI already has it. ESRS is also defining it. So it's going to get into the brass tacks. So the design rules and the design principles as a preparer becomes important. The second bit is, in my view, the entire space is going to get integrated between financial reporting and non-financial reporting. We will be effectively be doing corporate reporting, because if you have to cross-reference, link the financial impact of non-financial action, decisions, strategies, opportunities, and the forward view, it will be one reporting. So organizationally, it would be, to me, a best practice to move towards integrating corporate reporting rather than keep it as a separate, because the discipline that over the decades financial reporting has through the financial reporting standards globally and in India or anywhere else, if I say revenue of 10, it can mean only one way of revenue of 10. It cannot mean 10 ways. So similarly, when we look at non-financial reporting, Takashi-san referred to scope 3. Yes, the definition of scope 3, the duplication of scope 3, etc. comes into picture. So therefore, one has to get into the taxonomy. If you see in Europe, with the introduction of the carbon border adjustment tax, they are defining what is emission at the source country level. So we will have to become similar, and everybody has to talk the same language in non-financial reporting, and the entire definition, the decision rules, the reporting rules, and the disclosure rules have to be consistent across. So I think just now, people still have a bit of a leeway as this is an evolving subject. Just now, if I'm looking at a reasonable assurance certificate from what we report, you can disclose, define, say which guidelines you're following between GRI or earlier SASB, etc., and then you can define it. But very soon, maybe in a couple of years, we will have one defined approach, and then individual jurisdictions have to align or differ, like in IFRS and Ind AS. If there is any definitional difference, it is there and documented. It's not subject to interpretation or the treatment. By and large, it's similar, but if there are any carve-outs, then individual jurisdictions will have to carve out from the ISSB. But unfortunately, climate knows no political boundaries. In accounting terms, we can define it does work for another geography, doesn't work here, or vice versa. Climate, nature are somewhat irrespective of political boundaries or geography. So, end of the day, what we do is, what our current focus is actually on automation and ensuring that we have a similar, like if you have a ERP for financial reporting and financial data, capture, we are doing the same for non-financial, and we are not going on the whole hog, but we're looking at priority and what will be worked on the disclosures. It is also working based on what the BRSR looks like, because the core BRSR also has to be assured. So therefore, we are looking at ensuring that definitions are correct, the data capture and the integrity is correct, and then only can you offer it for assurance. So it's a full range of activity which needs to be done. And there has to be linked to this is a very strong capability building within the organization, because this is a new area and a maturity needs to be achieved soon in order to ensure that it is reasonably assured.
So I think we have the experience of how IFRS on the financial reporting side evolved. So we have a precedence of an evolutionary path that it took. So I think probably it may evolve on the similar lines, but it may be more complex. Yeah, that's what they.
Yeah, thank you for that. And I'll come back to you, Kaushik, on the linkage between financial reporting you mentioned and technology. But before that, Mr. Singh, if I may ask you, we heard Kaushik and Mr. Takashi on the challenges, but from your perspective and a regulator's perspective, what's the role of a board of directors, and the committees, in the context of sustainability reporting? There's a lot which is enshrined in the Companies Act, I know, but it would be great to hear from you as to what you expect from them.
Yeah, sure. So the G part of ESG we covered in BRSR. So let me also mention, in most of the jurisdictions in the West, it is climate first, right? The disclosure focus is climate first. Whereas we have taken very consciously climate plus approach. And that is given our, the developmental challenges, social inequalities, income inequalities. Given all of that, we very consciously followed a climate plus approach. So in coming specifically to your question, so the G part is actually addresses how is the governance structure addressing the E and S. How G addresses E and S in a nutshell. So there we've very specifically put some disclosure requirements as to what is the role and expectation of the board of directors. Does it get discussed in the board? Do you have a committee? You have to answer all these questions when you fill the BRSR template. Or is it just, idea is just to see whether it is just a lip service or something really is happening at the top level in the boardroom. This is a serious discussion. Is there a strategy around climate and social issues? If there is a strategy, then what is the goal that you've set yourself? And what is your performance against that goal? So we've put all those high-level disclosure requirements just to get a sense of, is G really addressing the E and S? Yeah, I'll pause with that.
Thanks. And while you're there, Mr. Singh, can you speak more about this whole concept of double materiality? That's been a topic which is coming up in various discussions. It would be helpful to
Kaushik could answer better that because he probably deals with it, but let me attempt. So double materiality in very simple terms, how the company is impacted by outside events, outside in, that is one, and then inside out, and how you are impacting the climate. So it's the externalities which you are creating and the externalities which you are affected by. So it's a discourse on both. And just to give an example, if let's say a company is engaged in selling seafood, right? So overfishing would impact. Overfishing would destroy your ecological resources, the availability of fish and so on, so you will be impacted by that. But seafood, because you're in that business, you could also put pressure on fishing. So, you are acting both ways. So that's, in a nutshell, the double materiality. And in BRSR, we've tried to cover both the aspects.
Thank you. Kaushik, would you like to add to that? And maybe if you can, also, there's a lot of discussion on financial reporting, but if you can maybe give some examples of the linkage between sustainability reporting and financial reporting with some examples.
So I think he's explained it very succinctly. So if you look at the UN SDG 17 framework, there is livelihoods, there's inequality, there's water, climate, nature, oceans, partnerships, and so on. And effectively, when we look at, so we do the assessment of the UN SDG within and see the applicability of that 17, and we have disclosed that we have impacted or impacts 15 of them. And the way we look at it is essentially when you look at how does under each of them you impact that, you as in the company impacts that, that element, and how does that element impact you. And then you define the materiality of how significant it is, and based on that you quantify, monetize, and then disclose. So that's how it works in a simplistic way. But your second question, which was the linkage between financial and non-financial reporting, before that you asked me the question about which one is most difficult to report. I don't think there is any additional difficulty or ease in any of them. But climate is more structured, it's more linear. You can measure scope 1, you can measure scope 2, you can make assumptions on scope 3, and you can disclose that. On governance, it's, as Mr. Singh mentioned, it's principle-based, it's coverage-based, it's risk-based. And I hope that eventually we will have more specific KPIs. The BRSR report does address that from a questionnaire point of view, addressing the data points point of view. And I think what would make a good report on both the E and the G, and including the S, is how does the impact happen from a company to each of these indicators, including KPIs. So social indicators, for example, how many lives have you impacted, positively and otherwise. Whether in that social indicators, it's health, it could be on education, it could be on livelihood, it could be on skills, it could be on any range of definition, and what is it that the company gets impacted by and or impacts each of them. As far as the linkage is concerned, I think the sustainability reporting is kind of a intermediate to the financial reporting, because what a company does is what it gets measured within its environment or non-financial. For example, if I am a company which is very badly managing my emissions, it should reflect on the emissions. If I am a company which affects the livelihoods of people by releasing toxic water, it will reflect on that. And finally, when the Pollution Control Board imposes a financial penalty on that, that impacts the financial outcome. So it is actually not independent. It's a kind of a value chain, it's interdependent, and actions taken by the company or strategies undertaken by the company, risk it faces or the opportunities it is leveraging will reflect on the financial reporting. So we don't see that because we're not used to seeing it for a long period of time. We don't see previous year numbers versus next year's numbers. So therefore, it is yet not visualized in that manner. But when these dashboards get interlinked, when we have the taxonomy in place, I think it will become very clear what are the, in fact, you asked Mr. Singh about the governance part. It will actually start from the governance to the plan, to the strategy, to the risks and the opportunities, actions taken by the company into the non-financial reporting, and the outcome of that finally measured in terms of money in the financial outcome. So it's a very clear interdependency. Today, many companies like to give a sustainability report, a very glossy, nice things to say, and it says we are all doing fine. Financial reports are separate. But as I said, that corporate reporting is going to integrate. There wouldn't be a line between non-financial and financial. and we'll see it in a more holistic manner. And therefore, the stakeholder, whosoever it is, will get to know a company's risk and opportunities in a more holistic way.
Thank you. So again, for financial accountants, it's not that sustainability reporting is a very separate topic. There is clear linkage. Maybe if I can move to Mr. Takashi, based on your experience, what are you seeing companies doing in the context of technology? And of course, what role can technology play both for reporting and assurance? And if you can share some examples.
Thanks. Before answering to that question, could I elaborate a little bit on topics that has been discussed earlier?
Sure.
Comparing E and S and G, as the previous speaker said, that climate is the most structured one, so it was the first one that was taken on board in the area of ESG. But even if we just talk about environment, E, climate is only part of it. And then for others, do we have any set goal or shared value, if you will, at this point? I don't think it is clear. We have to have it in order to have taxonomy and in order to have standards that leads to the framework of reporting. And then I think S&G, for those areas, I think the situation is the same. We have to first visualize what we want. And in the area of financial reporting and also in the area of climate, I think a lot of developments has started from in a bottom up approach rather than top down. And then we have to be seeing those developments on a wide basis. And then in order to do so, I think we have to be messaging out the importance of those issues and then have all the stakeholders think about it. And then after some molding take place, then we can start thinking about the framework. So I think encouraging those movements in a broad base is the first thing we have to do. And then, just for your information, but in Japan, we have started the disclosure of human capital, which could be categorized as S. And in that, we are asking the corporates to disclose, for example, human development policies and policies on improving workplace environment, etc. And that's only part of S, only a fragment of S, but we are starting to take some steps in that S sphere. So all those efforts in different jurisdictions, different areas, I think will mobilize the discussion in different areas so that we can build on it to further framework and then reporting standards. And then going back to technology, well, at this point, to be honest, we don't really see actual practices, actual examples of technologies being used to form certain best practices yet. But potentially speaking, theoretically speaking, I think the technology has a big role to play in solving many of the challenges that corporate sector will be facing. For example, going back to the scope 3 GHG emissions, when we look at the value chain information, how they are reported, if we have a robust system of collecting and analyzing abundance of data, that in itself will help the corporate sector eliminate their costs on gathering data and then analyzing and then trying to figure out what they could disclose as scope 3. So there is a potential for technology, even from those simple approach. And then further if we could come up with some algorithm on how we treat those data, and if we could look at data coming in on a real-time basis through the use of technology, all those things could be beneficial. And if we jump to the use of AI, to be honest, I don't know how we could use AI. There is a large potential, but there is a lot of risks that we have not explored yet. So we cannot say at this right moment whether it is useful or if it is risky. That we need to study more and then think about. Maybe we need a framework around AI itself before we could start utilizing it. But anyway, sorry, I cannot give a direct answer to your question, but I agree that there is a huge potential for that. X.
Thanks. Thank you, Mr. Takashi. Maybe in the interest of time, I'll cover one more theme, and I'll start with Mr. Singh. And this is in the context of greenwashing, and we hear that term, very often. So in that kind of context, Mr. Singh, how do you see auditors and assurance providers contributing towards integrity of sustainability reporting? And equally important, I think the ethical considerations around that in terms of conflict, independence, etc. So if you could share your thoughts around that.
Yeah, sure. So I'll tell you what we've done actually in this space, and I think that will illustrate the whole intention of. So the idea is that we need to understand that disclosures are important. Now we have a disclosure template. Investors would rely on those disclosures which are made by, as I mentioned, roughly 1,200 companies in our country today. Many other informed analysts and rating service providers, they would also rely on those disclosures. So it's very important that the disclosures which are made are credible, reliable, which can be used for the purpose of investment decision making. So from that objective in mind, what we've done is we have developed what Kaushik mentioned earlier, BRSR core, which is a set of 42 indicators, roughly a subset of BRSR. As I had mentioned, BRSR has 800 indicators. So to keep the ease of doing business in mind, we have required assurance requirement only on this limited set of BRSR core. And this has become effective this year for top 150 companies. So definitely the idea is that the assurance, reasonable assurance, that's what we are asking for, will add more credibility to the disclosures, which are important for the market, for the investors. Ethical element is again very important because, and we recently had ISPA has issued its global standards and they are seeking comments on that. So that is also for the purpose of assurance providers. I'll pause with that. I'm seeing a queue there. So.
Okay. No, so thank you for that, Mr. Singh. I think we will have to end the session. The honorable ministers out there. So thank you very much. If there are any questions, you can please take it offline. We'll be happy to answer.
Thank you. Thank you so much, sir. And sorry for interrupting and cutting short so abruptly. Quickly, I would like to invite Mr. Shyam Tak, ED NFRA, to kindly do the honors of presenting a token of gratitude to Mr. Sumit Seth, Mr. Amarjeet Singh, and Mr. Kaushik Chatterjee. And ladies and gentlemen, while we are getting ready to welcome the Honorable Minister, those seated at the back are kindly requested to move forward and occupy the seats in the front. All our guests who are seated at the back are kindly requested to move forward. We're extremely sorry for this inconvenience caused to you, but once again requesting everybody to kindly move forward and occupy the seats in the front. We are quickly getting the stage ready, and a group photograph, sir, before we close it. So ladies and gentlemen, we will quickly get the stage ready, and let's once again put our hands together to thank Mr. Takashi Nagaoka. Thank you very much indeed, sir, for sparing your time and being here with us. Thank you, sir. Thank you, sir.
मिडिल पे आएगा, एक और चेयर आएगा। हाँ उधर आ रहा है ना, अजय भूषण सर इधर, मनोज कोविल सर उधर। मनोज कोविल सर और ये पानी बोतल बदल दो। बदल रहे आई थिंक दोनों एंड पे रख लो, फिर मैडम से पूछ लो। हाँ यस यस प्लीज सिटिंग। हाँ एक्चुअली उनको भी हम सॉल्व करेंगे कि मैं बोल रही हूँ। अच्छा तो एक मिनट मैडम से बात करते हैं क्या उनके पास ही was secretary in Ministry of Corporate Affairs. तो फिर 5 चेयर्स राजेंद्र जी को यहाँ रखो ना। मैम ये रखिए, वो नींद पे टूटी हुई है ना इसलिए। एक ग्लास और एक बॉटल ये लो बॉटल। अच्छा एक प्रोग्राम कॉपी है। लगा दो ये एक और देखो देखो आ गया।
और जोरदार तालियों के साथ स्वागत करेंगे। लेट्स पुट आवर हैंड्स टुगेदर टू वेलकम माननीय मुख्य अतिथि माननीय मंत्री जी राव इंद्रजीत सिंह जी का। और उसी के साथ मंच पे स्वागत है डॉक्टर मनोज गोविल जी का, सचिव मिनिस्ट्री ऑफ कॉर्पोरेट अफेयर्स, डॉक्टर अजय भूषण प्रसाद पांडे, चेयरपर्सन NFRA, Dr. P.K. Tiwari, full-time member NFRA, and Ms. Smita Jhingran, full-time member NFRA. May we request everyone to kindly be seated. Namaskar and good evening. Honorable Chief Guest, Rao Inderjeet Singh Ji, Honorable Minister of State with independent charge for statistics and program implementation planning, and Honorable Minister of State for Corporate Affairs. Eminent dignitaries on the dais, our special invitees, distinguished leaders of the corporate world, accounting and audit professionals, distinguished participants from all across the globe, respected members of the press and media, ladies and gentlemen. A very warm welcome to the validatory session of the NFRA International Conference on Transparent Financial Reporting and Audit Quality Pillars of Corporate Governance. राष्ट्रीय वित्तीय रिपोर्टिंग प्राधिकरण द्वारा पारदर्शी वित्तीय रिपोर्टिंग एवं लेखा परीक्षा गुणवत्ता कॉर्पोरेट अभिशासन के स्तंभ पर आयोजित अंतर्राष्ट्रीय सम्मेलन के समापन सत्र में आप सभी का हार्दिक स्वागत है। Today, on this momentous occasion, we are honored to have amongst us the august presence of Rao Inderjeet Singh Ji, the Honorable Minister of State with independent charge for statistics and program implementation planning, and Honorable Minister of State for Corporate Affairs. Sir is the Honorable Union Minister, and he's also having the independent charge, Honorable Union Minister of State with independent charge, Ministry of Planning, and Union Minister of State for Ministry of Corporate Affairs, and has had a long and distinguished political career spanning several decades. He has held various ministerial positions from 31st May 2019 to 6th of July 2021. He was the Honorable Union Minister of State with independent charge at Ministry of Planning and Union Ministry of State with Ministry of Defense. Rao Inderjeet Singh Ji is a seasoned politician who has made significant contributions to the Indian politics. During his political career, he has been elected as the Lok Sabha member for 5 times. He is considered a prominent leader in Haryana politics and was positioned as the Honorable Cabinet Minister, Government of Haryana during 1991 to 96. And may I now request Dr. Ajay Bhushan Prasad Pandey, Honorable Chairperson, NFRA, to kindly do the honors of welcoming and honoring our Honorable Chief Guest, Honorable Minister, with the Madhubani stole. And we also present and welcome Sir with a green potted plant. I would request you, sir, to also honor and welcome Secretary, Ministry of Corporate Affairs, Dr. Manoj Govilji. And ladies and gentlemen, may I now invite Dr. Ajay Bhushan Prasad Pandey, Honorable Chairperson, NFRA, to kindly present the conference takeaways.
Honorable Minister of State Rao Inderjit Singh Ji, Dr. Manoj Govil, Secretary Corporate Affairs, Dr. P.K. Tiwari, Mrs. Smita Jhangran, full-time members of NFRA, distinguished speakers, panelists, guests, and the members of the media. It is my honor to welcome our chief guest today, Rao Inderjit Singh, who is Minister of State, Independent Charge for Statistics and Program Implementation and Planning, and also for Corporate Affairs, for this valedictory session of NFRA's first international conference. Honorable Minister could come here and grace this occasion during his so much busy schedule. You all can understand that at this point of time, how busy Honorable Minister would have been, but still he chose here to come. So we are really very thankful to you, sir. I also acknowledge here the presence of Dr. Manoj Govil, who is the Secretary, Ministry of Corporate Affairs, who has been, you all have seen, has been here for last 2 days, attended every session. So I want to say that Honorable Minister could come here, despite his busy schedule, and also the Secretary, who has been here for last 2 days. So actually, it does send us a message of how what kind of importance this conference is being attached, and also what kind of expectations which the government has from all of us, the regulator, and then the entire audit community, the corporate world. And I'm sure that whatever we have discussed in this conference, this is something which we will go ahead and we will try to do as much as possible. Also, during the last 2 days, sir, we had participants from accounting and corporate world, almost practically the top leadership, whether it is a regulator or whether the corporate world or whether it is the accounting and auditing world, they all were here. We were also very privileged to have international participants from our counterparts from the different parts of the world, like PCAOB, FRC, Austria, and also IFAR, International Forum for Independent Audit Regulator, and also we had members of the press and the media. Honorable Sir, we had the privilege of your presence and guidance way back in 2022 when we had hosted a seminar under AKAM, Azadi Ka Amrit Mahotsav. Again, sir, your presence here today again symbolizes your continued support as we are moving forward in our journey as mandated by the Parliament. Sir, as we know, NFRA is the youngest regulator in India in this sector, which was established just about 5 years ago. So therefore, it is a moment of gratitude and also great happiness for us that all stakeholders have been with us since yesterday, and to mark our journey and in many ways make this journey towards the further strengthening the audit quality, financial reporting, and thereby improving the overall corporate governance and serving the public interest in India. Sir, we had the opportunity to benefit from the deliberations from the diverse group of experts and practitioners over the last 2 days. Justice Ashok Bhushan, who gave us the NCLAT perspectives on the current regulation and our work. Justice U. Lalit, the former Chief Justice, gave us the perspective on legal interpretation and also the perspective on dominance of public interest in regulatory sphere. And if we see the takeaways from the last 2 days deliberation, the key takeaways have been that as a country, currently we are, in terms of economy, we are 5th, and we aspire to become in top 3 during the next few years. For that, what is required is that the continued confidence of the investors, whether it is a domestic investors or foreign investor or the retail investors. And then the investors are going to put their money only if they have a confidence in the corporate system here, corporate governance here, the regulatory system here, then the entire audit system. So all of this should inspire confidence, and that is why this conference assumes a very, very special significance. The globally audit quality inspections are integral part of the audit regulators and also corporate governance. In last 5 years, first 2-3 years, we took time to settle down and kind of build up our capacity. And during the last 1.5 years, we have done about 65 cases of disciplinary matters, and where we have taken appropriate actions in a major corporate failure cases of ILFS, DHFL, Cafe Coffee Day, SRS, and also we have started inspections since last year. This year we are going to further improve upon the inspections, where we will also engage with the audit committees and independent directors. So basically we want to engage in a dialogue, and our enforcement and NFRA should not be known only as somebody who does only the enforcement, but also indulges in a dialogue and how we can further improve the system, how it can be a two-way communication. So this is the kind of an exercise that we want to do that. Now, if we, the total, the various takeaway, sir, we had during the last 2 days, 7 sessions of the panel discussion. It ranged from investor protection, the responsibilities of the audit committees, independent directors, and also the standard formulations. One of the very important aspects we also discussed as to, and that is in line with expectations set by our Honorable Prime Minister, that should India not have also its own homegrown the big audit firms. Why should we talk only about Big 4 or Big 5 or Big 8? Why not we should have a larger set of large and very world famous homegrown audit firms. Today, if we see that India is, in terms of new startups, the globally India ranks, 3rd or 4th in terms of number of startups which are becoming unicorns. So we have achieved that distinction. So we all should collectively think, can we repeat the same thing? Can we do the same thing in the auditing community? So what exactly prevents us from doing this. And it was very, today there was a particular session, panel discussion devoted to that. And there we discussed that what all we need to do so that there are about 1 lakh chartered accountants who are in practice. 75,000, President ICAI, he gave those statistics. Almost 75,000 are the proprietary firms. 25,000 are the partnership firms. Now, can we, upgrade their skills? Can we have some special qualifications or a specialization just like, we have in the medical profession? And can we have some kind of the regulatory guidelines so that, they can project their work and they can, people can know about their good work, their qualifications, so that they can inspire trust among the companies and in the investors and the shareholders. So those are many of the things that we have deliberated. Sir, so what we intend doing this is that after this conference, we have taken note of the deliberations which have happened in all the panel discussions, and we will prepare a document, and we will make an action plan, and we'll pursue those action plan, I would say, in the coming months, because whatever we try to do, unless and until we set a timeline, and we need to set up some timeline. So we are going to do that. So with these words, sir, I end here, and I welcome you again for this validatory function here. Thank you very much, sir.
Thank you very much indeed, sir, for sharing the conference proceedings with the August House. And ladies and gentlemen, before we move forward with the proceedings of the validatory session, I have the proud privilege of saying that apart from the various other achievements of the Honorable Minister, today I am also proud to share that the Honorable Minister won medals for the country in Asian Games and Commonwealth Games in shooting. And let's put our hands together, ladies and gentlemen, a round of applause for that. और अब निवेदन है माननीय मंत्री महोदय जी से, श्री राव इंद्रजीत सिंह जी से, कि आप अपने प्रेरणात्मक संदेश के साथ हम सबका मार्गदर्शन करें, और एक बार जोरदार तालियों के साथ स्वागत करना चाहेंगे माननीय मंत्री महोदय जी।
Secretary Corporate Affairs, Shri Manoj Govil, Chairperson and members, NFRA, distinguished delegates and guests. It is with a sense of pleasure that I participate in the concluding session of NFRA's first international conference on transparent financial reporting and audit quality, held on 5th-6th March at Bharat Mandapam, our newest international conference house. This conference has brought together eminent personalities from various sectors to deliberate on critical topics shaping the landscape of financial reporting and auditing. I commend NFRA for this initiative in engaging stakeholders in a collaborative effort to elevate the quality of financial reporting and auditing standards. Conferences like this serve as a vital platform for professionals, industry leaders, regulators, members of the judiciary, and government officials to come together, exchange insights, and share best practices. As you already know, throughout the conference, multifaceted discussions on harnessing technology, safeguarding investor protection, and navigating recent reforms in auditing standards have taken place. I have been informed that you have explored the pivotal roles of audit committees and independent directors in fostering effective communication with auditors, while also acknowledging the strides made in financial reporting and the importance of sustainability reporting. Our government is working towards achieving the goal of Viksit Bharat by 2047 with the vision, prosperous Bharat, in harmony with nature, modern infrastructure and opportunities for all. Viksit Bharat 2047 means making India a developed entity by 2047 by encouraging various areas of development such as economy, environment, good governance, and social progress. The budget vote on account presented by the Honourable Finance Minister Nirmala Sitharaman represents a decisive move towards shaping a resilient, inclusive, innovative, and environmentally conscious India, perfectly aligned with Prime Minister Narendra Modi's vision. In the budget proposals for the financial year 25, 5 key areas deserve attention due to their significance. First, fiscal prudence. The government's aim to reduce the fiscal deficit from 5.8% to 5.1% of the GDP demonstrates fiscal responsibility and a commitment to sustainable growth. 2. CAPEX-led growth. Allocating 40% of the total budget increase to achieve an 11.1% enhancement in capital expenditure is commendable and underscores the government's dedication to laying a robust foundation for long-term growth. 3. Foreign investment. Recognizing the importance of capital inflows for advancing India's infrastructure, the government has extended tax benefits for startups and sovereign wealth or pension fund investments, fostering a favorable investment climate. 4. Green growth. The budget's emphasis on green growth builds on the existing support for the clean energy sector. The allocation of viability gap funding for offshore wind energy, coupled with initiatives to boost rooftop solar panels and promote the adoption of electric vehicles, signifies significant progress towards achieving the net zero target by 2070. The announcement of rupees 1 lakh crore corpus for R&D in sunrise projects further demonstrates a commitment to fostering innovation in clean energy technologies. 5. Skill development. The increased allocation for education and skill development underscores the importance of skilling and empowering youth to harness India's demographic dividend, offering growth opportunities and creating millions of jobs. In tune with the government's vision, this budget lays a robust foundation for India's journey to becoming a developed nation by 2047. The commitment to sustainable and equitable development, coupled with strategic investments in infrastructure and human capital, sets the stage for growth rates exceeding 7 to 8% over the next few decades. Hence, you can see how critical the role of the corporate sector is going to be. This vision is going to be achieved with all of us acting together and creating a trusting ecosystem for investors and creditors. Our government is committed to promoting a transparent financial reporting regime that adheres to global best practices. We all know that transparent financial reporting plays a pivotal role in enhancing investor confidence and in facilitating capital flow into the Indian economy. We have witnessed this in the last 10 years, which has led to increased capital inflows into the country, fueling economic growth, job creation, and overall prosperity. Friends, India boasts a rich heritage in accounting and auditing practices, dating back centuries. Ancient Indian texts like the Arthashastra document meticulous record-keeping methods employed in governance and trade. This tradition further evolved through Mughal rule, witnessing the adoption of double-entry bookkeeping. The colonial era brought Western accounting practices, which later paved the way for the Companies Act of 1956, laying the groundwork for modern corporate governance. The establishment of professional bodies like the Institute of Chartered Accountants further strengthened the accounting and auditing landscape. Today, as India strides towards the goal of becoming an economic powerhouse, the government recognizes the critical role of robust accounting and auditing standards. I wish to emphasize that the Government of India, spearheaded by the Ministry of Corporate Affairs, has implemented a series of initiatives aimed at bolstering the regulatory framework governing transparent financial reporting, namely, 1. The enactment of the Companies Act 2013. This is a prominent intervention ushering in enhanced disclosure norms, refined corporate governance standards, and stricter penalties for non-compliance, thus fostering transparency and accountability in financial reporting practices. Additionally, the mandatory adoption of Indian accounting standards aligned with international financial reporting standards for select companies has been instrumental in augmenting the comparability and transparency of financial statements on a global scale. The establishment of a National Financial Reporting Authority as an autonomous regulatory body underscores the government's commitment to ensuring quality and adherence to accounting and auditing standards, further enhancing transparency and reliability in financial reporting. Furthermore, amendments to listing regulations in collaboration with the Securities and Exchange Control Board of India serve to fortify disclosure requirements and corporate governance norms for listed entities, aligning Indian regulations with international best practices to bolster investor confidence. The introduction of Insolvency and Bankruptcy Code 2016 offers a consolidated framework for resolving insolvency proceedings, promoting transparency and expediency in corporate restructuring efforts. The reforms mentioned herein above build upon this legacy and align with international best practices. These initiatives not only ensure transparency and investor confidence, but also empower Indian businesses to compete effectively on the global stage. Strengthened enforcement mechanisms, coupled with initiatives to improve corporate governance, signify the government's proactive stance in fortifying the regulatory landscape. These concerted efforts underscore the Government of India's unwavering commitment to fostering transparency, reporting, vital for instilling investor trust, maintaining market integrity, and sustaining economic growth. India's journey towards imbibing best global practices in accounting and auditing is not merely a matter of compliance, but is a strategic imperative. By actively engaging with international standard setters and embracing convergence efforts like the International Financial Reporting Standards, we unlock several benefits. Firstly, it enhances the comparability and transparency of Indian financial statements, making them more readily understood by global investors. Secondly, it fosters seamless integration with international capital markets, attracting foreign investments and facilitating cross-border business opportunities. Finally, it elevates the skills and expertise of our accounting and auditing professionals, placing them at par with their global counterparts, further strengthening India's competitive edge in the globalized financial landscape. We recognize the critical role of NFRA, along with other regulators, in helping uphold the integrity of India's financial reporting ecosystem and ensuring investor protection. As we near the conclusion of this insightful conference, I want you to leave with not just knowledge gained, but with also a call for action. The discussions you've engaged in, the perspectives you have shared, and the best practices you have explored hold immense potential to shape the future of transparent financial reporting and quality auditing in India. Let us not allow these valuable takeaways to remain confined within the walls of this conference. I urge you, esteemed delegates, to translate your insights into action, whether you are an auditor, a standard setter, a regulator, or a leader within the corporate sector. Champion the best practices that you've encountered. Advocate for their implementation within your organizations. Collaborate with stakeholders to drive change, and share your knowledge to empower others. Remember, the success of transparent financial reporting and quality auditing hinges not just on individual efforts, but on a collective commitment to action. Let us leave this conference not just informed, but inspired to be the architects of a robust financial reporting ecosystem in India, one that fosters investor confidence, fuels economic growth, and positions our nation as a leader in global financial markets. To conclude, I compliment NFRA in holding this conference, the first of its kind that's been held in India, this international one. This gathering, convened under the leadership of NFRA Chairperson Dr. Ajay Bhushan Prasad Pandey and full-time members Dr. Tiwari and Ms. Jingran, has served as a pivotal forum for thought leaders from diverse sectors to deliberate on critical issues shaping the landscape of financial reporting and auditing. I commend NFRA on its commitment in driving dialogue and collaboration amongst stakeholders, fostering innovation, transparency, and accountability in the financial ecosystem. Well done, and thank you, and Jai Hind.
Thank you very much indeed, Honorable Minister, sir, for the inspiring and motivating address from you. And we also thank you for kindly sparing your valuable time and gracing this occasion. May I now invite Dr. P.K. Tiwari, full-time member, NFRA, to kindly propose a few words of thanks.
Honorable Minister for State, Independent Charge, Statistics and Program Implementation, Planning and Minister of State Corporate Affairs, Secretary, Ministry of Corporate Affairs, Chairman, NFRA, distinguished guests, colleagues, ladies and gentlemen. On behalf of the NFRA, I stand here to express our sincere gratitude to the Honorable Minister for gracing this valedictory session and addressing us this afternoon. Sir, your address will be a driving force for NFRA in our future endeavors. Sir, Chairman NCLAT, Honorable Justice Ashok Bhushan was here for the inaugural session and gave an inspiring speech. I take this opportunity to thank him for that. Dr. Manoj Govil, Secretary MCA, has given considerable time attending most, actually all of the sessions, and exchanging thoughts with delegates and officials of NFRA. NFRA is very enthused with the time and attention he has given to this conference. Dr. Govil, we sincerely thank you and all the senior officials of the MCA who have attended this different events of this conference. The conference had special addresses by Mr. Uday Kotak on the first day and Honorable Justice U. Lalit today. I take this opportunity to express our gratitude to both of them. The conference has had a number of distinguished panelists, men and women of high repute, knowledge, and experience, who traveled from different parts of the world and addressed this conference. On behalf of NFRA, I stand here to thank them and tell them that we truly appreciate their time and effort. I would also like to thank the delegates to this conference for giving an enthusiastic response to this conference, both in physical and virtual modes. We thank them from our hearts. We also extend our gratitude to accounting bodies like ACCA and ICAEW, PCAOB, IAASB, FRC, IFIAR, and CAG for their esteemed presence in the conference. We also extend our sincere thanks to the venue host, ITPO, ITDC, ITC, and RailTel for their hospitality and providing a conducive environment for the conference, and to those who provided catering services during the tea and coffee breaks and lunch. We also thank our friends from the media for covering this conference. Chairman NFRA, Dr. Ajay Bhushan Prasad Pandey, full-time member, and my colleague, Ms. Smita Jingran, Secretary NFRA, the executive directors, the CGMs, and all officers, staff of NFRA have worked tirelessly for conceptualizing and organizing this conference. They deserve a huge round of applause. Thank you. Finally, a big thank you to all those whose names I might have missed inadvertently. Thank you all once again for making this conference a success. Safe travels and best wishes. Jai Hind.
Thank you very much indeed, sir. And ladies and gentlemen, as we close the proceedings of the valedictory session and also of this international conference, I once again take this opportunity to thank our Honorable Minister and other dignitaries for gracing this occasion. May I request you, sir, for a group photograph with the distinguished members of NFRA. Thank you very much indeed. And ladies and gentlemen, let's once again put our hands together, especially for each one of you for your participation in making this event a huge success that it was. And we would like to invite on behalf of NFRA, each one of you to kindly join us for high tea before you leave the venue, once again on a floor 1 level below. And with that, ladies and gentlemen, once again, a huge thank you to each one of you. And we close the proceedings. It was wonderful working with each one of you. Ladies and gentlemen, thank you. Have a wonderful evening ahead. Safe drive home. Good evening and namaskar.